Can't believe I'm back, but I am. Let's see what the market has in store for us this week. Give me a minute as I get my stuff together here. I'm gonna actually divert a little bit of attention away from me to CNBC while I get my charts together. Check this volume, make sure it's not too loud.
Here's a piece, Jim, about electricity and some policy think tanks arguing that 2/3 of the electricity that's being sought for the boom will never get there because so much of it is phantom projects, sort of long shot pitches, and the grid operators don't know what's going to end up being real.
I think that's true. I do think that actually Michael needs to hear that. Michael actually does firm. I mean, there's a lot of guys out there who, look, I'll say it, Fermi, okay? They're claiming they have like a 11 gigawatt, but there's been no groundbreaking according to some of what people are saying.
Right.
His numbers until it is absolutely true, and I really like that about him. I can't say that about the other guys. But Carl, well, the one thing that's amazing is that let's say you're going to go to let's say we were at the Permian together. We went and visited this plant that Mike Worth talked about on our show. I mean, there you've got that whole GE Vernova turning the gas into electricity. That's going to be the model. Caterpillar too. Those are the models. Those are the ones behind the meter. They're not. I mean, I know Michael spoke very positively about what happens when he comes to a town. Eventually, what's going to happen? It's going to be like There Will Be Blood, where if I'm going to do this, I'm going to have to pay you $20,000 because I want my data center there. And by the way, I can't believe they're not doing that right now.
Is he Daniel Day-Lewis in that?
Yes. And you get a straw in there.
Yeah. I remember. Great movie. There was already a lot of opposition. I mean, when you started to see Texas, you got to believe that there is some opposition.
If the election, he'll repent on that. He'll go back.
Abbott?
Yeah, he'll do that. There are a lot of states that want it. There are a lot of places.
Without a doubt, there are a lot of states that want it, and it is going to be an ongoing debate. And by the way, we're just starting to, we talked about water yesterday. Actually, I was talking with Sarah about it, and the newest data centers are having a different approach in terms of their own
his
water and circular as opposed to use, and that is obviously can change the debate around water usage to a certain extent. And to your point, behind the meter, and so there are a lot of different things they conceivably can enter into this debate. But there's no doubt that there is rising opposition in general because there's fear around AI. It goes beyond
also, there's no guarantee Abbott wins.
It goes beyond data centers.
We have to defund Intrader. How's that? You want that?
Why do you always go to like Code Red?
Why do I go Code Red?
Yeah.
I'm
just saying. That there is a debate.
Well, you haven't hit me today about NVIDIA. NVIDIA's not doing that well.
NVIDIA is doing well. Oracle is doing fairly well.
Well, then talk about Oracle.
By the way,
talk about Oracle. Because you're hearing layoffs? What are you hearing?
I'm not. Are you hearing layoffs? What are you hearing?
There was a report, Business Insider, yesterday saying the company's planning another round. They've already cut 21K.
Well, remember, they do have Cerner, that medical records business. I'm not so sure if I want that business these days.
By the way, guys, when it comes to gigawatts, you heard Intrader talking about having, 500 megawatts so far already, and on their way to a lot more than that in terms of what they were able to set up, tripling that. Elon Musk on a conversation, all hands meeting, however you want to describe it, with SpaceX employees. Talk some big numbers. Not the first time, of course. We've heard it before, most recently on their first earnings conference call, in terms of getting to 10 gigawatts by the end of next year, and also talking about how their revenue from AI, and this is largely from offering compute to the likes of Anthropic or Alphabet, will definitely, in his words, exceed all other SpaceX revenue probably in September. I've said a lot of what he said. I don't know if you want to listen to it. Do we have it, guys?
I always like to listen to it.
Yeah, take a listen to Elon for a moment.
The wild thing is that probably our AI revenue, not probably, definitely, our AI revenue will exceed all other SpaceX revenue probably in September, like next month. and will significantly exceed all other SpaceX revenue in the fourth quarter. So AI has become an extremely important part of SpaceX's future. I think it's actually vital that we succeed in AI, not just in hardware, but also in software. So, yeah, the future is fundamentally AI and robots.
Well, robots, I think more Tesla than I think SpaceX. Of course, we will continue to talk about the real possibility that these two companies at some point become one. But that's funny that he went to robots, because robots is obviously where Tesla's going to be manufacturing them. Don't forget, this was all XAI at one point before it was brought into SpaceX. XAI was about Grok, the compute they were setting up in Memphis, that supercluster that he put together in some crazy number, what was it, 19 days, that had Jensen Huang in awe, was put together to provide the compute for Grok. It was only when this sort of didn't seem to need as much compute for Grok, and having built even more, and with that commitment from GPUs, that they have essentially become a mini hyperscaler on their way to being a max hyperscaler.
Look, I could argue that Intrader's a hyperscaler at this pace. But I will say that when you hear robots, Carl, you should be thinking Intel, because robots are CPU, not GPU. And Intel did that equity offering earlier this week at 95, and now it's at 101, and that's the sign of a very successful common stock offering.
I always think back to the Micron call, I think, where Morotra said that the amount of memory that goes into a humanoid is 10x that of an autonomous vehicle.
Yeah, that's why it's the future. And I think that, by the way, I was talking who are concerned about national security. Musk is the only guy that can hold a candle to China when it comes to the robots.
Yes. They're far ahead of us in robots in China, particularly in their use in manufacturing. I can get you the exact numbers, and I will if you'd like, but I mean, they are stunning.
They're depressing.
Well, yeah. You know, we have to be aware of the competitive challenge China represents, whether it comes to batteries, or solar panels, or robots, or drones, electric vehicles, and now pharmaceuticals, too. Also AI, but pharmaceuticals. I mean, what they've done there, and the people who've come back from this country and who have returned to China, their efforts there, the numbers are pretty staggering.
Well,
they're starting to see them develop.
Well, they have a less strict equivalent of the FDA.
They do, but they have changed things so that at least has a global. They have sort of considered at least a regulator that other markets will accept.
When you have 3 hospitals that have 500,000 people each, you can really get a lot of tests done. We have to try to recruit people.
They are a significant competitor. And back to robots, without a doubt.
Well, look, Carl, we have to stay in touch with it, if only just because the national security issues over and over again. I mean, how many times do you have to read that they will take Taiwan, they need Taiwan semi, or they're going to get ASMLF, or they can be able to make ASMLF. So to not include them in the conversation is always to be naive about where we are versus where they are.
We keep seeing SMCI at the top of the leaderboard this morning, Jim, although I know you're a Dell guy, and you sort of made this point this morning.
Well, look, I mean, SMCI is a coiled spring because they had so many problems. But I remain a Dell guy, and I think that it is just indicative, though. They're an NVIDIA house. I mean, once again, you go over and over again, NVIDIA, and you say, and including obviously the $500 billion plan, now it's going to be much more than that, but I don't think, I look at NVIDIA and I am mystified by why it sells such a low multiple, because the things that have happened are so multiple enhancing in the last few weeks, and it just doesn't seem to matter. It's still 24 times earnings. I think it's going to turn out to be much lower PE, but maybe this is what causes it to break out.
Well, we got the earnings coming up on the 26th, I believe, right? That'll be always a late catalyst in earnings season.
Right, and this is probably going to be the least heralded. I don't think people are expecting anything, because remember we used to have NVIDIA parties?
No.
Top right is a daily chart.
I was never invited.
Bottom right is a weekly chart.
I was not invited. Did you have an NVIDIA party that you didn't invite me to?
Who would invite you to an NVIDIA party?
Skunk.
Yeah, I mean, you're probably the anti-NVIDIA party.
Who would invite me to any party for that?
Why don't you short the securities that Jensen's offering, okay? As part of your IRA. You short them.
The Faber long short fund?
Yes. Yeah, why don't you do that? I'll bury you. I'm going to send you.
Bury you?
I am going to send you an invitation to your funeral, partner.
No kidding.
Yeah. No, not kidding.
Okay.
And since you got
Whatever you say. I don't know how to
gotta
respond
take
to
him
that
to the vet
attack,
today, too.
that full frontal attack.
Pretty heavy, wasn't it?
That was heavy. That was accusing. What did you accuse me of? Being a short seller? I'm going to be a short seller now?
No. Was that Edward G. Robinson that you were just doing from Soylent Green? It was. You were doing the Soylent Green or were you doing Ten Commandments? It's good.
It's people. Guys, speaking of movies, perfect transition.
Oh my,
well done.
Here we go, and the stock's going up. And this is when I was fishing. All people want to know, what's he thinking? What's favorite
I don't know if those
thinking?
were Warner Brothers movies, any of them. There is some momentum now in shares of Warner Brothers as at least the hope that some sort of a settlement will take place between the state AGs led by Bonta in California.
Jesse Swanson! What's up, buddy? How you doing, man?
Figure things out. That is not
Jesse,
happened.
I'm back now, bro.
And I'm not hearing that it is
done
any
with my
plan
little-
for that to happen. It could happen fast, of course. But what you're
what do you
seeing
call
here
that?
is at least a response by investors to what does
Voyage,
appear to be some
expedition,
pressure/momentum on the side
voyage,
that
what do
says
you call that?
figure it out, because
The
you've got the
Vikings
current
used to
governor of
go out.
California and you've got the Democratic nominee, I believe, is he the nominee, Becerra, for governor as well, both saying
done voyaging.
figure this out. You've got Macon Del Rahim, the company's general counsel, in a public forum
get back to this
yesterday
market
talking
money,
openly
buddy.
about moving to
So we'll be
another state for
up here more
Paramount if
consistent,
things don't
Jesse.
go their way.
Yeah.
And so, will that be enough to pressure the AG of
Thank you for
California?
stopping
And then
by.
there's
Appreciate
some of the other states that are a part of this. How strong is their desire to
Get my
actually
charts
go
together now.
to trial? By the way, a
See what
trial
we're
for which
looking
is not till March. And so you're talking about many, many months between now and then, which is one reason why I talked about this last week, why there really is a significant need on the part of the Paramount side to try and figure something out. But Bonta's still talking. At the same conference Macon was at yesterday, Bonta was, I think, there as well, talking about structural remedies. And that may just, that's hard for Paramount to imagine, but what would it be? And how would you go about doing it continues to be a question, but we are at least seeing some belief, Jim, that there's pressure being brought to bear to at least get both sides in a room to try to figure this out. And then where do you end up? Certainly there is a plan on Paramount. I don't know exactly what it is to offer something.
Right.
But the question has been whether the AG, feeling very good and strong right now, given, the fact that he's being taken so seriously with this case, would even be willing to do that.
But doesn't Paramount have something in mind that could even please an AG who smells blood?
You would imagine that, not to mention the real threat, perhaps, that they will take some of their jobs and leave the state of California. Oracle has moved to Tennessee, and so there is a belief that perhaps that would be a home for a new Paramount. They're not taking the lot, obviously.
That's what you want.
That studio lot is
But you can't take the jobs associated with HQ and things of that nature.
There is a lot of skepticism about this promise to have a certain number of films.
There is.
There's been some work done. In the 5 years before it was acquired by Disney, Fox released
Just got off a
75
plane,
movies.
Jesse,
In the
literally
5 years
20
after,
minutes.
Yeah.
21 movies. 72% decline in production.
Now, Paramount would say we are contractually obligated already to the big theater owners that we will release 30 movies. And they have had two of the big three theater chains, obviously led by AMC and Animarian, say they're in support of it. They've got one more to get, and then they're going to start working on, and I'm sure they are already, the independents. It could put them in a very strong position in terms of making their case, Carl, when the time comes. But of course, that's still so many months from now. We've talked about not just the actual cost, but the other costs that would be associated with simply taking so long to try to put these companies together to try and start it, the synergies that are so important to get the debt load down and make it all work.
Yeah. Meantime, North American box office for the quarter is running 31% above last year. In the first 9 days of August, we've already matched almost all of last August, 95%.
How much of that is the Odyssey? A lot? Or?
Yeah, of course.
Yeah.
And Spider-Man.
And Spider-Man as well.
Also
Oh, yeah?
blockbusters. Absolutely.
Blockbusters,
But that
yeah.
doesn't mean if it's a movie count, they're not a lot of movies. But look, I think that going out, I mean, I look at Brinker today. I mean, people are going out, and they're going out even more aggressively than they did in the last 4 years, and yet gasoline is really high. The Springer's up another 7. I mean, it is hard to figure out the American psyche. We know that they're spending at Best Buy. We know that they're redoing, they're starting to get some remodeling, according to Ferguson, which is pretty darn big. They obviously are going out for tickets, which are very, very expensive, and they're dining out, and they're supposed to be hurting. And it's not behavior that indicates that the consumer is hurting at all.
Well, you mentioned the Chili's comps.
I love it.
5%, but I think on a 5-year stack, Jim, it's some
rest of the market
ridiculous
is red.
number on Chili's.
Everybody's red, but
This
in
is Kevin
video.
Hoffman.
Wow,
I
look
love
at that
having-
stock.
What?
Everybody's red.
Well,
Except
Look at that stair step.
3 for me,
Man.
David. This is you know.
Baker.
Okay,
Up
he's
326%
so
in
he
5
has
years.
never been to a
I've been to a Chili's.
You have not been to a
I
Chili's.
have been to a
Then
Chili's.
you would know why that stock is still.
It was many years ago,
Fix my
and I was
trading
hungry.
charts as well.
Well, there you go. Well, you have to starve to go to a Chili's?
No, you don't have to start. It was good.
Okay,
It was
they
fine.
have a 3
yeah.
for me.
Enjoyed it.
They have
margaritas,
they-
right?
That's
They
all
got
I'm going
the-
to do today,
yeah,
Jesse. I'm going to get my
top
computer
flight.
together today.
I'm not getting top flight more tequila.
And I'll be ready to
But
rock
the
and
main
roll
thing is that he has
tomorrow,
kept, Kevin Hoffman has
inshallah.
kept the $10 meal that I go to with Lisa, and we marvel that we can get that margie with it, and it is so delicious. So I was wise to it, and don't forget, he does so much social. He's got great social.
Yeah, there's a 5-year chart. By the way, cumulative comp over 5 years for Chili's, 71%. 71%.
I'm taking you to both an Olive Garden and Chili's. I'm going to show you America.
I know America very well.
You know America?
I've been to. I'm not going to do
You know,
Johnny
top
Cash
down
here, but I've been to a lot of places.
How about him with the John Ring of what is it? Ring of Fire.
Yeah. Oh, what a great song.
Fantastic.
Girl
You ever
from
see when he did it with
But him and,
Bob-
him
when
and
he
Dylan
did-
on Girl from the North Country. Not the best song.
With Dylan.
Maybe the
I
best song
listened to
ever.
it this morning.
Maybe
I
the
listened
best
to this
song
very, very morning. That's really weird.
Maybe just one of the greatest songs of all time.
Watch bonds, that inline CPI number definitely giving us some relief on the rate front. Although mortgage apps actually a little bit of an increase this week, up 3.6. The 30-year fixed 6.77. Stay with us.
Chart I'm looking at right now. So far this week is a little bit indecisive. Good move right there. Strong move. Bull stepping back in. Well, damn. All right now. A little bit of sun, girl, you have going on. Man, your stomach looking better too. Look like the old you. I'm about to mute this microphone in a minute. There you go. Yeah, I'll be taking a little break sooner than later, guys. Alright, what was I just saying? I don't even remember around this chat. Okay. Doing my top-down analysis. Okay, now let's bring it on down. 30 minutes. See if I see any algos, where it's at. What's going on? Okay, here we go. See what I see. Thank you for your patience. See what I see. What do I see? What do I see? What do I see? Okay, let's see. Consolidation right here. Do a little box. You know what I need to get? I need to figure out what it is, that app that everybody uses when they can draw on their screens. I know, I forgot. Did you write it down? I heard it from somebody. I sure hope you wrote it down for me. Okay, good, because I need that. That's going to help me take my explaining to another level. Okay, control buying algo, control selling algo. This is ranging also. This is ranging. This looks like a good put opportunity right now.
Cisco reporting earnings after the bell, the #1 Dow stock of the year. Tomorrow morning, an exclusive with CEO Chuck Robbins at 9 a.m. Eastern time. As that battle for the #1 spot, they keep flipping between that and Cat. This morning at Cisco.
You know, it's like Cat was a big player in last night's core wave. But I got to tell you that I love when Chuck comes on because he comes on when it's bad too. Let's not forget that.
Yeah, always great color from Chuck.
Yeah.
Dow up 66. Stop trading with Jim is next.
Potential lower high as well. Don't want to wait till 10 o'clock. It's good now, be greater later. This is a box right here. Okay, change that color to white. Purple? Okay. Box. Big money. Will be below the 770.
Writing pad.
How do I get that? Where are they located at?
Right pad.
Right now. Text that out. That's what I'm looking at overall. As far as trend wise, might be a potential scalp in there right now. As I told you, I saw a potential scalp put, but I don't like it. We're to wait for the larger time frame, the 30-minute time frame, as we're trying to battle right now for control of the week. If you look at the weekly calendar, if you look at the weekly candle. The weekly candle right now on a Wednesday is showing you indecision.
Let's get to Jim and stop trading.
Okay, so
Nobody
listen,
really
Micron has
has
been kept
control
down because
right
Micron
now.
actually doesn't trade
So
with the
I'm
complex
not
zero
going
core. It
to
actually trades with
be
Korea.
aggressive
And Korea hasn't
and
been
take
up
the
because of the
puts
problems with Leopold. It looks like those have
right
been
now
digested,
because,
and it's time for Micron to fly, and that's exactly what's happening.
It's showing a state of
with
indecision
SK
when we
Hynix
go back
and
and
Samsung,
forth either
not
way.
with Intel, and not with CoreWeave. Certainly not with NVIDIA.
Yeah, Hanhai was another positive
Yeah.
story
Oh,
today.
this is it.
10 cent.
This is a really
Confirmation.
bad day for the Bears.
Continuation.
Kodiaks, Grizzlies, it really doesn't matter.
CPI.
Yeah, exactly. I just think
The buyback window's open again.
I know, and I feel bad for the Bears. I mean, they feel like teddy bears today, you know? Like, boo-boo. Hey, boo-boo.
Hey, boo-boo.
The best way
We
to
got a
stop
picnic
is never to
basket.
start.
You mentioned Leopold. We should explain. You're talking about Leopold Aschenbrenner, the
You don't need
24-year-old
to,
hedge fund.
you don't need
Yes,
to explain
you
it anymore.
do.
And
Yes,
Leopold's
you
like,
do.
sure.
People don't know who that is.
Not
By the way,
just
he's winding up
understand
giving
the
money
direction.
again. It's going to
Yeah.
go into privates
that
largely.
great?
But that's amazing.
P.T. Barnum got money
Yeah.
consistently.
Well, he already had. I mean, yeah. So
Are you comparing him to Barnum?
Leopold.
Well, I think when you lose that
not
much
just
money,
lives, he
I don't know who.
thrives.
But look, this business is a strange business. You always get more money. That's what the nature of the business.
There's a lot sloshing around, that's for sure.
Oh my God! Or else you wouldn't have these stocks. I think that they should just put it in SpaceX. But
Tonight?
Tonight I have Coherent, which is a version of Lumentum, and then I got Mike Dustar. You know, this Novo Nordisk is just not hanging in there, David. It's just being left behind.
Is it really? They were. It's funny. They were the leader for a while.
Michael Burry should be talking about them, man. It's B-U-R-Y, because I'm from Philly.
2 R's.
Rob Mack.
Jim, we'll see you tonight.
Yeah.
Mad Money, 6 p.m. Eastern Time. As we mentioned earlier, shares of Lumentum surging post-earnings, up more than 620% in the last year. Don't miss our exclusive with the CEO next hour, as Infotech doing a lot of work this morning, up a full percent. Stay with us.
Get my bracket orders ready. How about that, Dr. J? Everything's set in place. More important, the discipline is there. See what this 10 o'clock candle is looking like. We're getting some rejection right now, and that's exactly why I didn't chase it. But I did call out that scalp put. That's exactly what you got out of it. Nice little scalp put from the 773.6 all the way down to the 772.2. So it was a good dollar scalp move. We're not looking for that. We're looking for some real change. So again, I just want to hop on here, get my screens together, get my computer together, allow the market to play itself out. Look for trades right out of my playbook that's lining up with the larger time frame. Again, holding true to my discipline, waiting till 10 o'clock, even though I saw that move. My discipline tells me to wait until 10. That's exactly what I'm doing. I also personally like to put under the 769 area. Like, see if we can get below yesterday's low. If we can get below yesterday's low with a break and retest, that might be a great area for me to potentially take a put in. So with that being the case, I have an alarm set at 769, and that is the area that I will potentially look at. Here we come again with this beautiful put on the 10 o'clock hour. I'm not going to second guess myself. I'm going to be patient. I'm not here to trade every hand, only the hands that I see edge in. And as I look to the larger time frame, I'm looking at the 15-minute candle right now. And on the second candle in the 15-minute, we saw the bulls step back in at the 772. The bulls stepped back in, rejected those more prices, and keep those for the second candle for those.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl to the end. David Faber. We are live as always from Post 9 of the New York Stock Exchange.
With this tail at the bottom of this middle candle was letting me know that there is bullish strength. Don't let this candle fool you. The bulls are buying at 772. So this is not a safe put until those bulls get taken out at the 772. So being that I am not in and was not in, I will not get in or even, possibly even look at it until she breaks that 772. My ideal put entry is going to be below yesterday's low of 769. It's going to take some while to get there, but until then, we have a little chop. And whether you like it or not, right now, the bulls are in control. The bulls are in control of the overall market. So even this little flush after this morning gap up means nothing, because right now the bulls are definitely in control of the month. They haven't decided on the week yet, but the bulls still have overall control. So until that overall control flip-flops, we want to continue to be cautious and patient. This is starting to look like a flip-flop. Nope, I'm gonna be patient. I'm gonna be patient. All right, guys, I'll be back with you and check with you shortly. Thank you for tuning in. Same instrument, top right corner, daily chart. Bottom right corner is the weekly chart. Bottom middle is the 30-minute chart. Bottom left is the 15-minute chart. Okay, we're gonna rock with that. Okay, there we go. Top left, 2-minute Heikin-Ashi. Top middle, 5-minute candle. Top right, daily chart.
Let's just give you a sense of where the gains are. We've seen it in places
like Jesse said, not yet
motor
tradable.
oil, coolant,
Absolutely.
and fluids. Computers,
Looking at
why?
large time frame,
We know about
Jesse.
the memory price of chips, right?
Nice
The
scalp
shortage
available.
causing prices to rise. Airline
tradable.
fares, you feel this, you book this,
Looking for some
2.2%
reduction.
higher on the month. Fresh fruits was also kind of a hot spot among food for inflation, and public transportation. If you look into where some of the deflationary, impact was.
Lettuce.
You know why? Because we're not buying lettuce because of cyclospora. And so lettuce prices came down. They also say the 16% plunge since May 1st, 2026. CDC has received reports of 13,895 lab-confirmed cases of cyclospora acquired in the U.S. And that is, again, the lack of lettuce inflation there, lettuce deflation. Hotels down 3.3%, and so that actually took the overall shelter number down. That was good to see. Fuel, gas prices, fresh vegetables were also down 2.6%. And then the other one we just pulled out, guys, because besides lettuce as a kind of what's going on and what we talk about every single day is the computers, the computer parts and smart home. This is, a source of inflation here because of, again, the input prices that we've seen on memory chips and just the insatiable demand for building out AI. So we're seeing inflation in that sense. But overall, David, as expected and not a hot surprise, and therefore that's good news.
Right. So where are we on the chances that we get a rate hike?
I mean, it's under 50% on September.
55 by year end. I mean,
September.
The worrisome trend on this one was core goods. Month-on-month core goods is the biggest monthly jump since September. And so that's going to keep the Fed watching to see how things resolve.
I mean, they're still not at their 2% level. So that's, I'm just looking at the core goods prices here. Yeah, I mean, core goods gained 0.2% versus negative 0.1 prior because we know June was
it was down two straight months. Yeah.
But computer, software, and accessories goes in there. And that was actually a little softer than it was in the month before, which actually suggests the AI build-out pressure may be easing a little bit. It's still hot, but maybe easing a little bit. I think it's, as pretty much as expected. And then the other, just piece of good news that everybody's buzzing about on the economy lately, Bank of America does their spending numbers, and we've been hearing a lot about the K-shaped economy. And we first heard, I think last week, Treasury Secretary Bessent say the K-shape is over, and there actually is some proof of that in this card spending numbers on total card spending, where there was once a K. It's becoming one of convergence, they say, with spending growth converging across income groups. Basically, the lower income level is now spending more, and the upper income level is spending less. So you're starting to see kind of the K equalize a little bit, not necessarily, but I think they say, Bank of America, against this backdrop, financial health for consumers looks solid, despite the cost of living pressures from gas and everything we've been talking about.
Squawk yesterday saying there's probably no letter in the alphabet right now that kind of characterizes it well. Maybe she mentioned the bass clef in music, if you know.
Oh, God.
Good eye, Jesse. Good eye, team.
That takes me back to piano lessons as a child, which I hated.
Didn't chase that.
Let's talk some more about the market action with the Citi U.S. equity strategist, Scott Kroner. Man, so many moving pieces today, Scott. It's good to have you back.
Hey, Carl. Good to be here.
Just talking about that here on the 15-minute chart.
Let's do macro in a moment. This convergence of solid sort of tech results, is that reviving your view? I know we had a discussion a few weeks ago.
Which is underneath the candle body, the tail was showing us bullish strength. The bears are still heavy right now this morning, but once we got back down to that 70.72, the bull stepped back in, and the current 15-minute candle is also showing another tail right now, that is, indicating that the bulls are once again rejecting lower prices. We want to be careful, because if the bulls do show some strength, a lot of these early bears that are still in will have to cover to put some money in their pocket and to protect their position. So again, going to look a little bit more now towards 10:15 in these larger time frames in mind. Check back with you guys soon.
The NDX, at least for the moment, might be undervalued on a multiple basis. Does that make sense to you?
Well, it's undervalued if you think that there's going to be a lot of persistence in the commodity semi playbook out to the 28 and beyond time frame. Very clearly, I think what the market's doing here is pricing in 26 and 27 earnings growth and fundamentals for that part of the semiconductor and NASDAQ component. But then I think where the rub is okay, what do you do in terms of modeling out 28 to 30? I think there's a question mark here. Growth is expected to decelerate in 28 versus 27 over 26. And I think that's the linchpin here. So what ends up happening is that, you think these stocks look less expensive or inexpensive on forward PEs, but there is this issue of how you navigate decelerating growth.
Right. How should viewers think about, there is an argument that, for example, this CoreWeave and Nebius backlog for the moment is giving you better visibility into 28 and in some cases even 29. Is that clean? Is that a clean view?
I think it's it's increasingly clean. That's sort of been the storyline through the Q2 reporting period. We were looking for a bit of a mean reversion lower in semis. We got that, but what we needed was confidence in this hyperscaler CapEx spending component to demonstrate some ROI opportunity, and I think that's what's happening here. And so when you do that, you begin to rejuvenate the whole complex. And in the meantime, let's not forget software, which was sort of left for dead earlier in the year, is now your top performing industry group quarter to date. So again, the various components of the tech complex have come together here. But I would say when you look at the hyperscaler communication services component, it's still lagging the index quarter to date. So as you get renewed confidence in here, I do think you begin to set up for a different version of the broadening playbook where we've gotten the anti-AI trade working earlier in the quarter. Now I think you're set up for, again, a bit of a stability fashion here that I think supports the index.
Communication services and consumer discretionary, those are the two weak links, I guess, for the year. They're the only two sectors that are in the red. So does it make sense to you, or would you be a buyer on the weakness, on the broadening?
Well, where I want to be a buyer, Sarah, is on the communications, on the consumer discretionary part. I still think that what we're looking at here is a setup where, whether you look at, the aggregate consumer discretionary sector, the equal weighted component, or even the retail component, there's still a lot of nagging concern, whether it's regarding the oil price influence, read through to gasoline, et cetera, whether it's the inflation influence, the risk of a hawkish Fed reinvigorating here. But under the surface, when you look at what's happening here, whether it's K-shape or something different than that, I do think the underlying fundamental trends are pretty supportive of money flow back to this part of the market, which has been lagging. It's part of the broadening complex that I think can work from here into the end of the year.
Yeah, especially if the K is converging, as we've been saying. I mean, ultimately, isn't that good for
that'd be a sweet spot.
Consumer stocks?
Yeah, that'd be a sweet spot. And it's going to play through in different ways. I mean, obviously, within consumer discretion, you have to handicap Amazon and Tesla. But away from that, like I said, the market's been pretty reticent to come back to the traditional retailers, and I think honestly for good reason. But again, that's part of the broadening playbook that we think comes with, I think, an improving setup here, whereby the hawkish Fed dynamic that's priced into rates right now gradually comes out as we go into the fall months.
Scott, we'll try to tackle the war and energy in future appearances. It's much tougher read at the moment than the other stuff we've been talking about. Scott, as always, our thanks. Scott Cronin over at Citi.
Take care.
Take a look at our roadmap for the rest of the hour. When we come back, we'll talk about some major AI movers today, including Lumentum, up more than 600% in a year, adding to gains on these recent results. The company CEO is with us exclusively.
Plus, President Trump reportedly considering a new tax cut push ahead of the midterms. It could have a big impact on investors. We're going to explain.
And much more on the inflation picture and what it means for the Fed when we are joined by Goldman Sachs' chief U.S. economist, David Miracle. Squawk on the Street. We'll be right back after a quick break.
Let's get to some big moves in the AI space today, including Supermicro. Stocks higher after upbeat guidance. Company's earnings outlook now in the range of $1.01 to $1.10. That's well above the 76-cent estimate. Revenue guidance of $14.5 to $15.5 billion, also above projections of just under $11.7 billion. NeoCloud Nebius also jumping after a better than expected quarter on the top and the bottom line. Gross margin stronger than estimates. And then, of course, there's CoreWeave surging today. The revenue doubles on accelerating AI infrastructure demand. Michael Intrater joined us here at the desk last hour, detailed the outlook for margins and the value of these existing GPUs.
We brought on 500 megawatts of power, which is astronomical. Our installed base is now 1.5 gigawatts, right? We are a massive supplier of this. Enterprise companies are beginning to adopt our platform. Contract margins, the contribution margins, as you said, are rising. And one of the debates that has followed this industry has been on older generations of GPUs. And what we have, I hope, put to bed here is that those older generations of GPUs are going to have a longer useful life than anyone anticipated.
Backlog 104 billion is roughly 4x a year ago. And then, David, you tried to pin him down on some of the additional commitments they've gotten quarter to date.
Yeah, in the last 5 weeks, more than he said, $25 billion in commitments. Best we got from him is it looks more like it's similar to what they have already in place. The momentum obviously is there. He is talking about margins obviously inflecting in a significant way. We talked about that. The longer term, though, Carl, is still, of course, the larger question. Given the indebtedness of the company, somewhat $35 billion, have raised a lot of capital and debt over time. And when do you get to that nirvana of real free cash flow? But investors clearly see it coming at some point, given the way their business is inflecting.
Yeah, I think the stock right around 160 or so.
Yeah.
Of course, got down to the 60s in recent months. And then Jim tried to pin him down, too, on some of the cultural and societal friction on data center development, midterms less than 90 days away, all that stuff.
Also, we're flashing this thing about the older generation of GPUs and basically what that looks like. It was a funny line from a trading note of Bank of America today. Depreciation bears getting defenestrated as we speak. So that had been part of the bearish case as well.
Yeah, it's not insignificant, of course. Is that? I mean, you did the opposite on this yesterday, didn't you? About data center and all the things.
I did the economic boost,
yeah,
basically, because there was just so much negativity around. And look, I think there are valid concerns around water, right, and the environmental electricity costs and noise. But I showed that basically job growth comes with it, and housing units come with it, and housing values rise, at least according to some of the data that Wells Fargo put out there, and that we've gotten from some of these counties in Virginia where tax revenues are also skyrocketing, and that is able to lower their property taxes. So there are positives there too.
Let's stick with AI and the movers. Lumentum stock is up, cut it up about 5.3%. This follows an earnings beat from the company. It's a maker of photonic and optical technology that has become a key part of data centers. Of course, it's a way to enable the data to move even more quickly around the actual data center within the server. Shares, they're only up some 620+% for the year. Joining us now on the CNBC exclusive is the company's CEO, Michael Hurlston. Michael, good to have you.
David, good morning. Good to see you.
And you as well. You know, let's just start off. I mean, I think you raised Q1 revenue guidance to sort of that $1.25 billion midpoint. It's more than a quarter ahead of the target you laid out only not that long ago at your OC. So things are accelerating, and I'm just curious, I guess, is it more customers? Is it bigger orders? Is it the same number of customers and the hyperscalers you had before?
Look, you've been talking about it all morning. I think the demand signal that we're seeing is better than we expected. As you correctly said, we were talking about this just a few months ago at the Optical Fiber Conference where we had an analyst day, and here we are less than 6 months later, and the demand signal that we're seeing from the hyperscalers is just incredible. So we see really no end in sight to the demand.
I think you said on the call you're now much further behind on ultra-high power laser supply than you were 3 months ago. Maybe that's a high-class problem because of this demand, but I'm sort of curious, how do you view that? Are you leaving revenue on the table as a result of not simply being able to get these high-power lasers that you need?
Yeah, the high-powered lasers, you talked about it in the preamble. We are connecting data and making it move faster and faster. Everything, our company is based on optics. Optics is light. Nothing moves faster than light. So these data center customers we have are trying to move traffic using light as the optimum medium. And we have a partnership with NVIDIA that's well known. NVIDIA invested in the company. And they are looking to deploy more and more photonics because they're building ever faster compute. And in that context, the demand for all these high-powered lasers that drive and connect the traffic has gone up substantially over the last couple of quarters. We fabricate these, we have to manufacture them, so our lead time is relatively long. And so we're having trouble just keeping up with the demand that NVIDIA and other customers are currently putting on us.
Okay, so back to sort of demand as well. How much visibility do you have then? I mean, how long, in your opinion, Michael, does this continue?
Yeah, we have long-term agreements with a good number of our customers, and those long-term agreements now are spanning out to 2029. We're effectively sold out through that capture period. Based on the demand that our customers are putting on us, we don't see, one, any end in sight, and two, our ability to kind of catch up to this demand signal is severely constrained. Our lead times to build our manufacturing facilities are 2 and 3 years, and we have visibility out that far, David, that says, at the end of that, we're still behind.
So you don't buy into the obviously the overbuild concerns, and that's how you would answer some of those? If the hyperscalers are just spending too much and building too much?
Yeah, just, we have committed orders from them, and those committed orders, Sarah, go out, as I said, 3 years. They are essentially take or pay. So these guys are really putting teeth into what they put on us. And if they don't meet that bill, they have to take the goods anyway. So we really feel like this is a 5-year cycle. And again, given the commitments they've given us, we don't see that this is slowing down anytime soon.
The other topic of discussion I know investors are asking you around these reports that the FCC may make a move, new rules to limit the imports of these optical transceivers, especially getting at Chinese suppliers. How would that affect you specifically, considering Chinese suppliers are customers and your competitors in the industry?
Yeah, look, it's a great question. I think it's good for us, sort of in the near term and in the narrow narrative. What our concern is around this proposed rulemaking, again, everything is speculative at this point. We haven't seen any real rules come out of either the FCC or any other agency in the government. But I think they have to be thoughtful. If there's any disruption to the supply chain, it's going to be a problem, not just for us, but for anybody else that's supplying into it. We would be a beneficiary because obviously we manufacture these transceivers, which are an issue. But if we think about it in the macro, U.S. suppliers probably are about a third of the transceivers that go into these data centers, limiting 66% of the transceivers. I think if it's not done thoughtfully, would be a big problem.
Finally, Michael, given our conversation with you, we spoke with Michael Intrater in the last hour, obviously. Things look so incredibly strong in terms of at least the overall growth story for compute and everything that comes along with it. But I am curious, is there one thing, one...
All right, team, I went ahead and adjusted this control selling algo. We're now at the top of it, looking to see if we can break through that. I'm also waiting for another 5 minutes of that 1030 candle. We got a beautiful green hammer right now currently on the 30-minute, beautiful red hammer on the 15-minute. Looking for confirmation with price closing above the high of this hammer candle. And then that will be our confirmation, and then looking for a continuation that'll happen at 1030. Again, looking to the larger time frames. Also looking to see if we can break this control selling algo. And if that does happen, there will be a lot of bears who will then have to start covering their positions, who will then start looking for a push, possibly back up to the 774. 4 more minutes to wait. Again, looking at the larger time frame, and then looking at the lower time frame for a potential entry position. But the overall decision comes from the larger time frame. And right now we're still in a state of indecision. The weekly chart is still a doji. The bulls do have control. But this week, the bulls have control of the overall market, but there is a CPI report coming out too. Does anybody know what time that is coming out? Let me look and see. When is the CPI report coming out? What's today? Oh, it came out already. CPI came out at 8:30 this morning. Alrighty. We're still red for the day. Let's put an alarm above that 774.8. That's when we will go green for the day. Alarm at 774, another alarm at 769. I'm avoiding the chop in between. Coming back up to that 773 resistance area. Alright guys, it's time for me to go. I'll be with you guys in a moment. Y'all got alarms set. Being patient right now. See what happens on the top of this algo. And at this resistance at the 773. 2. We touched it. Came right down from it. Alhamdulillah. Being patient right now. Thank you guys for being patient as well.
Hey Rashid, you still in London, mate?
Let's see what we do.
Welcome back. President Trump reportedly considering a push for a capital gains tax cut in hopes of gaining a boost for the Republicans in the midterms. Megan Casella in Washington with the story. Couldn't be going in a bigger, different direction than the socialists here, Megan.
That's right, Sarah. So this comes according to current National Economic Council Director Kevin Hassett and former Director Larry Kudlow. They were discussing various ways of cutting capital gains taxes on Fox Business on Tuesday. Hassett said that President Trump is looking for promises to make to voters on what the administration will do if Republicans have power in the future. So he says, quote, "You could expect a lot more policy between now and the midterms." Kudlow then replied that he had spoken to the president, and he says the president likes the idea of indexing capital gains taxes to inflation and the idea of a bigger exemption. So I asked the White House about this, and a spokesman told me this morning that President Trump is always exploring new ideas to make America wealthy again, but that any policy announcements will come from the administration directly. Now, a couple of things to note on all of this. This is very preliminary, something that the president is considering asking Congress to do. The odds that Congress would tackle something like this ahead of the midterms are very slim. There has been some bipartisan support for pieces of it. There was a Senate bill introduced late last year that would index capital gains taxes, specifically on home sales, to inflation, but the calendar and momentum are just not on Congress's side. Lawmakers are here for about 3 weeks in September, but otherwise they're mostly campaigning in their districts between now and November. Now, some conservative senators and analysts have argued in the past that the Treasury Department possibly could take some action on this without Congress to index gains to inflation. That would be on shaky legal grounds, though, and it would very quickly end up in the courts. Guys?
Yeah, I was just thinking of all of the other promised or at least hoped for legislation, Clarity Act, SAVE Act, that wasn't able to get in before the recess. I mean, 90 days is not a lot of time, Megan.
it's not a lot of time, and it's especially not a lot of time to get things done where there's going to be a lot of debate. Yes, some Democrats, especially moderate Democrats, like this, but maybe not enough Democrats to get something over the finish line. There could be some Republican pushback. To the cost of this specifically, Yale Budget Lab had estimated that indexing capital gains to inflation would cost $1 trillion over 10 years. So not something that they can easily attach to something that does have to pass, like the NDAA or funding the government. Those things will have to get done between now and November, but you're likely not going to see a lot of things like this attached to them.
Megan, thanks. Megan Casella watching the possibility of further tax policy evolution. Dow's up 42. Let's get a news update with Pippa Stevens. Hey, Pippa.
Good morning, Carl. A federal judge in Boston expanded her order blocking the Postal Service from implementing parts of President Trump's executive order to overhaul mail-in voting policies ahead of the midterms. The provision called on states to provide lists of eligible voters to the USPS, and if they didn't comply, the agency would not deliver the ballots. The White House is appealing. Major U.S. freight railroads and industry groups just lost an appeal that challenged a new rule from the Federal Railroad Administration requiring trains to operate with at least 2 crew members. The rule came about after intense scrutiny of railroad safety following a 2023 derailment in East Palestine, Ohio, that resulted in cars spilling toxic chemicals that caught fire. And the Chicago White Sox held a Pope hat giveaway last night in recognition of Pope Leo's love for his hometown team. The team's marketing chief says they originally only ordered 2,500 hats, but tickets started selling so fast they bumped up the order to cover a sellout crowd of 40,000. The team says it's unclear whether the Pope knew about the event. Guys, back to you.
Pippa, thank you. Did want to bring some M&A news involving a well-known name, to say the least, courtesy of reporting originally from ESPN, although we do have a statement as well from the 2 people behind a deal to acquire the Los Angeles Lakers, of course, for $12 billion. Both Josh Kushner of the firm Thrive, right? Mm-hmm. Very successful venture capitalist. And Bob Iger, longtime CEO of Disney, former CEO of Disney, of course, in a statement saying and confirming that they have reached a deal to acquire the Lakers. The price, according to ESPN, we have not, I've put calls into Mr. Iger, have not had them returned, is $12 billion. Statement as follows. They say, as lifelong NBA fans, they're deeply honored for the opportunity to become stewards of the Los Angeles Lakers, iconic sports franchise. They also talk about having respect for the longtime owners, Jerry and Jeannie Buss, and their long-term commitment to building on the foundation, of course, and competing at a very high level. Now, interesting to note in the statement, they talk about the Buss family, but of course, people may recall that it's only a year or so ago, I think it closed last October, that Mark Walter, also the owner of the Los Angeles Dodgers, the Chelsea Football Club, purchased the Lakers for $10 billion. So you're talking about a franchise that will have changed hands in the space of a year at a 20% increase over the last price, which, by the way, was a record when it was sold. This is a new record. It would certainly seem, if the $12 billion is confirmed as well, for a sports franchise. And Sarah and Carl, it is also interesting to note that Mr. Walter was the subject of a recent story in the Wall Street Journal about a federal probe into his loans that he took to help finance the purchase of things such as the Lakers. The U.S. Attorney's Office in Manhattan, the SEC, were reported by the Journal to have been examining about $16 billion in loans extended to companies tied to Mark Walter or his conglomerate. Remember, he controls life insurance companies as well. And whether or not those loans, after having passed through a third entity, should have still been called related party transactions. And there was a probe into whether they were mischaracterized, and that should have been perhaps disclosed to insurance regulators. It's a rule meant to limit conflict of interest, as you might imagine. That gets taken care of. Those loans get paid back when you're getting paid $12 billion for a team you just bought for $10 billion. So kind of another part of this. Not clear that it has a lot to do with it or anything, but certainly did want to note it, given it is tied into it.
I mean, it's also interesting given Josh Kushner just in the last few weeks tried to make a bid to basically buy the World Cup, right? This private enterprise of FIFA, which failed spectacularly after there was a revolt. It was very controversial by most of the soccer federations, including the European League, that deal was supposed to happen with Gianni Infantino, which is the head of FIFA, and Kushner for that, I guess, 20% stake in a private enterprise that would be attached to
Sarah,
FIFA.
Obviously I know Iger quite well. He's certainly a wealthy man as a result of many years at Disney. You know Kushner, I believe,
He's
to
a
some
wealthy
extent.
man.
But neither one of them wealthy enough to put up $12 billion. And so I don't know if this is being done. Again, we don't have any details as to where the money is all coming from, how much is being financed, where other equity is coming from, Kushner's a venture capital investor, so that doesn't necessarily go along with, although you said he was interested in buying FIFA. I don't know, is that a possibility that it is also coming in part from his own fund?
I mean, look, I just looked, Forbes gives him a net worth of $5.2 billion. He's had a number of home runs, both in terms of fundraising and investments on some of the most successful startups, notably OpenAI has been a big bet for him. SpaceX was a big bet for him. Others include Instagram, Stripe,
no doubt,
Spotify. So he's been at the center of
but they're
very
combined
key.
net worths to the extent they are, and certainly you're not going to put your entire net worth into buying a basketball team.
Also, Iger is an investor, I believe, in Thrive.
Yes, he is. And he works with him as well.
And also when he, in between his last two Disney CEO stints, he was at Thrive.
Yeah, spent some time there as well.
Very close.
Certainly hope to get a little more information around the financing of the actual $12 billion, Carl, which is just a stunning number.
It is stunning. Thanks to Vital Knowledge, Bus buys the Lakers, the Forum, and the Kings in '79 for $67 million. But that only works out to about 11-12% annual
Is that
gain.
all?
Yeah. Would have been, like
not bad.
Stocks.
Not bad.
Still
I
feels
don't
like
know
a
what the
good
S&P is in
investment.
'79, but that's interesting.
Sports teams, where's the ceiling?
There doesn't appear to be one, even though they really, on a return on invested capital basis, they don't return a lot in any given year, or certainly many of them don't. But they do when it comes to asset value, that's for sure. They just keep going higher and higher.
$25 billion in assets under management, Thrive. That's what I was looking at. That's as of this year.
Yeah, I just wonder if he has the leeway to actually invest in sports franchises. Maybe he does. I don't know. It's not necessarily under the venture.
I think we should also note, not necessarily tied to the financing, but he's the brother of Josh Kushner, of course, advisor to the president, and son-in-law to the president, and son of the ambassador to France.
Right. When we come back, the AI boom came with promises of disinflationary effects. So far, they've yet to materialize at scale. We're going to look at how that costly build-out may be complicating the Fed's inflation fight. CEO of Honeywell Quantum spinoff Quantinuum, its first earnings report since going public in June. Stay with us.
Welcome back. Inflation was in line with expectations in the July CPI report as the Federal Reserve weighs its next move on interest rates. Let's bring in David Miracle, Chief U.S. Economist at Goldman Sachs. Welcome back. It's good to have you.
Thank you.
Anything surprise you about today's inflation data?
No, for the most part, I think in line with expectations. I think the big picture takeaway is this is the second consecutive month of better inflation news. We came in a few basis points above our expectation, but we actually think we're going to come in a few basis points lower than we had thought on core PCE inflation, the Fed's preferred measure at 23. That would include a large impact from the stock market. So we actually think the news is even better than that. This is what the Fed wanted to see. Of course, there's one more round in early September, the August data. But I would say so far, we think we're on track for the Fed to hold at the September meeting.
Nothing in here makes you think they need to hike?
No, I don't think so. I think generally over the course of the last several months, our take has been the reasons that we are above 3% are the combined effects of the war, tariffs, and some statistical mismeasurement that amplifies the impact of AI demand, and all of those things are fading so that we're on a better trajectory.
That's a very rosy view.
Although your view on the consumer has been pretty cautious, yes? And we did get average hourly earnings negative on this print, right?
So on the consumer, I would say the last few months have been surprisingly okay given the increase in gasoline prices. We think the explanation of that is that the gas price increases coincided with the tax refunds. At this point, the impact of the tax refunds on consumer cash flow should be over. So in the back half of the year, you're looking at mediocre real income growth, a saving rate that's already quite low, and we think that translates to below potential consumption growth. Call it something like 1.5%.
What do you think is supporting then retail spend on the consumer's behalf? Is it wealth effect? I mean, household debt went down in the quarter, did it not?
Yeah, so I would say a handful of things. One of those absolutely is a wealth effect. We think that's been worth maybe a few tenths boost to annualized consumption growth, led basically entirely by the stock market rather than housing prices. The other is the tax refunds. And then the third is, real income growth is mediocre, but not quite zero. We've also seen a pullback in the saving rate. That's a volatile number, but so far that's been also a contributor over the last few
months. But it hasn't been a credit story or a leverage story on the household front.
We've seen a small decline in the saving rate, but that's normal. Suddenly you get hit with higher gasoline expenses, you cushion the blow a little bit by saving a tad less.
Is the labor market weakening?
I would say there was a meaningful change in our perception of trend job growth after last month's number, because we got both a decline last month but also negative back revisions. It's hard to get too worked up about weaker jobs numbers when the unemployment rate is falling rather than rising. It's also hard
but it's falling because participation is also
That's
coming
right,
down.
and I think there is a bit of a puzzle on why the participation rate has fallen quite so much this year. It should be falling a little bit just because of population aging, but it's fallen more than a little bit, and I don't know that we have all the answers to why.
There's a great debate, speaking of wealth effects, on whether or not people are retiring earlier. I've seen some age-adjusted work that suggests maybe it's not that dramatic over time.
So I would say that's right. Just the pure population aging, you would think is worth maybe a couple tenths per year. And relative to January, we're down 7 tenths. So we're moving faster than that. So I wouldn't say that population aging explains all of it. It's possible that wealth effects make people willing to retire a little earlier, but the decline in participation is not just a story about older workers.
Right. Interesting week in that you have ADP down 7 straight weeks and a sub 10K print today on the week. And yet NFIB hiring plans were really strong. How do we square those?
So I like to look at a measure that we call our Slack tracker that brings together many different survey-based and hard data-based indicators of labor market strength. The message has generally been that things are a little bit worse than the unemployment rate alone implies. Most of the surveys have been more downbeat. Workers say it's hard to find a job. Employers say, for the most part, they're not struggling as much to find workers. I wouldn't say it's a hugely different message, but a little bit worse than the 4.1% unemployment rate suggests.
I mean, so add it all up in this economy, and You know, there's a lot of concern, for instance, on the political front about inflation, cutting into wages, making cost of living harder and affordability. How would you characterize where we are right now on that?
Yeah, I think that's right. The fact that inflation has stayed high for another year means that real income, inflation-adjusted income growth this year is going to be mediocre. Now, we think that things that have surprised to the upside on inflation, namely the effects of the war and the effects of AI demand amplified by statistical mismeasurement, are retreating at this point. So going forward, if wage growth stabilizes, as it appears to have been stabilizing in the mid-3s, and inflation comes down, as we expect, then real wage growth would look better next year than it looks at the moment.
And I was just going to say, how much is AI driving the economy at this point?
Yeah, I think less than is widely thought. I mean, it is, for one technology, this is an enormous contribution to the overall economy. So if you kind of look at it realistically, it's just that there are claims out there that this is the majority of U.S. GDP growth. And that's a bit exaggerated because a lot of the production of equipment used for that AI investment is actually done abroad.
Yeah, you did some work this week looking at it's crowding out some things, but maybe not crowding out as dramatically as some fear. Yes?
I think that's right. It just so happens that this big data center construction surge, for example, coincided with a kind of lukewarm at best housing market and a big decline in manufacturing facilities investment.
Again, team,
from a high point
I don't like any of this. Let's continue to be safe. A lot of chop. It is what it is. We now have those huge tails on the 15. We now have one on the 30-minute as well. So bulls are definitely rejecting the lower prices. Hit the bottom of the algo, as you can clearly see on the 2-minute, the 5-minute, any of these algos that you look at. Came right down to the bottom. Maybe one day we'll get to the point where we can start buying at the bottom. But for right now, we're just being safe, waiting for the obvious trade. Every day is not going to be a trading day. Still holding a put on QQQ from this morning. Indecision is killing my price. Looking for a gap fill. I hope you get it, Jesse. I hope you get it. I'm going to take a little break. Come back about 11:30. And I'll probably pull a QQQ up, Jesse, so we can see what's going on with that. Let me see if I'm going to pull it up for you on one of these charts. Which one am I going to put it up on? This is the week. I don't understand what we're doing for the week. I got the alarm set for the day. I'm going to pull it up right here, Jesse. Just for you, my buddy. Just for you, buddy. Jesse holding that QQQ. Teammate. What time frame do you look at, Jess? Do you look at 5 to 15? What do you look at on this QQQ? I just cut on the 15-minute right now. Yeah, if I go to the 15-minute, I can exactly see what you're saying, Jesse. As the bulls are buying up the 723 area on the QQQ, you can see, but every candle on the 15-minute has a tail at the bottom of it. So that bottom is letting me know that the bulls are rejecting these lower prices. Let's look at what happened with the QQQ this morning. Same thing as the SPY. Had that big gap up post and pre-market, okay? Put in a double top here at 727, all right? And then you said the 15, the 5, and the 1. All right, awesome. 15, 5, 4. It's coming your way now. It's definitely coming your way now. You can also look at this as now as a lower high. So you really should, be getting into something here, Jesse. What you want to see now is this close below this 724. You want to see a candle close below the 724 with a following continuation candle. That will be ideal for you, buddy. Let me go ahead and put that up here just to show you what it would look like. Okay, you want that right there. Glad you're already in that position. I was just getting off the plane. I probably would have taken an earlier position in the SPY as well. But nonetheless, I'm glad you were able to get it, buddy. And I'm hoping that it continues to go in your favor, your direction. It's looking very good right now. It's looking very good right now. Yes, sir. That's what you want to see right there, buddy. Yes, sir. Doing great. Doing great. Oh, okay, there we go. Let me highlight this a little less. Oh, the original one. Okay. All right, there we go. That's what you're looking for, Jesse. That's 724 at 11 o'clock. Continuation on the 15-minute on the QQQ, buddy. That'll really put you down into some good money. I would definitely hold it possibly to the 721. Look for a bounce possibly at the 721. Right here, Jesse. Look for a possible bounce right there. I'm going to go ahead and leave that up in the top right corner just for you, teammate. Just for you. On the 15-minute time frame. That's what you want to see there, buddy. Hoping it goes for you. I'm just going to continue to be patient. As I still see the Bulls are not giving up. The Bulls are not giving up. So I'm going to continue to be patient. Check back with you guys in a little bit.
Honest job sequentially. We spoke to Ronnie Chatterjee, he's the chief economist over at OpenAI now. He does argue that this is a short-term shock since demand right now is so drastically outpacing supply. He did say some of the immediate costs of AI are a lot easier to spot than potential benefits.
I do think that this is one thing we sometimes miss. We think about AI, we think about all the amazing things it can do. For it to impact the economy, it has to be adopted by organizations, and those organizations have to realize value. That's the process that we're in right now, and that's why focusing on enterprise AI is probably the most important thing we can do in terms of understanding AI's impact on the economy.
OpenAI with a new report out this morning addressing that, and then in part highlighting this disconnect between some of the biggest users of AI and then everyone else. So the power adopters use it about 8 times more than the median user. That gap is also widening. It was only about double that usage a few months ago. There are some questions over how much more productive AI will make us if it is widely adopted, and in the meantime, it is posing a dilemma for the Fed. Kevin Warsh has been a big believer in AI, but the Fed, of course, cannot set rates on potential gains that just haven't shown up yet. Worked on this story with Matt Peterson. You can read a lot more on CNBC.com, guys.
Love stuff from Matt. I think one of the more compelling early examples or case studies, Kate, might be Airbnb. The stock is broken out this year, and when they posted earnings the other day, they said probably the AI, the best thing that's ever happened to the company. We've reduced the time from concept to launch on key initiatives by as much as 60%. I mean, that's the kind of thing you'd want to hear from a lot of companies.
It's a great point. I think Airbnb is a good example, but Carl, I would probably put them in the power user category, where you have these companies that are able to harness AI. They're able to use it really well. I'm sure their employees out here are using it in a big way, but there's this disconnect where the rest of the economy isn't necessarily seeing the gains. I think where you really want to see it are places like healthcare and education, where inflation tends to be really sticky. If they can actually use software, use AI to bring that down. I also spoke to Peter Bookvar when I was reporting this out with Matt. One of the things he talked about was sort of this question of, looking back to the internet, which was probably the other moment you can think of as sort of this big productivity boost from technology. The gains were actually not that eye-popping. Over a 30-year period, it was less than 2%. So there is this open question of, yes, it could be adding to productivity, but is it a step function change? And I think that's still an open question here.
I brought this up a little bit with Kevin Warsh and Sintra in July about whether AI build out is inflationary or disinflationary or deflationary. And it sounded like he first of all characterizes himself as an AI optimist. And it sounded like in those comments and even in subsequent comments, he buys into the disinflation story and maybe is willing to not think about the inflationary impulse that we're seeing now in terms of the build out as inflation monetary policy can help fight because of the disinflationary promise on the other side. It's different than the war, for instance, and the energy. He made that comparison.
he's also surrounded himself with some serious techno optimists, including people like Mark Andreessen, who is now on this Fed task force to help talk about and translate some of the AI productivity gains. So no question that he is a believer, I think, at the potential. I wonder about some of the dissenters and people pushing back. Neil Kashkari, I know, had some commentary about this. And if it sets up a bit of more of a debate when it comes to inflation. But it's one of those tricky subjects. I think he's going to have to, he's a believer, but what do the numbers say and what can he do as a result?
I just think about, David, when we come into the work every morning and Jim shows off his Claude-generated
He's a
notes.
power user.
Yes.
Kramer
how he
is
processes
in that
information for 5,000 companies.
That's how you do it. I mean, there's no doubt it is becoming a more important part of some of our workflows.
All of ours, but
Yes.
but he's not firing his research assistants, so not disinflationary
Although would he have
yet.
fired more in absentia? It's hard to say.
I don't know, man. I just want to know when we're getting to that, somebody feeding us grapes or some robot, and we're just sitting back in the Roman baths the way
Paradise.
Massa described to me
Right.
7.5 years ago.
The age of abundance.
There it is, yes.
Kate, thank you. A really provocative piece. Everybody should go online and read it. That's our Kate Rooney. When we come back, former Treasury Secretary Liu is with us in a few moments. We'll talk about some of this stuff, this morning's CPI print, the Fed's inflation fright, in a few minutes.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla live from Post 9 at the New York Stock Exchange. Today, inflation cooling last month despite higher oil and gas prices, continued cost pressures, and ongoing geopolitical risk. We'll discuss what it all means for the economy, the Fed's path forward with the former Treasury Secretary, Jack Lew.
The quantum computing trade shares a Quantinuum surging following its first earnings release since the IPO. Revenue nearly quadrupling with a new deal with Oracle. We'll break it all down with the CEO this hour.
And Meta back in federal court today, challenged by a coalition of state attorneys general. And the biggest test yet, over claims the social media platforms are addictive to children. We'll be all over it.
Also, check out shares of Wendy's today. Busy morning for restaurant stocks. This one jumping on a report out of the FT that Nelson Peltz at Trian is preparing a take private for the chain. Trian is already Wendy's largest shareholder with 16%. Wendy's telling the FT it would, quote, thoroughly review any proposal submitted by Trian consistent with its fiduciary duties. Follows an FT report from May saying Peltz was in talks to raise some funding for a bid. Stock was halted but has since reopened, as you can see, up gaining about 12%. Let's begin with two tech earnings movers this morning. There's CoreWeave and Supermicro. Our Christina Partzinevelos with more on probably the two biggest stories of the day.
Yeah, there's actually a few more. There's a wave of earnings driving the chip trade higher this morning. Foxconn overnight in Asia, plus Lumentum, and then you mentioned CoreWeave. There was Nebius this morning and Supermicro, and they all delivered. And it really just lands after a brutal July sell-off. The message was pretty consistent across all of those earnings. You can see them all in the green right now. The world remains short on compute. GPU pricing keeps rising, and order visibility now stretches into 2027 and even 2028. Let's start with CoreWeave, though, because shares are popping 17, almost 18% after its best quarter as a public company. It raised its guidance on revenue, it increased its active power, as well as CapEx. Backlog sits around $104 billion, which is up sequentially. That doesn't even count more than $25 billion in new deals signed in July. What moved the stock is better operating margins as well as guidance. GPU rental prices keep climbing, even a 6-year-old chip like the A100, and then roughly 25% they saw price hikes in July, which points to wider margins into year end. Nebius, similar. NeoCloud told a similar story, beating on profit, and that strength really ripples out to power cooling like Vistra and Vertiv. The one check specifically for CoreWeave and Nebius is debt. CoreWeave is funding the entire build-out with borrowed money, and ballooning interest bills is keeping it in a net loss, even as its operating margins did improve to 5%. Then you have Supermicro. Margins came in more than double than the guide, driving a big earnings beat, though revenue landed near the low end. The standout was $60 billion of orders in a single quarter and record backlog. Again, this is an AI server assembler, and they had enterprises upgrading to newer systems, which obviously is strong for demand. One overhang remains the open investigation into its China GPU server shipments. There's been some drama there. But overall, just after a tough July, this earnings stretch gave the AI trade its best argument in weeks. The demand is real. It's still growing, especially with these long-term contracts, and so is the bill for building it. Carl?
Yep. All right, Christina, thank you. Never boring in these semi stocks. Let's get more on the market, the tech trade, and how investors should be thinking about this morning's CPI report. Joining us here at Post 9 is Neuberger Berman Private Wealth Managing Director Holly Newman-Croft. Welcome back, Holly. It's good to have you. The big number was inflation today, in line, still higher than the Fed and most people would like to see. What is your sense on how that's going to ultimately impact equity market and where we go from here?
Yeah, the CPI number came in this morning as expected, met expectations. I think we're off a second quarter earnings that is exceptionally strong on the heels of the Q1 earnings. So Q1, Q2 earnings both up more than 25%, which suggests that the market strength is real and fundamental and not just a story of multiple expansion. We expect to see that continue. But there are a lot of concerns as well as the seasonality effects. So August is historically a very volatile month in the market. September is historically the weakest month in the market. So we're halfway through August. We can expect more volatility. Inflation stays higher than the Fed target of 2%. We have ongoing conflict in the Middle East, which contributes to the price of oil, which directly impacts inflation. We have the midterm election coming up. We had a weaker jobs number. So we think that there is still room for these equity markets to grow. We are expecting increased volatility and keeping our eyes on some areas of concern.
Are you changing allocations at all or recommendations for investors?
No, our outlook remains the same as the last time I saw you. We continue to be overweight small cap. We continue to be overweight. Yeah, continue to be overweight emerging market equities. You'll remember at the end of the second quarter, we went back to neutral on international developed, specifically Europe, because of their heavy reliance on oil. But I think we really need to focus on the price of oil because that impacts the election. The focus on the election is going to be affordability. Lower income households are tired of paying more at the pump, more at the grocery store. And the president wants to have a successful midterm election. So he's focused on no more military action in the Middle East, trying to impose economic sanctions. There's just a lot happening, and it can almost all filter back to the price of oil.
Yeah. I mean, you talk about volatility. The VIX is below 15 this morning, and there's all this, like, bull recipe of leverage reset, passive buying's intact, the buyback window's open, right?
Yeah. I mean, we could see more volatility at the end of August, but what we're seeing is volatility, and yet every 2 weeks the market hits a new high. Hit a high on August 7th. We will probably see it hit a high again. But as we enter the fall, as we get closer to the elections, and active managers are going to do some window dressing and lock in some returns as we near year end. So we do expect volatility, but it all gets back really to your asset allocation, and your portfolio needs to be able to weather the volatility. And when you look at the market, we think that there is still room to grow. The numbers do not suggest, we're not seeing any signs of an impending recession, downturn, anything like that. So we remain cautiously optimistic and believe that investors should stay the course and stay invested. And when the market goes down, I mean, it's going right back up. So our expectation is that that will continue.
What about, I mean, we just heard from Christina, just a normal day in semi-land where we see 20% moves higher or lower off earnings. When your clients say, okay, how exposed do you need to be to the AI build-out trade? Because, I mean, there's probably a lot of FOMO out there.
There's definitely FOMO. And look, by virtue of passive investing, you have heavy reliance on that trade and the Mag 7, the top 10, whatever. But we are still continuing to see the broadening out, which we really like. 11 of 12 sectors reported positive earnings growth last quarter. The only down sector year over year actually was healthcare. And I think 8 of those 10 sectors had double-digit earnings growth. So by virtue of being invested in the index, you have an overexposure to those companies that are really driving the returns. But the concentration risk does remain. Those companies that went up the most when we have a downturn or a reversal, they will go down the most. So you've got to keep an eye on your overall asset allocation and make sure that you're protected on the downside with a healthy exposure to fixed income, which is still attractive, especially for taxable investors, with commodities, which is a hedge against both inflation and geopolitical risk, both of which are very present in today's market.
I'm looking at gold today, almost to 4,500.
Yeah, don't go buy jewelry. It's too expensive today.
Except for diamonds. Diamonds are plummeting, but gold's up.
Well, if your wife is listening, Carl, she's going to like that statement.
Yeah, nice of you. No, what's the most common question you're getting from your investors these days?
Can the market continue to go up?
And you say yes.
I say yes. The second question is, why shouldn't I just own the Mag 7 or the top 10? And I show them the chart on a down day of what can happen. It's too risky to be so concentrated. As I said before, this is irreplaceable wealth largely for my clients. So my job is downside protection and responsible growth of their portfolios.
All right. Well, thank you for coming on as always and sharing some of the advice with the viewers. Holly Newman-Croft from Neuberger Berman.
Thank you.
Thank you.
Coming up this morning, the CEO of Quantinuum joins us on their first earnings since the June IPO. We'll talk about this new deal with Oracle today.
Plus, more on that blockbuster sale of the LA Lakers to an ownership group, including Bob Iger. David Faber comes back with his latest reporting on that when we come right back.
Welcome back. Take a look at shares of Quantinuum climbing this morning on the back of the company's first public results, beating on the top line and announcing this new multi-year partnership to integrate quantum computing hardware into one of Oracle's U.S. data centers. Joining us this morning in a first on CNBC interview is Quantinuum CEO Raj Hazra. Raj, welcome. It's good to have you. Congratulations on the first print and this appearance here. I want to talk about the quarter, but everybody wants to know about the Oracle deal, what they're getting, what it means for you. Can you describe it?
Sure. Thank you for having me here. It's wonderful to be able to speak to you as a public company. Now, the Oracle deal that you talked about is essentially part of what we've described as the trends in quantum computing. Quantum computing is not going to be used in isolation. All the great use cases that we see across industries, drug discovery, pharma, chemicals, chemistry, optimization, is only going to happen when you put quantum computing and high-performance computing and AI together. The Oracle deal represents a wonderful opportunity, industry first, to do that. What we do is we put the world's most accurate quantum computer called Helios into an Oracle data center, but it's not just the physical integration, it's the integration at the software levels as well, which makes that quantum computer a first-class citizen of data services, compute, network, storage, identity, security, and gives developers and customers the ability to use the quantum computer much more easily and extensively than they would have otherwise been able to do. It's kind of the way we stoke usage, demand, and adoption of quantum computing, partnering with one of the leaders in AI.
Yeah, no, we've been talking about it sort of in theory for so long. It's interesting to see the rubber start to hit the road. How quickly can you follow on with other deals of similar size?
Well, this we see as the tip of the iceberg and the tip of the flywheel going, particularly as we build out our roadmap to Sol and Apollo. I mean, these machines are each up to 1 trillion times more capable. The capability of the quantum computer goes up, and integrations like this into cloud service providers gives us the ability to then reach that customer base, reach and deliver on these hybrid workflows in a much more, what I would say, accelerated fashion and a much deeper fashion. So watch this space, more to come.
Well, can you just give us some examples about some of the use cases that companies will be able to use with your new Sol computer, for instance?
Absolutely. Let's just take one, which is in pharma. In pharma, it is a complex process to discover new molecules, understand their behavior, test them. And today, AI is being used to intelligently look through multiple choices and get to the optimal choices faster and spending less money. Quantum computing is an essential way to actually make that discovery process go faster and be more accurate. So how do you understand which molecules to proceed with down into the wet lab and actually eventually into testing? Quantum simulations along with AI allow you to do that much more efficiently and, most importantly, more accurately than just classical computing alone. And that's one of the many use cases where quantum simulation training AI gives rise to value creation that you couldn't do with either of them.
No, a game changer potentially, I guess, for drug discovery.
Absolutely.
What about other industries?
The other industries not just focusing on chemistry, but look at optimization, for instance. The tremendous parallel computational power of quantum computing, along with the very, very low energy usage, makes it an amazing tool to be used for very complex optimization problems, where today classical techniques have to look through a lot of data. And quantum can be used to restructure that data and make that search for patterns, whether it's a fraud detection or a portfolio optimization or a supply chain problem, much more efficient and eventually even more accurate.
Would you argue, Raj, that you're in the middle of an investment cycle? And if so, when does revenue and margin start to ramp?
Yeah, we're investing to build what we call the world's most powerful, fully fault-tolerant quantum computers. We're investing in building the hardware. We're investing in building the supply chain. We're investing in building the ecosystem, the developer ecosystem that will take charge or create value from this. And we are investing in building these applications that I was describing. It is an investment cycle. But the reason we're doing that is because we see the tremendous potential through the work we're doing with customers. This isn't about a consultant's report or just a view of the industry. We see this on a daily basis as we work with companies who are looking to use this to accelerate their discovery journey and their businesses. So it's very real for us.
And just on the Oracle deal again, just thinking about how these hyperscalers are building data centers and then incorporating quantum. Are others doing this? Is Amazon doing this?
Yeah, there's examples of Amazon and other companies who will offer what's called a quantum backend, and that exists, and we participated in one of those in the past. The unique thing about the Oracle deal is the code design and the code development of that data center to actually not just use the quantum computer, but actually integrate the quantum computer into the workflow in a seamless manner. Look, customers they like the computational power of diverse computational things. They hate managing that complexity, and that's what this deep integration allows. Just like you had CPUs, then you got GPUs, but all in one kind of environment. Now you get CPUs, GPUs, and QPUs in that environment using tools that you're familiar with, and that just keeps that software flywheel going faster.
Well, while we're on the parallels to AI, just a clarification. You've been talking about Helios, and now you're moving to Sol, and then I guess Apollo is the platform. Is it like, how should we think about it? Is it like the new models? Every time they come up with an update, it's just faster, better technology, which becomes the standard?
Absolutely. Each of these machines represent fundamental increases in computational power, and they unlock different, use cases at different scales. So this is like, taking, for instance, on Helios, if we were doing molecular characterization, this takes Sol, and then Apollo takes you to much more complex molecules, faster families of molecules. So these are game-changing in each of the generations, not just evolutionary.
Raj, fascinating. Stock's obviously responding to what may be a new chapter here. Please come back.
I will be back, and thank you again for having me here today.
Raj Hazra over at Quintinuum.
All right, still ahead, much more on this morning's inflation data. Former Treasury Secretary Jack Lew joins us, plus his take on the recent Japanese yen intervention.
Jury selection begins today in a California case against Meta, alleging harm to children. We'll bring you details when we come right back.
Welcome back. Jury selection beginning today in a California case against Meta, alleging harm to children. Julia Borston joins us with more. Julia.
Sarah, this federal trial beginning in Oakland with opening statements next Tuesday is the biggest test yet of youth safety allegations against Meta. California, Colorado, Kentucky, and New Jersey allege that Meta designed its platforms to addict users and misled them about their safety. The trial is also addressing claims by 29 states that Meta violated the Children's Online Privacy Protection Act by collecting and using children's data. Meta said in a filing that the damages could be as high as $1.4 trillion, which is close to its market cap. And just as potentially damaging, the states are asking for big changes to Meta's algorithm, including eliminating features such as infinite scroll and notifications, asking the court to make Meta prioritize content focused on well-being instead of engagement, to implement age restrictions and time limits for young users. Meta saying, quote, we strongly disagree with these allegations and are confident the evidence will show our longstanding commitment to supporting young people. We've listened to parents, worked with experts in law enforcement, and conducted in-depth research to understand the issues that matter most. Going on to say we're proud of the progress we've made and we're always working to do better. Now, Meta CEO Mark Zuckerberg and Instagram head Adam Mosseri are both expected to testify in this trial that could last about 7 weeks. It's presided over by the same judge who ruled in favor of OpenAI and Sam Altman in Elon Musk's lawsuit against that company. Carl?
Yeah, shares still deeply in the red year on year, down about 30%. Julia, thanks. Let's get a news update this morning with Pippa Stevens. Hey, Pippa.
Hey, Carl. The Trump administration is reportedly spending at least $900 million on construction projects on the White House grounds, which would be primarily covered by taxpayers. That's according to the Washington Post, citing records. The Post reports instead of getting the money directly from Congress, the administration is collecting funds from other federal agencies and private donors and putting in an account that's traditionally used for routine maintenance of the grounds. Last week, a federal appeals court ordered construction to be halted on the East Wing ballroom, saying only Congress could approve it. Darlene Graham, the sister of late Senator Lindsey Graham, who was appointed to serve out his term, advanced to a runoff last night in the South Carolina Senate primary. She will face Congressman Ralph Norman on August 25th. And Google announced its Gemini AI app is surging, topping 1 billion monthly active users and keeping pace with ChatGPT, which hit 1 billion users in June. Google says the milestone makes it the fastest growing product in Google history. Sarah, back to you.
Okay, thank you. Pippa Stevens. Still ahead, former Treasury Secretary Jack Lew joins us. His take on the morning's inflation data, his reaction to the historic yen intervention, and much more.
Google launching some new Pixel phones today, although they're going to be a little more expensive. We'll talk about how that ramps up the competition with Apple over AI integration in consumer devices, and we're back in a minute.
Breaking news here on Truth Social. Megan Casella with the details. Megan.
Sarah, the president, some of his top aides, and the White House are now being sued over the decision to sell Truth Social's API to Wall Street firms to allow Wall Street firms to get some information on Truth Social fractionally faster than the general public. So this is a new lawsuit filed by the Intercept Media, the Freedom of the Press Foundation, filed in the Southern District of New York today. And they argue that this scheme, they say, is extraordinary, corrupt, and unconstitutional. They say it's profoundly corrupt because the president, who is the majority shareholder in Truth Social, says that he gains financially by giving market-moving government information to those who are willing and able to pay his personal company. They also argue that it's unconstitutional under both the First Amendment and the Fifth Amendment, and they are asking the judge to stop this sale. They say that the fact that public companies could gain this market-moving information fractionally faster, that's not fair under the Constitution. Now, Truth API has been asked about this. They were saying on earnings calls as recently as last week that they do so far have 10 paying customers. They've called criticism of this misinformed and said that the sale of commercial APIs is a well-established business practice, so they have the room to do this, guys. We'll see how the judge responds. For now, though, the White House getting sued over it.
Yeah, shares have had a rough couple of days on the losses related to some of the losses on those digital assets. Megan, thank you, Megan Casella. Meantime, the LA Lakers getting sold to a group led by Josh Kushner and Bob Iger. Our David Faber brought us that a few moments ago. Has done a little more work on it.
Yeah, I want to provide a little more clarity around it as well, given our last conversation. It is valuing the LA Lakers franchise, of course, at some $12.5 billion. That is according to a source reporting from CNBC. $12.5 billion, of course, is $2.5 billion above where the control stake in the Lakers traded only about a year ago, when Mark Walter, also the owner of the Los Angeles Dodgers baseball team, the Chelsea football team as well, took control of the Lakers. In the latest change in control, it is Josh Kushner and Bob Iger who will now, and through Kushner's Thrive as well, will now be the control stake holders. But the Buss family will continue, according to our reporting, own its 49%. They held it when Mr. Walter briefly had that control stake, and they will continue to hold that 49%. Obviously, they are beneficiaries of what is now a valuation some 20+% higher in less than a year for that same franchise. So, you know, we were talking earlier, Sarah, about, well, how do you finance this exactly? And we are talking now probably about $6+ billion, not an insignificant sum, that conceivably is being in part provided by funds from overseen by Mr. Kushner, and still sort of trying to understand exactly where else money may be coming from for that. In addition, obviously, to what would be a contribution, I would assume personally, from both Kushner and Iger. Iger, obviously, a great face of ownership for the franchise, one would imagine, given his long history in Los Angeles, and obviously an incredibly articulate spokesman for Disney for so long as its longtime leader, not to mention, of course, a huge basketball fan, although I thought he was a Knicks fan. I certainly think he was for many years. I remember talking to him about it. He has not returned my calls to try to get a little more clarity around this. And then a very interesting connection certainly is this probe into Mark Walter that is ongoing and has been reported by the Wall Street Journal, amongst others, involving related party transactions, or what would appear to have been a failure to report what was a related party transaction, namely in loans from Walter-controlled insurance companies to help support his purchase of the control stake in the Lakers and the Dodgers. Now, a great deal of opacity here around exactly how those were financed, what any loans may have actually been financing, his equity stake or not. But certainly this transaction, it's hard to imagine, given the timing, is not in some way related to that. As he puts a statement out and simply says that owning the Lakers was one of the great honors of his life, an extraordinary investment, true, given the return in a very short amount of time. And he says he'll carry with him the community, the fans, and as well says he's grateful to Jeannie Buss and the Buss family. Again, they will continue to own 49% of the Lakers.
He also owns part of the Cadillac F1 team. I mean, they have so many teams through this TWG Global, Walter.
Yes, he does.
Yeah.
Yes, he does. And again, we've referenced this I don't have reporting of my own on. I'm relying on others, obviously, but
Interesting
continue
timing.
to look at whether there was a failure to report related party transactions to the insurance regulators. But conceivably, those loans or whatever they might have been will now be made either taken off the books or, I don't know, or perhaps transferred to the new ownership group. But regardless, they will not be related party any longer.
Yeah, Thrive Eternal that's the permanent capital fund, basically, from Kushner under Thrive that also invest in the San Francisco Giants. So this is, the next move, I guess, for both of them. I'm told Bob will have more of a hands-on role here in the Lakers.
One would imagine that would be the case. Again, with Iger, certainly his management experience, not to mention, of course,
he's probably looking for something to do,
great face
right?
for the franchise. Yeah, I think he's been pretty busy, but it's not bad. And a huge basketball fan, as I well know as well. So we should all be so lucky in our semi-retirement. Now I'm going to go on and,
own an NBA team.
have a control stake in the Lakers.
All right, David, thank you. Keep us posted on what else you learn. Meantime, other big story this morning, CPI inflation comes in line with expectations, though remaining above the Fed's 2% range. Let's bring in former Treasury Secretary Jack Lew with his reaction. He's also the former U.S. ambassador to Israel. We've got a lot to get to with you, Secretary Lew. Thank you for joining us. Any big concerns that you have about the direction of inflation from here now that we're starting to see the pressure come down?
Good to see you, Sarah. Today's CPI data was pretty much along the lines of what was expected internally. There were some things that were moving around. But I think, it paints a picture that's very challenging in terms of the future direction, because it shows that it's still going to take a good while to get down to the 2%. And just a few days ago, we saw a jobs report that showed a weakening economy. My expectation would be that this gives a lot of room to stand pat for a bit, but there's going to be a lot of attention on whether or not the Fed sticks to the importance of getting to the 2% target. The new Fed chair, I think, has tried very hard to make it clear that is a priority of his. But ultimately, balancing the kind of trade-off between worrying about a weakening jobs market and worrying about inflation is going to be a hard decision. I wouldn't expect a move right away. I think that if I were there, I would be waiting for some more data, even tomorrow when the PPE data comes out.
I was thinking of you and other former Treasury secretaries when we learned of the Japanese yen intervention that the U.S. participated in alongside Japan, because it was pretty unusual that we did that. I mean, it's happened before, but not in a really long time. Coordinated intervention to stop the yen from getting too weak. Look, it doesn't appear to be working that well. At least half of those, half of it has come back. What do you make of that? Was that the right move for the Treasury to do?
Well, it was an unusual move. I think it was motivated in large part out of a concern that Japan would potentially be selling dollar-denominated securities and having Treasury bonds kind of flow into the market at a time when the federal government's borrowing a great deal was something that there was a good reason to want to at least avoid. I think that the challenge, and we don't know the details, is the extent to which there were understandings about what the ongoing policy in Japan would be, and whether there were conversations with other governments, other treasuries, other monetary authorities. When there was the Fukushima disaster, there was a coordinated global intervention to stabilize the yen. There have been cases where intervening with another country in a cooperative way actually can serve both interests. I think the fact that the benefit has pretty much half run off in a very short period of time suggests that without some action by Japan on its own policy, any benefit would be short-lived. And it was interesting that the transaction was done in euros, not in dollars, to try to keep it out of having an impact on U.S. Treasury market.
Yeah, then there was the added complication, if you believe the FT, that the ECB was blindsided by that, and there might have been some erosion in, I don't know, relations between our central bank, or at least our Treasury, and them. Jack, do you believe that?
So look, I think moves like this made in a coordinated way tend to be more effective. I don't know the extent to which there was coordination here. I think there's been a pattern of interventions by Treasury that suggest a greater willingness to use the Exchange Stabilization Fund. I think it raised a lot of questions when that intervention was done with Argentina. This is a very different case. The first in Argentina, it kind of had all kinds of issues about whether or not it was to prop up the government or for U.S. economic interests. This one, there were legitimate arguments that there were U.S. economic interests, but when you look at the two together, it does raise questions about how the U.S. is using this ability. One of the things that I think is little understood is how limited the Treasury's authority here is. When I last checked, there's about $40 billion of liquid assets and another 200 in encumbered assets. Really, they're the IMF special drawing right holdings. So it's not a huge amount of firepower, and it has to be used very carefully.
I guess why? Like, what is the risk? It's not, I mean, it's not using taxpayer funds directly, right? And the idea that, you know, that it would prevent, I think they're our largest foreign debt holder now, from potentially having to sell treasuries to do more feels very prudent.
Well, first of all, there's the need to have assets at your disposal when you need them. If there's a true financial crisis, the Exchange Stabilization Fund is really important. It's what was used in the 1990s during the peso crisis. So there is the question of just conserving the resource. Secondly, there's a question of potential loss. And you say it doesn't affect the taxpayer, but if we were to have lost what we had at risk when we did a swap with Argentina, it would have shown up as a loss to the Exchange Stabilization Fund. It turned out not to do that. It had we were able to exit without the loss, but it was a very risky move. This one is a little different. I'm sympathetic to the desire to avoid external pressures distorting U.S. Treasury markets. I think the question of coordination, the question of sustainability, they're also important.
Meantime, Jack, there's a lot of pieces being written about Besant's 3-3-3 hopes. 3% deficit to GDP is clearly not happening. We're almost double that. 3% economic growth, we're doing 1.5. Oil production missing on that count. And then he's getting a little more strident, criticizing journal reporters on social media posts. I just wonder what you make of the tone coming out of Treasury right now.
Look, the tone is a little different than anything we've heard in recent years. It's not a tone that I think is the right tone for Treasury. Treasury should be above politics to the extent that you can be while you're a policy agency of the president. The respect and trust that the world have in the Treasury is a big part of our ability to have an impact economically around the world. So I would be a little bit more constrained in my rhetoric. I think that the language and the policies with regard to Iran just don't add up. I mean, we're hearing Treasury talk about Iran caving to pressure, but there's no evidence of that. In fact, the evidence is that Iran feels emboldened by the fact that the United States has used its economic tools and then kind of pulled back when Iran responded by deploying its ability to close the Strait of Hormuz. I think the United States is in a vulnerable position right now where we made very strident moves and then couldn't absorb the impact of the response. That makes it harder to negotiate, but it also weakens our credibility. So I think it's important to use these tools of economic statecraft with great care.
Finally, I've really been wanting to ask you, Jack, how you feel about the socialist takeover of your party. I know that we saw an upset yesterday in Wisconsin for the Democratic governor, but I mean, otherwise, there's been such momentum. And I do wonder if you see, for instance, the El Sayed win in Michigan as a turning point. and how you're
Look, I
making
don't
sense of
see it as
this.
a turning point. I think you've seen through this primary season mixed results. Even in New York, which I watched obviously very closely as a New Yorker, there's a lot of attention on the congressional primaries that went to progressives, much less attention on the Hudson Valley seat that went to a moderate that could be a flip, and the East Side primary that went to a moderate. I think yesterday was another indication that there's a division and a bit of a debate going on about the Democratic Party. I don't think it's any secret that my comfort level is with the center of the party. Though when I say that, I'm sympathetic to many of the policy concerns that are expressed by progressives. I don't think the mode of splitting the party is going to be a constructive one. So I hope there's an ability to heal, but some wounds are harder to heal than others, and we will have to see.
Although Andy Ogles lost the primary in Tennessee 05, I mean, this is kind of like how primaries go.
Yeah, and there's also in each primary question of the individual and personality. I think it's hard to draw national trends. The fact that last week the Michigan vote was really very close and that yesterday the Wisconsin vote was as thin as a margin can be, it shows that this is not a decided question. And I think if Democrats are going to win in a national election, if they're going to win the Senate, it's going to require people who need to have some comfort that the center will hold, finding a place to call home. So we'll have to see where the rest of the primary season goes and how the victors in the primaries rearrange their campaigns as they approach very difficult general elections.
All right, we're going to have to do a whole nother segment on this and some of the economic ideas that these guys are floating. But for now, it's good to get your take on it, as always. Thank you.
Good to be with you.
Jack Lew, former Treasury Secretary, former President, Chief of Staff, former Ambassador to Israel.
Take a look at some restaurant stocks. Cava and Brinker with some impressive comps. We'll talk about what's driving shares of both of those companies higher this morning when we're back in a minute. Welcome back. Kava and Brinker International jumping after earnings. Brandon Gomez has his tails. Morning, Brandon.
Hey, good morning, Carl. Kava reported a Q2 beat. Top takeaway there, though, was the 9% pop in same-store sales, the second straight quarter of 9% growth. Now, CEO Brett Schulman on the call last night saying exiting Q2, the company saw sales dip from Cyclospora's industry-wide impact, but that started to rebound recently, giving the company confidence to maintain its annual guidance. Now, the stock really popped last night when the CFO said there is nothing in today's trends to indicate that the company would land at the lower end of their guidance range. She also said the company is seeing significant strength in the lower median household income markets and that they're actually outperforming better than all of the company's other channels. And then you have Brinker International this morning higher. The Chili's parent reported in-line revenue of $1.54 billion, a slight miss on EPS. The biggest driver once again was Chili's, with same-store sales jumping 5.6%, making the brand's fifth consecutive year of same-store sales growth. Maggiano's came in weaker, with comp sales falling 2.5%. Now, the company said food and beverage costs at both chains were negatively impacted by higher beef costs and temporary increase in produce costs. But investors seem to be looking ahead. Brinker gave 2027 guidance, adjusted EPS between $12.60 and $13.40 a share, with revenue between $6.15 and $6.27 billion. The company also increased repurchase authorization to aggregate of $750 million. Now, I also know you talked about Wendy's earlier this morning as well. Reports of a take-private bid from Nelson Peltz and Trian, which hold a significant stake in the company. Still awaiting a response from Wendy's. I did reach out, but Trian did respond saying that they declined to comment on the FT's reporting. We know the company trying to do a turnaround there, so I'll keep updates coming to you as I get them. Guys, Sarah?
Okay, that was a lot. Thank you, Brandon. Brandon Gomez. Still ahead, Google launching a new Pixel lineup today, showcasing AI capabilities. How that sets the bar for Apple's hardware refresh in September. We'll be right back. Welcome back. Google launching a new Pixel lineup today. Mackenzie Sagalos has the details. Mackenzie, what do we expect?
Hey, good morning, Sarah. So Google is launching the Pixel 11 and a new Pixel 11 Pro Fold this morning, built around its biggest push yet to make Gemini the way that you operate your phone. Now, Gemini Intelligence can understand what you're doing, connect information across apps, and then take actions for you, really moving closer to this autonomous agent sitting on top of the operating system. And Google gets to show that off just weeks before Apple rolls out its rebuilt Siri, powered by Google's Gemini models. I asked Devices chief Rick Osterloh in an exclusive interview whether Gemini Intelligence is essentially a preview of what Siri AI will offer.
I think obviously Pixel and iPhone are going in very different directions. It's always been at the forefront of Pixel's product strategy to lead with new technologies, and in particular with Gemini and AI. And so, we think we've been able to go really far in deeply integrating that into the user experience. All these things are unique to Android and Gemini Intelligence. So I think these are things you're going to want to get a Pixel or an Android phone to try to experience.
Now, the new Pixel lineup is also more expensive, and Osterloh says that the memory shortage could push prices even higher.
There's quite clearly a shortage of memory, both RAM memory and flash memory, both. What's happening in the near term, I think, is everyone's needing to raise their prices. We've also discussed that we will need to raise ours like all the other industry players.
Now, the bigger test is, of course, whether agentic AI actually gives people a reason to upgrade. So far, it hasn't. And in a few weeks, Apple makes that same bet with a much bigger installed base. Guys?
Mac, I guess the question will be after Tim Cook already talked about the difficult decisions when it comes to pricing in the face of those memory price pressures. You sort of, which is more competitive, where margins come in, what the consumer's willing to withstand?
And that's something that came up when I spoke to the Google Devices chief yesterday, Rick Osterloh. They actually took down their base RAM from 16 gigs down to 12 gigs while also raising prices. And that's just a reflection of the reality at this point. But what he pointed to is also part of this hardware upgrade is this new Tensor G6 processor that's actually 20% more efficient in terms of battery life, in terms of what they're able to do with Gemini efficiency. So that is meant to basically safeguard against cutting into this new Gemini Intelligence experience.
Oh, interesting. Mac, thanks so much for that. Meantime, another really narrow range intraday as you got the VIX sub 15. Pretty amazing.
I think we got through CPI and there was no big surprises, in line with expectations. Keeps the Fed maybe not having to raise in September, and that's good news for the market.
Yeah. Let's get to the Judge at Post 9.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Food for the bulls. The CPI hits in line, yields down, CoreWeave surging after earnings. We trade the markets with the investment committee. Joining me for the hour today, Joe Terranova, Shannon Sakosha, Brian Belsky, Bryn Talkington. Check the markets here. Green across the board today, so a little bit of relief, obviously, after the CPI print. Certainly the AI bulls getting a nice lift from Supermicro and CoreWeave, the beats, the raises, etc. And Ed Yardeni goes to 8,400 now on the S&P. 8,250 was the prior target, which at the time he said could be a little conservative. All right, so the words, then the action. So he raises it. Says, quote, "We've never seen consensus earnings expectations rise so quickly for the current and coming years as they have since mid-2025. The result has been an earnings-led melt-up in the stock market to record highs." That's where we find ourselves. There's no reason to think that that's going to change as long as the earnings picture remains what it is.
No, and congratulations to Ed on calling the 20s for exactly what it is. It is the roaring 20s, specifically attributable to the earnings growth. Now, Ed is the highest on the street. If you look at the S&P targets, the actual consensus price is 78.45. But we're looking now at taking profit margins towards 17%, which is absolutely staggering if you think about where they were just 5-6 years ago, kind of wallowing around 10%. The earnings growth is the driving force for sure. Ed right now is the highest on the street. And I think what we will benefit from is continued participation as we move higher from the systematic funds. We're kind of sitting in place right now off of this 3% gain that we've had in the month of August, really strong out of the gates. But I'll tell you what, we break out above that August 5th 77.93 high. I expect systematic to engage further and move the market towards 8,000.
Okay, so I mentioned, you know, obviously you get the news that you really needed, Bryn, today. Does the Yardeni target sound reasonable now to you? Because I said yesterday, I think 8,000 is the floor. It feels like it from the street, at least. Everybody's gotten now to at least 8,000, or certainly most people are getting there. And now he ups the ante at 8,400 because of this FEMO, right? Not FOMO, FEMO. It's the earnings-led momentum.
So I typically, ignore year-end price targets. That being said, Ed's been doing this for decades. He has a very good track record. And so I think directionally what he's saying makes so much sense, because you also have to think about how the construct of the S&P and the NASDAQ, or for the S&P for earnings, has changed so much. So yes, NVIDIA is still the #1 holding in the S&P, but now Broadcom and Micron are also in the top 10. Obviously, Broadcom's been there for a minute, but Micron's now broken to, I think it's like #7 or 8 position. And those earnings from those three companies are going to continue just to be monster. And so I think if you are looking at earnings from these specific companies, especially the Micron and NVIDIA, you can math out very easily why his number at 8,400 sounds plausible. And so I do think investors do need to understand that huge shift of the constitution of the S&P and the NASDAQ has changed, which is going to continue to push those earnings growth numbers higher.
Shan, what do we think about this market?
Well, I mean, the crazy thing, right, is that the S&P 500 is actually underperforming other global equity markets. And so I think if you look at the tech PE ratio, we've seen that compress pretty markedly. We're seeing the opportunity for this pivot, if you will, in terms of the next phase of AI. But I think it's most important to kind of counter some of the enthusiasm with the fact that many are still concerned about the recent unwind in memory. Was that fundamental? Feels more technical to us, certainly the degrossing. The reality is, too, you also have the news from NVIDIA about these memoranda of understanding that clearly is indicating that there is going to be a wider participation. We've seen it in the credit markets already in terms of funding, investment, this issuance, increase in investment grade issuance. You're seeing it now utilizing the alternative private equity managers, private credit managers to also fund this growth. The bottom line is that all of this is underlying the economic momentum that we have globally. We're no longer, especially here in the U.S., Scott, our economy is not based on what's happening with the consumer. And so all of these concerns about the labor market and inflation and the Fed, the reality is that the tenor of economic growth has changed in the United States, and the companies that are performing well from an earnings perspective are benefiting from that and are likely to continue to benefit from that, even if there are pockets of weakness in parts of the consumer market, for instance.
Big week for the AI bulls, undoubtedly, right? The NVIDIA financing news, no money to be seen yet, obviously, but the announcement enough speaks to the environment and the expected demand that's going to be there. CoreWeave blows it out, stock's ripping. Supermicro gives a good guide, stock's higher. So this has been a week of AI trade validation in many respects.
It's been about validation. It's been about the messaging and how they're doing it. Remember, people were worried about how and why companies like Oracle and Microsoft going out into the private sector and gaining debt. This consortium, even though it's still not completely tied together, this consortium, in terms of how NVIDIA put this together, number one, and number two, how they communicated it, Scott. We need information in the market, and they did a great job talking about how that's number one. Number two, in terms of the tech trade, we've said for 10 years that tech is becoming the consumer staples of the U.S., period. And so earnings have become excessively stable, but Ed nailed it. And we talked about this on the show yesterday. In the second quarter, we've never seen in the history of watching earnings revisions for well over 30 years, we've never seen revision of earnings like that. And when you see that, that is real. That is real. And so what's going to end up happening is you're going to continue to see these types of revisions over the next 4 to 6 quarters, and 8,400 is clearly in the way.
I mean, Bespoke today talks about the beat rate for tech, the highest, 85.1%. 1 of every 100 tech stocks that have reported, 85 of them have beaten expectations. You have had, according to Bank of America, who watches the flows of what their institutional clients are doing, tech's second biggest inflow ever. So driven by hedge fund clients. Remember, we've been talking a lot about the degrossing from hedge funds. There's been a lot of deleveraging. The positioning environment, the field, if you will, is cleaner now. Tech saw the second biggest inflow week of all time. Money's going where they think they can get a nice reward. There's no doubt about that. This trade seems to be back in a big way. If it wasn't gone, it was parts of it at least were just taking a rest. Now the chips and the momentum trade, they were taking more than a rest. They had to puke up a little bit before they felt good enough to get back in the party.
So we had this 19% move from the end of March through June 2nd. That took you up to 76.20, an all-time high. And then the market, to your point, Scott, it kind of had this consolidation to lower trade as you moved through the month of June. We're now rebuilding positioning once again. The catalyst is clearly earnings. And I think, Scott, we're getting in front of NVIDIA earnings. I think if you...
Exactly 2 weeks from today.
Exactly 2 weeks from today. So if I can, let me just walk you through why I think we're getting in front of it. First of all, analyst community, 96% buy rating, 303 price target. Here's what happens with the revenue growth. The revenue growth reaccelerates. Remember we were hearing about revenue growth moderating? You're coming in, the consensus number is 96%. That's the best figure in nearly 12 months for NVIDIA. Now you're going to see earnings growth, 114%. You're talking about free cash flow generation that's going to come in at $47 billion. Next quarter, they're going to guide to $100 billion in revenue. Think about how staggering that ultimately is. So I think the market is getting in front of what I think universally people believe is going to be a really good quarter. Be a little bit careful with that on the other side of earnings.
I was exactly thinking
Be a little careful with that on the other side of
right.
earnings, but I think we are working ourselves up towards that that previous high at 236 for sure that we had in May.
Bryn, and Goldman says it's going to 285. They reiterate their NVIDIA buy, but Joe makes, I think, a really great point that we just came off one of the best weeks that this stock has had in an awfully long time. It's been on a nice run here, okay? You can look at it over, that's month to date. Thank you, guys. That's a good chart. That shows exactly what I'm talking about. Therein lies one of the problems, okay? So expectations are elevated too. Watch out on the other side of earnings in a couple of weeks.
I mean, the growth of this company, though, is so ginormous that I think it's been a huge laggard with the growth, which tells you it's like people just still don't believe this growth is going to continue. But to Joe, walking through those revenue and earnings numbers, they are. And to do $100 billion next year is amazing. And so the stock continues to get cheaper. I think it's just been consolidating, right? What do we have, a $5 trillion market cap? But this stock is cheap. It should be at 280. 220 is at 223 is inexpensive. So we'll see if it can break through that technical ceiling around 230s. When it does, I do think it will. I think it's off to the races. But that 230 definitely is a ceiling that it needs to pierce through. But it's been an underperformer relative to the Microns. A bunch of different stocks year to date. And so I do think there's an opportunity for catch up, especially with Elon saying with SpaceX that they're pushing all of their chips in with NVIDIA. That's a huge, huge new customer that was not underwritten a month ago.
You make a good reminder to people, too, about the valuation. Let's show that again, if we could, because the stock, we've been saying for the last few weeks, the stock is the cheapest that it's been. I don't know, what was that, since 08? In 7 or 7 years? I'm sorry, 7 years. I was thinking 2007, 2008, yeah. But in 7 years. So therein tells its own story, right? Of a stock that earnings expectations continue to go up and the stock continues to get cheaper. There's other news today as well. So Morgan Stanley comments on Meta's new Muse Spark, re-entering the open weight game through Muse Spark, reads positively for the ecosystem. So that's a story that we continue to follow. Google getting its first crack today at the iPhone. That's interesting, a new Pixel lineup. We're following that. There's the SpaceX news today of the target getting cut. The stock has been teetering right around the 135 level that it had gone out at. It got below that. Now it's back, at least above it there. I want to move and talk about a stock that reports earnings tonight. We don't talk about it all that often. It is Cisco. Brian Belsky, you own it.
Yeah, we do. We've owned it for about 10 years, Scott. And this is a company that has really benefited from the Russell 1000 value technology sector being a place with respect to where momentum has been, especially when Micron was in the sector. So this is also a name that value investors have been able to buy, not only for the cash flow and the consistent earnings, but this stock throws off a dividend. So now that they've talked more and more the last couple, 3 quarters about their AI development, the stock has a lot of fundamental momentum behind it.
Why has this stock done so well?
I think 2 things. Number one, it is obviously participating in AI, but it's participating in AI through optical. And you see today.
Look, Lumentum.
So let's talk about how strong the optical story is. It is Lumentum and Corning. You see this strong earnings. Corning is the traditional way. It's more of a reasonable valuation, and that's how I'm playing the trade. You could look at Lumentum. You could look at Coherent. Coherent's up 59% so far month to date. Applied Opto, if we could show that, that's up 84% year to date. So Cisco is there. It's participating in that optical component, which is critically important because years ago, everyone was saying in AI infrastructure, what do you need? You need copper. Everyone said own copper. Well, now optical is replacing the copper wiring because the light is actually moving the data faster and more efficiently.
Copper's been ripping too.
Well, no. But optical is absolutely the trade. And if you don't believe that optical is the trade, NVIDIA earlier in the year announced $2 billion deals with Lumentum and with Coherent because they understand that's where you have to be. Last point is also keep in mind, and this is not confirmed as of yet, but the FCC consideration in terms of limiting Chinese imports of optical is obviously going to turn us more reliant on U.S. optical that plays right into the names like Cisco, like Corning, and the others I mentioned.
Let's talk more about software. Okta today upgraded to market outperform from perform at Citizens. The cyber trade, Brian, has been really where it's at in terms of software. It had that momentary blip months ago and then has had just a strong rebound. CrowdStrike taken to 230 today from 195 also at Citizens, so they're sort of reevaluating the whole group. They take Palo Alto to 415. What do you think?
Stock's up 100%. But remember the blip. The blip came at a great time for this company because it was in the process of folding in CyberArk and everything that was happening in terms of their operations. And now Palo Alto to us is the creme de la creme in terms of that type of space with respect to cybersecurity. So we like the company. We've been adding to the company over the last few months, and it's our core holding in that space.
You have some?
CrowdStrike, Fortinet, Palo Alto, cybersecurity, that was the dominant theme as software was entering this corrective phase. And even as we've now witnessed other parts of software come back and have the mean reversion recovery, cybersecurity is maintaining the strength, and it's attributable to the fundamentals and also the fact that if you are a CTO, you are not cutting the budget as it relates to security.
You're starting to get more conversation that software has some legs, that this rebound is not punk.
No, I was just going to say that. I mean, we heard so much about both software and business services, this AI disintermediation, and what I think was overlooked or under-acknowledged by the market is that the companies that are outside of the technology sector that are going to be integrating and implementing AI, they are accustomed to utilizing the software that they have on their desktop today. They want that software to be enhanced, improved, created greater efficiency by introducing AI into that software, not necessarily upsetting their entire stack, especially large Fortune 500 businesses, Scott. They don't have the opportunity to just tuck something entirely new in. So they're going to rely on software providers, perhaps at lower take rates in terms of annual revenue, but they're going to rely on their software stack in this AI introduction and implementation that they're going to have to achieve.
How about this space, Bryn? Software.
I think that Microsoft, a week and a half ago when their earnings was a game changer. And so I think that puts a ton of support. It's obviously a big position of IGV. And I do think that we're all starting to understand, especially with these open weight models, Whether Meta can be successful, that's yet to be seen. But these open weight models is that ultimately these LLMs become commodities, and you do need a trusted application layer, which is where the margins are. And so I think that you're going to continue to see IGB specifically make these higher lows, which is great for the chart. And I think it creepies, up there for the remainder of the year. But I think that I was frustrated with Microsoft. I think it was a game changer to say this, software application layer is here to stay, and there'll be winners and losers. But I do think IGV, because you have a little bit of everything, is a decent way to play the software space if you don't want to have an individual, risk of one single name.
I'm going to maintain a degree of skepticism until I hear from the three names in software that I think the problems exist most.
Salesforce.
At the end of the month, we get Salesforce. I think August 26th. September 9th, somewhere around there, is Oracle, and the following day is Adobe. Let's hear what each one of those reports are all about before we get this enthusiasm that a return to software in totality is warranted.
Do you think those are equally important? Because I would think about Adobe in maybe a different context of that, just given the narrowness and the creative aspects of that company that might be unseated more so than a Salesforce.
I was thinking the same thing.
Yeah,
I was going to say, I thought you were going to say ServiceNow.
No, I actually think ServiceNow of those four is probably the best positioned. And that's
You're not as concerned about that.
The stock doesn't reflect. I mean, the stock has bounced nicely over the last month, but that's about the only green you're going to find if you look at it, at least on my fact set.
Yes.
Quite literally.
Yeah.
Week to date, it's down in the course of what's been a decent bounce. Over the last 1 month, yes, it's up 15.5%. Year to date, red. 12 months, red.
I feel as though the trouble has been spent, and ServiceNow is challenged for sure, but I feel as though the real trouble is specifically related, and it all began 1 year ago with Oracle, and then it trickled down and it went to Adobe and it went to Salesforce. So I'm maintaining this disbelief.
So is Oracle the number one problem child? And
I think so.
So
Absolutely.
is that the one that needs to provide clarity in terms of getting out of the penalty box?
Candidly, Brian, I'd like to go 3 for 3. I'd like to hear something really good from all three of them universally, and that will shift my sentiment.
Okay. Let's talk about financials for a moment, because you put out a note today. The good folks at Humulus were working all night on this note, and they said today that they're buying into the rebound in financials.
We are.
Why?
Well, we wrote the report because we knew that you would really appreciate that today. So
I appreciate that. I do.
It is
I do.
Really all about Wapner today. And this is a sector that we think, you talk about earnings, the next great earnings win, aside from tech, is going to be financials. And we're going to see rates moderate. We're going to see spreads continue to increase, but more from a thematic perspective. You see the really big banks and the really small banks doing well, but the broker-dealers are a great business, and that's why we highlighted Bank of America and Goldman Sachs in terms of the two stocks in focus with respect to where and why we own those names. We think there's a long runway here in financials.
And if I remember correctly, didn't you either sold or you trimmed Regional Bank yesterday, right?
Fifth Third.
Yeah, Fifth Third in our value portfolio, because we are up 30% in the name. We're really worried about their loan book for the next couple of quarters, but we're already 32 or 33% financials in our value portfolio. So we just added to a couple of our more favorite names.
My take is JP Morgan continues to break out. If we could show a chart, I think JP Morgan trades to an all-time high today. Bank of America, very quietly, I probably fail in mentioning this name enough as it relates to the money center banks. I tend to focus on Goldman Sachs and Morgan Stanley and JP Morgan, but it continues to work higher. And Brian, you pointed out yesterday, I thought it was excellent as we talked offset, just about the value in the wealth management business for Merrill Lynch. Really strong.
Remember we talked also offset. All the good stuff is off. That's where really good comments come, when the cameras are on.
Well, maybe you should bounce off right now.
See you later.
If you're not going to
Good night, everybody.
If you're not actually going to deliver when your mic is
Not
open.
really. I mean, I get so nervous on air. But if you think about how they communicated their second quarter earnings, think about how much talk there wasn't about wealth management, because they were talking about net interest margins, commercial bank, the investment bank, the deal flow. The creme de la creme, I think, in all of these major banks, it's going to be wealth management the next 6 to 9 months, period.
These guys deliver, by the way, their best stuff during the actual hour of the program.
I'm still a rookie compared to these two. I mean, honestly.
I don't know, man. What should we do with this guy? The hook?
The hook?
The hook. Wow. Okay. Executive producer says the hook.
See you later,
Go to the bullpen. Go to the bullpen. All right, coming up. Speaking of sports, a bombshell basketball buyout. The Lakers sold for the second time in about a year. We have more on this still developing story next. Welcome back to Los Angeles. Lakers changing hands for the second time in less than a year with some big name buyers in a deal reportedly valued now at $12.5 billion. To give us more context, put all of this into perspectives, Alex Sherman with CNBC Sports. This is a shocker to a lot of people.
I would say a shocker across the board, including to the league itself, to Jeannie Buss, the current governor of the Lakers. In fact, I would say even right now, there's still more questions than answers involved with this. Let's get to what we know off the top, which is that Mark Walter, who formally acquired the Lakers in October of last year, is now in essence flipping the team. He bought the team at a valuation of $10 billion. He's now selling it to a consortium led by Josh Kushner and Bob Iger for $12.5 billion. Of course, Joshua Kushner, founder of venture capital firm Thrive Capital, Bob Iger, former CEO of Disney. These two had been looking to buy the Las Vegas NBA team. They were one of many bidders potentially for that expansion team, now turning around and buying the Lakers instead for a record price. Now, there's a few questions I just want to rattle off here, and we can talk about it a little bit, Scott. We don't really know the financing at this stage. I don't know exactly what Bob Iger's net worth is, but he is not a multi-billionaire like some of these tech founders that you see, so we don't know exactly what ownership stake he will have in it. The NBA has rules around private equity ownership that caps it at 30% in the aggregate, so we don't know exactly what percentage of this will be owned individually by Joshua Kushner and how many other investors they're going to need to bring in order to hit $12.5 billion valuation. Mark Walter bought more than 70% of the Lakers when he bought that stake from the Buss family last year. Like I said, we don't know what Jeannie Buss's role is going to be moving forward. She's still the governor of the Lakers. She basically is the person in charge of that team's operations. Does that carry on moving forward? I'm not sure. We also don't really know why Mark Walter sold the team yet. There is an ongoing investigation into several of his insurance companies. I don't know if that factors into this or not. Nobody knows yet, but it is certainly unusual that you would buy a team and then turn around and sell it less than a year later. Now, he is making a lot of money on this transaction, so it was clearly a good investment by him one way or the other, but we don't know exactly what the motivating factor in selling the team is to this point. So still a lot of questions to be answered. Scott.
Good point you make. I mean, obviously, the headline is the sale. The subplot is the financial empire and the federal probe, and we do need more details. Most of the people that I've been speaking with in and around the sports investing landscape were just stunned by the news itself, as you alluded to at the top. Let's welcome in, you stay with us. I want to welcome in Mark Gannis. He's the CEO and the founder of Sports Corp. He's a consultant. He's sort of a sports deal guru, if you will. Has his hands in a lot of things that are going on in professional sports transactions. Mark, it's good to hear from you. Thank you for joining us.
Thanks, Scott. Pleasure to be here.
Just to get everything in full transparency, you didn't, your company or yourself, you didn't have anything to do with this transaction, correct?
That's correct.
Okay. What do you make of it? I mean, I told Alex here, you know, the people that I've been speaking with this morning in and around the arena, if you will, are pretty stunned.
Yeah, it is stunning, and the speed by which from when Mark Walter bought the team to selling it, there's a lot more going on here that we don't, that has not been made public. He's not a person who flips. His history in sports, his history in business has been he buys, he fixes, he develops, and he holds. The Dodgers are a great example of that. What he's doing with the Cadillac F1 team, another example, in the Professional Women's Hockey League. So that he's flipping this so quickly, there's something more to the story here of why he's doing so, and it may have something to do with his personal situation.
Sure, people are trying to hypothesize, was this transaction pushed by the probe? We'll just have to wait and see, but it's certainly being discussed in sports circles today. I thought Alex made a good point as well in talking about the role that private equity can play when it comes to NBA deals relative to what the NFL, for example, allows. And that's where you really have your hands deep in so many of the biggest deals that have been done in the NFL. We don't know a lot about the financing here. We know the parties that are said to be involved. But can you speak to the fact that trying to get a transaction done in the NBA, and dare I use the word easier, it may be just that relative to the NFL in terms of the percentage of private equity that is allowed, the introduction of sovereign wealth money that is allowed in a way that the NFL does not?
Right. So transactions are much easier to do in the NBA, and that is reflected in the high valuation of NBA teams as compared to the NFL. For example, in the NBA, you can have corporate ownership, public company corporate ownership. The NFL doesn't permit that. Sovereign wealth funds you talked about. You can have direct pension funds investing in the NBA. You cannot have that in the NFL. Those are self-imposed governors at the NFL that anytime they want to release the brake, they can increase valuation significantly. So Josh Kushner and Bob Iger have been out in the marketplace raising money for an Las Vegas expansion team. So they have a pretty good idea of what's out there. And by doing so, I think they have probably a significant amount already lined up for this deal that has not been made public yet, and they don't have to compete for an expansion team like they would have in Vegas.
Interesting. Alex, I'd love your opinion on that, based on you've done so much reporting of late, and we've had conversations about the role of private equity, maybe the ever-increasing role of private equity in sports, and also to some degree the growing criticism around it.
Yep. So just to tack on to what Mark was saying there, the speculated price for a Las Vegas NBA team was in the $10 billion range, up to $10 billion. Some people think maybe it would end up going for 9 or something like that. But the point there is that quite a bit of money would have already been needed to be raised in order to make that a winning bid. So I do think that there's likely some credence to what Mark was saying there with this valuation at $12.5 billion. And again, for only a 70% plus stake, rather than what would in essence be a 100% stake, because that stake was being built from the ground up. There is no previous owner, so you'd be buying the team from scratch. So all of that money would need to be raised by Iger and Kushner and whoever else. So logic suggests that there are multiple financial backers already backed up. And just by the way, even if there aren't yet, we saw as evidence with the Boston Celtics sale last year that you can always bring on investors after the announcement of a sale. So in the coming months here, this sale would need to be approved by the Board of Governors of the NBA. So there could still be more money that comes to the table in order to get this deal approved by the league in however many months down the road that happens.
Mark, lastly to you, the Lakers are obviously, I guess, what we could call in our business a special situation. In many regards, it's a trophy franchise, obviously, in professional sports, to the degree that you can sell a franchise for $10 billion less than a year ago and command $12.5 today and actually get it. And just where valuations are going in your mind, the fact that the Seahawks just went for near 10 to Vinod Khosla, this is a one-way train, it appears, and every time I've asked you where valuations are going, you continue to say higher. You told me many months ago that the Seahawks would get 10 or close, and here we are. I'd love your insight into where we go next.
These trophy assets in sports in particular are going to continue to go up in value. Look at what just happened with the Yankees with Apollo at $2.6 billion coming in and basically selling almost none of the team. These trophy assets cannot be replicated. Sports is an asset class that is going to continue to grow. And as we move to AI and globalization, sports is the one asset class that will be advanced, will not be hindered by AI and globalization. So when you take the combination of the asset class, the future, and the limited trophy assets that are out there, these things are going to keep going up, and we're not anywhere near the end of the road on these. There's a lot of runway left to go.
It certainly seems to be that way. Great insight, Mark. Appreciate it as always. Great reporting from you and your own insight, Alex. We'll see you later at 3 o'clock. That's our Alex Sherman. Now to Pippa Stevens with a CNBC News update. Hi, Pippa.
Hey, Scott. A specific threat about a shoulder-fired missile was reportedly behind the decision to move President Trump off of Air Force One as he left the NATO summit in Turkey last month. That's according to CNN, citing a person familiar who said the threat was detailed enough to hide the president in a catering truck and move him to an unmarked military jet. Air Force One departed separately as a decoy, carrying aides and reporters. A desperate search continues for survivors of Colombia's magnitude 7.4 earthquake as the critical 72-hour rescue window closes. At least 181 people are dead and nearly 2,600 are injured. In Pereira, crews pulled a young woman alive from the rubble after a painstaking 12-hour operation. Thousands are now living in shelters and parks. And millions are gathering across Spain, Iceland, and Greenland for today's total solar eclipse, with darkness lasting up to 2.5 minutes. Spain has deployed more than 33,000 officers as crowds enter wildfire-prone rural areas. Authorities are urging viewers to use certified eclipse glasses and avoid anything that could spark a fire. Scott, back to you.
All right, Pippa, thank you. Pippa Stevens coming up. Calls of the day, including a number of bullish calls on the committee's top consumer plays today. We'll debate those names coming up. Let's do some calls of the day. Wolf today says they love the setup on McDonald's. Belsky, they say it's one of our favorite setups after a stock has suffered a significant drawdown. It's a weekly oversold signal at support coupled with a bullish inflection in momentum. Now, you didn't, thankfully, say anything about McDonald's off camera. So now you have to deliver your best stuff on.
Church mouse off camera. The real concern on McDonald's is that the same people coming in, they call it renewed traffic, is down less than 1%. So they need to try to find a way to crank that up. They're really working more on the app. Their sales are pretty flat, and the international side was a little bit light. So they've got a new focus on the U.S., Scott, and we think that there's going to be strong growth the second half of the year here.
You buy this turnaround in Target because B of A today, you own the stock. B of A reiterates underperform, okay? They do put the target at 124. It's at 153, okay? The stock is up 56.5% year to date. It's up more than 13% over the last month.
Yeah.
They're not believers, obviously. Are you?
We own it in one portfolio, so that kind of tells you the come on. But we prefer Walmart.
That means
here.
you like it, by the way.
We prefer Walmart more here. So we do think this is the first full year of the new CEO. He's done a great job operationally to turn the company around. That would be a name that is on our list to trim, Scott.
Okay. See, let's just cut to the chase and get to that then. You know what I mean?
Just trying to add a little bit more.
I understand, but if you own it in one portfolio, that means you like it. If you
Not
own
if
it
I
in
run
20
9 portfolios,
maybe that means you love it.
Okay.
Okay.
Thank you for clarifying that.
Well, I mean, our viewers are sitting there like,
come on, Belsky.
Again?
Yeah. I
Get
get it. I get it.
Hilton, coming right back to you. You're on the hot seat,
Please,
dude.
I love it.
You are on the hot seat. Upgraded to buy. The target 365 from 360. How many portfolios do you have this in?
One.
Does that mean you?
Well, it's a mid-cap
Well, it
name.
got upgraded, so.
It's a mid-cap name, Scott. RevPAR numbers are higher than Marriott. Marriott had a tougher quarter. From the FIFA perspective, they've actually outpaced Marriott with respect to what they saw. So Hilton, we think, is a great play on the healthcare space, or a hotel space, I'm sorry.
It's your unlucky day. I know you're a little bit flustered now, but
I know.
I'm coming right back to you.
Please do.
Lowe's.
Yes.
The target cut to 262 from 281. Home Depot target cut to 344 from 346.
Yep.
What's the story?
Lowe's is down 11% year to date. Home Depot's flat. Home Depot's done a better job with their integration of the new properties. Lowe's not so much. And so we think that there's an opportunity there to see increased earnings growth from some of their new M&A activity that they've seen in the last 6 months.
They're telling me to go to break, but I'm just coming right after you.
Come on.
TJX. Outperform Telsey ahead of earnings on Wednesday. Joe owns it, but I'm coming right at you.
5,200 stores around the world. There's still a runway to continue to grow that. This is a counter-cyclical play on the consumer that has great products, and we think if people are going, we talked yesterday about some consumers going downscale. This is the best way to go downscale as the consumer.
Integris upgraded today, target 200 at Deutsche.
You know what they do? They make the gas that goes into the components that make chips.
Okay.
That's why it's an AI play, and that's why from a demand perspective, this company is firing on all cylinders.
General Dynamics, that's you. Top picks, Wells Fargo.
Robotics.
Joe owns it too, but I'm coming right at you.
Robotics. This company is done from the robotics side and the defense side. We think that from a revenue perspective, this company is going to continue to beat.
Boeing on that list also. You got that.
Boeing, everyone's favorite stock to hate last year. This company continues to have new orders go up. We're flying more, especially on the international side. Their orders from the CEO perspective, this is another company that's done a great job in terms of balance sheet management and cash flow.
Right. Control room. I'm sorry.
Come on, give them a financial
minds. Deservedly, they're losing their minds. They tried to get me to go like 2 minutes ago, but this had to be done.
I know, I get it.
All right, we'll come back with the cash conundrum. There's some new data showing that investors are hoarding trillions of dollars on the sidelines, raising the question of what the ideal portfolio looks like right now. We discuss next. All right, good Wall Street Journal story today. Wealth management has a $3 trillion problem. Investors are keeping too much cash. Got us thinking about what the ideal portfolio does look like right now. So they point out that individual investors are sitting on a mountain of cash, that there's over $3 trillion in retail money market funds. That's around a record high. Not to mention the trillions of institutional dollars as well that are sitting in money markets. David Solomon of Goldman Sachs has talked about that. Advisors continue to pitch bonds. People don't want any part of it. They want cash. They want cash and stocks. What do you think?
Well, that's the barbell that's worked, and they don't want bonds because if they're anchoring themselves back to 2015, 16, 17, where bond yields weren't particularly attractive. Plus the post-COVID period where the Fed was actively hiking rates, and frankly, with an inverted yield curve, cash was the most attractive place to be. But if you look just at the yield increase or pickup that you get from December 31st to today, Scott, you're actually being able to lock in some very attractive yields, both on the taxable side and on the muni side, which is, tax exempt.
Yeah, no, munis, Rich Saperstein, every single time he is on this show, talks munis.
But I feel like this is part of the experience for investors is that they haven't looked at their bond portfolio in years. And so they feel like the relative opportunity is, cumbersome, and the potential for there to be, opportunities in the equity market remain. The other thing that's the challenge, Scott, is that the correlation of bonds and stocks has increased. And so people are like, my 60-40 isn't as elegant or effective as it used to be. The bottom line is, though, is that there are, pretty attractive absolute yields available. And that just going out even from cash to 2 years or 3 years or 4 years in duration, you don't have to go out to the 10-year and pick up that volatility.
Bryn, how are you advising your clients as it relates to this issue that the Journal brings up today and we decided to talk about?
Yeah, well, we say all the time, especially longer duration bonds have been a great way to grow core safely. They haven't kept up with inflation. The ag is flat from a total return over the last 5 years. And that's why, I talk a lot about covered calls, because what hasn't changed is people do want cash flow. It's just how do they want to get it? And bonds from a total return, long duration bonds have been horrific for investors. And so I think they felt more comfortable institutionally as well as on the private client side staying in cash. But when you have covered calls, that to us really squares that. You get equity exposure, but you can create a 6, 7, 8, 9% annual yield while also having some equity exposure. And then finally, I think that most of this cash, once again, the baby boomers, which are now in their 70s, 80s plus, they just have a different risk tolerance. And so I think this cash number is not going to change anytime soon. Institutionally is on the private client side, but this is why covered calls are such a great investment for people wanting cash flow, because you're not going to get that on the bond side.
Well, you're one of the experts, certainly in our orbit on that. Joe?
So institutions are the buyers of corporate debt. Very strong demand coming from institutions, not so much retail, to Bryn's point. I see in front of us that we are raising a next generation of investor that is going to specifically focus on equities, because that is what they know, that is what they have got paid on, and that is what they understand. So I think as we move through time, I think it's going to be more difficult for people to understand the benefits of bonds. They're going to want equities.
You need a break, or you got something to say here?
All I have to say is 40-year bull market in bonds. And we had the unwind from 2022. And now the majority of returns in bonds have been price performance. Now we're seeing what you adeptly said, is that we're seeing interest rates, we're seeing the fixed income part of bonds working again. And I think people are missing that. And that's why Rich does a great job talking about the muni bonds, because you need that interest part of it. So I think that's more important than most people think. I think you're spot on with respect to stocks is the place to be, but I don't think that people should completely run away from bonds.
Okay. So let's take a break and come back. We want to talk about power play problems. There's a backlash, as you know, against data centers. The power names today are getting a lift because of what CoreWeave, Nebius, some of these other companies had to say, NVIDIA, what they've had to say recently too. What does this trade do? Because they've had a huge run this year. We discuss next. Welcome back. Data center power stocks have had a huge year. I think everybody knows that at this point. For example, Vertiv's up 81.5%, Quanta 63, Vernova 58.5, Eaton 46, even Caterpillar, right in the mix there, has been a 50% gainer. So you had a couple of events. Caterpillar got downgraded a couple weeks ago at Baird. They said, quote, state and local regulations could further limit the ability of hyperscalers to deploy CapEx, potentially impacting future orders backlog progression. Okay, that's talking about the data center build out. New York has the data center moratorium. Texas is pausing connecting data centers to the grid until there is an audit. Recent polling has suggested, at least one poll that we saw, 71% of people oppose data centers, right? It's this not in my backyard debate. If they're not in somebody's backyard, they're going to be in another one, however, which is why people haven't gotten too negative on the stock performance from here forward. I'm wondering what we think. Joe T, you have Vertiv, you have Quanta, you have Vernova, and you have Eaton.
Just recently sold Caterpillar at the last rebalance, and that was related to debt to equity. We own 22 industrials. These are the top 4 performing industrials. If you're trying to make an investment decision based on the note that you just read, I would first turn to utilities, and I would step away from ownership of utilities. I still think we're in the process of building out these data centers while there are some regulatory obstacles ahead. And if we're continuing to build that out, manufacturing is going to continue. It's going to support the revenue growth that we're seeing. The 4 companies that we own in the most recent quarter, revenue growth above 20% for all of them.
Bank of America with a note today, Belsky. They say everything's bigger in Texas, including the political risk. Texas has been one of the country's most constructive data center markets, but that position is now at risk. They highlight specifically in their basket of names within the risk, CenterPoint, which you own, CNP, most exposed to the current uncertainty. What do I do?
Well, they're in the Houston area too, which Bryn knows a lot more about than I do.
I know, but you own it.
I do. So
you're stepping into it again.
I know I am. So
did such a good job too.
I know. I really no. Anyway, this stock from the growth perspective is
crawled through.
I'm not going to be
500 miles of.
I know.
Smelling
sludge.
foulness I can't even imagine.
I'm not going to be
and you
pulled down
emerged
by
on the other side. You put your hands in the air. The rain was coming down.
It literally was. I'm not going to let the political environment.
The sheriffs are circling.
I'm not going to let the political environment dictate what I know about this about owning a company. We think the data center side of the CenterPoint is going to be very, very strong, and the demand going forward is there.
That was a Shawshank reference. Did you get it?
Oh yeah, I got it.
All right, we're
get
back.
busy living or get busy dying, Scott.
All right, finals next.
All right, chat. We can see the market has turned around. No problem. Let's fix these algos real quick. That's how that went there. We are now in a controlled buying algo. We got a beautiful V right here at the bottom.
Wow. You notice that too? All right. Tom Lee, Stephanie Guild, Courtney Garcia, Sherry Paul, Jeff DeGraff, Malcolm Etheridge. We'll have more on that Lakers sale today as well. Floor managers getting aggressive, yelling at you, raising his voice at us. Belsky, what's your final trade?
LPL Financial, play on the independent channel.
Bryn.
Big shout out to Jesse Swanson for getting that money on that QQQ play. Shout out to you, Jesse. Okay, for the Kick family, I'm doing something special today for the Kick family. I'm getting ready to get off here because the trade that I wanted to take today, it did not happen. It did not come to fruition. Every day is not going to be a trading day, and I'm fine with that. But I will be streaming some after trading things on Kick. So for those of you who are signed up on Kick, you're going to get a little extra today. We'll be taking our Bengal cat to the hospital today. So we'll be streaming that live, a little behind the scenes with me and Dr. J. So stay tuned. Follow us on Kick so you can be a part of that journey. It's definitely going to be an adventure. All righty. I'll probably be shutting this down about 1:30. Maybe I might let it run. I don't know. Let me change the music though. Well, ladies and gentlemen, this is Abdul Shabazz, and this is Some Real Change. I am back every day now with live trading videos as well as education. Please get familiar. I do appreciate you. Thank you for tuning in. I look forward to talking to you guys shortly. On Kick, make sure you get up on Kick. It should be listed in the description below, I believe, as far as what the Kick is. Oh, it's Some Real Change on Kick. Thank you for letting me know. Some Real Change on Kick. Thank you.
Components are posting greater than 0.3%. That tells me indeed you're way above the Fed's target if that's where the bulk of the components are coming in. And there are actually less than 0.1% readings. So I would agree with what Steve suggests. You are seeing inflation become more sticky. I don't think it's because of energy prices. I think it's because there's too much liquidity. Just listening to your intro.
Yes.
Massive amount of liquidity in the stock market. Credit markets are wide open. Apparently, sports leagues are wide open as far as also sourcing a lot of liquidity. But more basic, money supply is growing 7%. Bank loan growth is 8%. And we just heard earlier this week that banks are easing lending standards, or last week, and so bank loans are going to continue to accelerate. Government spending is accelerating. It's 7%. So
Absolutely.
I think cherry picking the CPI, you're missing the bigger picture. You are seeing stickiness, and there's fundamental reason for it.
I also wanted to point this out. It comes from Peter Bookvar. A couple of things. I know this will be frustrating to our audience, but it is true, and it kind of builds into the point that you're making. He said, you know, a couple of other factors that were down kind of have your head scratching. Health insurance down 2% month on month and down 8% year on year. I don't think anybody is experiencing that. Energy, the BLS said gasoline prices fell 3% last month, but according to AAA, they were up 6%. So, Nancy, my point is there are even a couple of outliers to the downside that make you wonder about that. And the reason why I wanted you in particular to highlight this is because you're not somebody who's been super hawkish. You're not somebody who said for years it's higher than expected and we have to hike. You're still thinking the Fed was going to be on hold. So do you still believe that the way that the data are coming in here?
My colleague Kurt Lewis, who's in charge of our Fed calls, still does think the Fed is on hold, and that makes me even more bullish on the economy if that's going to be the case, because of all of this liquidity continuing to drive corporate earnings growth, which is now spreading from 500 to the 600, all at record highs, growing double digits. So for now, yes, we do think the Fed is on hold. I think the rate structure is too low given how fast nominal activity is growing, 6.5%. Corporate revenues in the S&P 500 are growing 12.5%. I think the Fed is further fueling this growth, and that would make me more worried about a bigger inflation issue in 2027.
I didn't know I was coming on this segment into a hawk's nest, is what I appear to have stumbled into.
Because we were just talking, you and I were talking about the 3-month annualized the other day. And how it's been lower and how the trend 2.3.
I always appreciate Nancy's analysis, and I think it's a fabulous and interesting one. I would just say that David Bromberg wrote a song, I might take a train, I might take a plane. If I have to do a God bleep boogaloo, I'll get there just the same. And the reason I bring up that song is because the Fed may not care how we get to lower inflation, and it may not. I looked this morning, Nancy, tell me I'm crazy about this. I looked, for example, at services less energy up just 0.2%. Now, I get that if you keep doing 0.2s, but it was pretty well contained. It was one area I looked at. I saw, shelter was up 0.1. So when I saw those, I'm like,
that's soft.
Okay, that's soft, and it's all headed down in the right direction. And that if I think I know what the Fed wants to do, I don't think they want to, as a group, necessarily hike. And if they feel like they're on the road there, that they'll be okay with it. But I don't want to disparage Nancy's analysis, which I think is excellent.
Nancy, respond to that if you could, and also this idea coming from the Fed itself. They don't believe kind of higher than expected growth is a driver of inflation. It sounds like you feel a little bit differently.
No, it's not just higher than expected growth. It's how much liquidity is in the system. Looking at current data is always looking behind. If troughs and recessions, if you forecast based on where you were, you miss the upturn. And I would say the same is true because growth is always weak at the trough in a business cycle. And I think the same is true when you look at inflation. You can't look at coincident indicators. You have to look at long-term drivers. You can have strong growth, as we did in the 1990s, 4% GDP growth with low inflation. But you didn't have a sticky inflation problem in the 1990s. Inflation from the get-go slowed through pretty much throughout the cycle until Chair Greenspan eased too aggressively in 1998. And I would argue the Fed eased too aggressively in 24, 25, particularly the last 50 basis points was too much, given that the economy was already starting to accelerate. They always seem to make this mistake. So absolutely, I am a believer with strong productivity growth. You can have strong underlying trend in economic activity. But monetary and fiscal policy and bank lending are leading indicators of the path of inflation.
All right.
And right now, I agree, the inflation data are fine, but I don't forecast based on where we are. We try to focus on leading indicators. Steve, to your point on services, look at the ISM Service Price Index. It's still very elevated. It correlates really nicely with the super core measure of the CPI. So I think it's way too complacent to get comfortable with inflation staying low. The bond market is not complacent. Bond yields are 4.70. If this was indeed an environment where the inflationary pressures were tame, why aren't bond yields lower?
Steve, a last word.
It's term. I'm just going to ask her. People say it's term premium, which is growth. And if the economy wants to grow and people want to invest, I don't know. Should the Fed stand in the way of that? It's not entirely clear to me if it's not an inflationary growth that is taxing resources, and to the extent to which the essential resources that are fueling the AI boom are coming from overseas, it's kind of self-correcting, no?
If inflation is indeed still a risk, and to get complacent on inflation of 5 years of having higher than expected inflation, I think it's way too early to get complacent. There is nothing worse for the economy. There's nothing worse for the lower end consumer to have an inflationary backdrop. All you have to do is look at the 70s. All you have to do is look at 2023, 20, and 20 and 24. Yeah. So squashing inflation on a sustained basis should be the goal of the Fed. I think it is the goal of the Fed.
And that chart is the perfect one to have up right now. You can see how we were coming over that bend, 0.2, 0.1 negative, and now
I didn't
popping
change
up again.
Nancy's mind, but she might have changed mine.
I
don't know. I got to rethink a little
You know
bit.
I'm sympathetic to the 3-month annualized, the lower.
I know.
But I have
know.
to,
I might have to rethink. It's okay.
Right. Nancy, thanks. Really appreciate it. Nancy Lazar, Steve, thanks as well.
Pleasure.
While all this was happening, the 10-year Treasury yield has been on the rise over the past month. Let's see if that's bringing in the buyers, because Rick Santelli is here with the results of the 1 p.m. auction today. How'd it go, Rick?
Yes, it went pretty well. I gave it a B as in boy. Let's go through it, shall we? 42 billion 10-year notes. This, of course, doesn't include non-comps and all the other ups and extras that can be included. The yield at this auction, 4.683, which was pretty much exactly where the when issued market was right before bidding ended at 1 Eastern. So B as in boy, if you look at all the metrics, they're all very close, if not slightly better than the 10 auction average. But considering pricing was spot on, I think the best variable was dealers took less than 9%. 10 auction average of dealer takedown is 10%. And the reason that's important, it's because what investors don't want, dealers end up with. I noticed that when we look at the yields right now, we see that they're coming down just a little bit. We're down about 3.5 basis points in a 10-year. And do consider that tomorrow will wrap up $125 billion in Treasury coupon supply with $25 billion 30-year bonds. And I would like to stress the notion that we continue to see downward pressure after CPI as the probabilities at the CME are approaching 40%. And of course, we all know that at one point they were in the 70 percentile. So it certainly seems as though investors listening to the new chairman of the Fed, doing their mental homework, trading markets based on data, and it is what it is. Back to you.
Do you mean by that, Rick, you had no follow-up to Nancy's case just now? You saw that super core, down, 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 and then a pop up.
Listen, we could talk about fundamentals till the cows come home. I could slice and dice it a million different ways. We could argue whether seasonality or just the accuracy of the inflation numbers is correct. We have panels and panels of people working on it. PPI, we can only have a 12-year history because they changed it so dramatically not that long ago. In my opinion, I would like to push all that together in a snowball, and that snowball's called market trading, monitor trading. That's what the Fed will do. They're not going to surprise. And even with our last guest saying that most of the inflation we see really was around prior to this Fed chairman, and much of the increase in interest rates could be directly attributable to what happened on February 28th.
Meaning the start of the Iran war. All right. Rick, thanks. We'll talk about it with our next guest.
Look at a chart. It goes up 45-degree angle on that exact day. And the day before the war, we're under 4%. Okay? So really, I don't think that all of a sudden they woke up on Saturday and decided, wow, we got to start selling. It was the war. And my guess is when the war ends, the inflation we're left with will be AI related. And that really does open up a new chapter.
So you acknowledge there's another. Anyway, like I said, Phil is sitting right here. We're going to talk about it. Not LeBeau, Campo-Reale. Rick, thank you very much. Our next guest is also in the camp that thinks peak inflation is behind us. Phil Campo-Reale is the chief investment strategist at JP Morgan Wealth Management. Phil, it's good to see you again.
Good to see you, Kelly.
All right, jump in here.
Yeah.
The water's warm. I'm very sympathetic to the cases we've been talking about for a long time now, that core inflation was coming down.
Yep.
This report, I think, is worth saying it's not a great data point in that direction, though. There's a few worrisome parts. So what gives you conviction? The peak inflation is behind us. Fed doesn't need to hike in September.
So two things, and they happened in the last 4 trading days, right? That payroll report that we got on Friday as part of this, right? So when the Federal Reserve is sitting in this data-dependent world, a negative payroll report with negative revisions and negative real wage growth doesn't scream to us overheating economy and wage price spiral, right? Which is what they were so worried about a couple of years ago in 2022. And then you look at core inflation this morning. I mean, I just look at core CPI at 2.5%, Kelly. That was exactly where we were pre-Iran. And the Fed hasn't done anything, right? They just patiently waited for this thing to come down, and we'll see what happens with headline CPI, right? Still sitting at 3.4%, so not back to where we were pre-Iran because energy prices were high. But the bottom line is neither the labor market is showing signs of inflation, nor are we seeing any evidence that the increase in energy prices from Iran are feeding into the rest of broader.
The consumer was very resilient during this period.
Yeah.
Even look at Bank of America's data. The low-income consumer, the low-income spending is where we saw accelerations, even throughout the spike in oil prices. Do you think, like Nancy said, there's too much liquidity out there? Let's show some of the S&P leaders again today, maybe the NASDAQ leaders. Nebius is up 28%. CoreWeave, these other, Lumentum was up 8 or 9 last check. There's Coherent. Ciena's up 13. Supermicro, again, that had been a tough stock coming into this. Is there too much liquidity, and are these market signals telling us that as a leading indicator of inflation, there's going to be a problem?
That's to be determined, but that's not why the Federal Reserve would either hike or hold in September. That might be a 2027 issue, but not for the September meeting, probably not even for the December meeting. So still a close call. We still have a couple of data points to go, as Steve was pointing out before the September 16th meeting. But they're not going to hike rates in September because of a CapEx story. They wanted to see, I think, more evidence that the spike in energy prices are feeding into broader goods. And Kelly, we're just not seeing that. Again, 2.5 core CPI is where we were before the war. That's where we are today.
So we can put your investment hat on, which is the hat you're wearing anyway. But as we've been talking a little bit about the data, then you have the market, which has been rip-roaring, incredible. I had a friend the other day go, are we at 7,700 already? I mean, it's if you haven't been watching every day, you might wake up and go, wow, it has been really strong.
Yeah.
Is that going to last? Is there anything here that worries you, or are you getting good confirming signs from some of the earnings last night?
I think the latter, confirming signs. So when I rank things that can kind of keep you up at night, right? It's the Iran war, it's the Federal Reserve either losing independence, like people were talking about after the last press conference, or losing credibility more than independence, or earnings. I think the earnings story, Kelly, is one of the most fundamental stories that you have to then offset all of the emotion that can come from, is this euphoric market trading at all-time highs? We've seen 25 all-time highs this year already. I think we saw 39 last year. I think that this financial condition story that we're in right now, Federal Reserve, again, maybe hiking once, that's already priced in. I don't even know why we would be worried about the rate.
But David Katz was on this program yesterday, and he, while acknowledging the strong earnings growth, that obviously is the underpinning of everything going on here, but he said we often don't see the strongest market stretches at the same time that we're seeing kind of peak level of earnings growth.
Yeah, I think I'd be more worried, though, if the multiples were stretched. So when you look at those Mag 7 versus 493 multiples, that valuation story, we're kind of decade kind of tights on that valuation premium. And I also think, like, if you just look at the SOX index up 19% since July 29th. That SOX index, even like the price to earnings growth, that story, you're still cheaper than the 25-year average. So I think I'd be more worried if the valuation was running ahead, but it's not. It's not keeping up with the earnings growth. And that 5% 10-year Treasury that I think would really make us worried, either driven by Fed credibility or by spiking energy prices, that just seems like a low probability event in the near term, which I think pushes the market to all-time highs.
The other thing that happened at the end of July was 475 on the 10-year. So as we've come down a little bit, that has underpinned what you're talking about. You're still in large cap U.S. growth.
Still in large cap, still like financials. Financials are another big story for us, based on deregulation, loan growth, earnings growth, right? Repurchases. I think financials make a lot of sense for us, along with the tech trade, and along with things like industrials, Kelly, I think this is just a really good time to invest.
You make it seem so easy, you know. Don't overthink it, Phil says. Thank you.
Yes.
Really appreciate it.
Thank
JP Morgan's Phil Kemperelli. Coming up, it's the deal of the day. Bob Iger and Josh Kushner buying a controlling stake in the Los Angeles Lakers at what we are reporting is a $12.5 billion valuation. We'll have the details, the impact on the sports and maybe political landscape next. Plus, former NASDAQ CEO Bob Greifeld, he's back to weigh in on the CME's new compute futures contracts. Look forward to hearing his point of view. The Exchange is back after this. Welcome back. A stunning turn of events in the sports world today as Bob Iger and Jared Kushner's group has announced it's purchasing the Los Angeles Lakers for a record-breaking $12.5 billion. This is just months after the team was pursuing, well, the team, I mean Iger and Kushner, they were pursuing a Las Vegas NBA expansion team. It also comes less than a year after the Lakers were previously sold at a price of $10 billion. With us to discuss is Sal Galatioto. He's the president of Galatioto Sports Partners, which has acted as a financial advisor, underwriter, and agent for more than 135 sports transactions and orchestrated one of the largest deals ever for an NHL team 2 years ago. Sal, it's great to have you here.
It's my pleasure.
There's a few unusual things about this deal, wouldn't you say?
Well, look, I've been doing this since 1995, and I have never seen a team trade in less than a year. So that's unusual in and of itself. The Lakers, as we all know, is an iconic brand. It's incredible. And it's a little unusual that it will be sold without an auction. But the price is very robust. I mean, $12.5 billion, if that's the price that's being reported, is a very strong price. The team was only sold about a year ago for $10 billion, and that reflects the strength, I think, of sports valuations across the leagues in general, and in the NBA in particular. I mean, the level of demand is extraordinary right now.
Sal, you mentioned, and I've heard from people in the industry the same idea, which is it's extremely unusual for a team of this magnitude to be sold without an auction.
Yes, I mean, look, I've never seen it. And like as you said, I've done many transactions. It's usual to have an auction and, to get interested parties in the market, to create competitive tension, to drive price. But that wasn't the case in this one. Still a very strong price. Well over $12 billion is an incredible number. When I started in this business, you could buy an NBA team for $80 million. And people have been telling me since 2002, 2003 that we're in a bubble. And I guess we're not. I mean, I see the valuations continuing to go up.
So do you know where this consortium is getting the money? Because the previous buyer, who was under some federal investigation over his tax issues, that money was said to be coming from the Saudis. Again, I don't know. Do you know in this case who is actually bringing the $12.5 billion to the table?
That I don't know. The deal's just been announced, and look, I mean, Bob Iger is a legendary figure. Josh Kushner is a very successful young entrepreneur. I know they were putting money together to get ahead of the bid in Las Vegas, potentially for an NBA expansion franchise. They must have numerous other investors, I would assume. So, but to give you details about where they're getting the money, that's above my pay grade.
I ask because there are some conspiracy theories about the unusual nature of this. Here's a seller who is under some pressure, selling to the president's son-in-law's brother, if I have that right, and who was now going to be the face of the league. Do you think that buys him some goodwill from those who are currently investigating him?
Oh, that's impossible for me to say. That question is not a sports valuation question or a sports question. That's way beyond my purview.
Understood.
I have no idea.
Understood. So this now being the case, Sal, I guess I don't know if there's any other questions you would have about the deal. It is a $2.5 billion more than it was sold for last year. That was already seen to be a rich valuation. But again, people, they want to sell to whoever they want to sell to. And it looks in this case like Iger and Kushner are not going to pursue a Vegas expansion team. Perhaps, again, this is undeniably a trophy asset, LeBron or no LeBron.
Look, the Lakers are a legendary franchise. I mean, they're one of the top 4 or 5 franchises in sports, not just North American sports. The level of demand right now that we're seeing for sports assets is incredible. As I said, I've been doing this since the mid-90s. I've never seen this kind of demand. We're in the market selling limited partnership stakes in 2 NBA teams right now, in a NASCAR team. We just sold a piece of a Major League Baseball team. We just closed on a very successful capital raise for the A's for their new building in Las Vegas. And I can tell you that the level of demand is not slowing down.
Last question, Sal, do you think if it had gone to an auction, it would have sold for even more?
Look, I'm a big proponent of having auctions always because it creates competitive tension. I would be speculating. Do I think it could have? Maybe. I can give you a firm non-committal on that.
Or maybe someone who could, who could be part of that sales process. No. Sal, really appreciate it. I know, look, it's a busy day, a last-minute story. It's great to talk to you. Thanks for making the time.
My pleasure. Thank you for having me.
Sal Galatioto joining us there. Coming up, cuts to the capital gains tax could be back on the table, at least according to the president. Will the proposal give the GOP a boost or not ahead of the midterms? We'll talk about the details and impact next. President Trump is reportedly considering a push for a capital gains tax cut in hopes of gaining a boost for Republicans in the midterms. Megan Casella joins us from D.C. with the latest. Hi, Megan.
Hey, Kelly. So this came about because National Economic Council Director Kevin Hassett was discussing various ways of cutting capital gains taxes with former NBC Director Larry Kudlow on Fox Business on Tuesday. Hassett said that President Trump is looking for promises to make to voters of what the administration would do if Republicans have power in the future. So he said you could expect a lot more policy between now and the midterms. And Kudlow then replied that he had spoken to the president, and he says the president likes the idea of indexing capital gains taxes to inflation and of a bigger exemption. Now, I asked the White House about this, and a spokesman told me any policy announcements will come from the administration directly. So still some gray area here, but a couple of things to note on the proposal. This is very preliminary, something that the president is considering asking Congress to do. Congress, though, is not likely to tackle something like this ahead of the midterms, especially because the calendar just isn't in their favor. Lawmakers are only in town for about 3 weeks between now and November, and because it's really costly, possibly carrying $1 trillion price tag, according to Yale Budget Lab. Some conservative senators and analysts have argued in the past that Treasury could take some action without Congress to index capital gains to inflation, but that would be on shaky legal grounds and would very quickly, Kelly, end up in the courts.
People have a lot of capital gains because the markets have done well, no doubt a tax cut would have, but then you'd have to sell. And I don't know if anyone wants to sell right now. Right. Megan, thanks. Megan Casella, appreciate it. Let's get to Brandon Gomez now for the CNBC News Update. Brandon?
Hey there, Kelly. The World Health Organization warns Congo's Ebola outbreak could become the deadliest in history, surpassing the West African epidemic from 2014 to 2016 that killed more than 11,000 people. The Congo has recorded over 4,300 cases and 2,000 deaths. Officials say the rare strain has no approved vaccine or treatment, while conflict and misinformation are slowing containment efforts. New Jersey just joined a growing push to curb social media addiction among children. Governor Mikey Sherrill signed a law requiring platforms to give users under 18 maximum privacy settings and limited targeted ads, infinite scrolling, and excessive notifications. At least 20 states have proposed or enacted similar restrictions. And tonight's Powerball jackpot has reached an estimated $1 billion after another drawing produced no grand prize winner. A winner could choose the full amount through a 30-year annuity or take roughly $433 million in cash before taxes. The odds are about 1 in 292 million. I don't know if you're feeling lucky, Kelly.
See, I can't let this pass without comment. Don't do it, people.
I know.
Don't do it.
I
Don't
never
buy
have
the
any
tickets.
luck either.
You know, don't do it. Don't do it. Even if you win, it's a curse. Anyway, Brendan, thanks.
Thanks, Kelly.
Coming up, we'll talk to former NASDAQ CEO Bob Greifeld about the lottery. About AI computing power becoming a tradable asset class. The CME is set to introduce futures contracts, allowing traders to bet on the rental costs of NVIDIA's GPUs. We've got details on that next. Welcome back, and look at shares of NVIDIA up another 3% today. That probably puts them around 20% year-to-date gain territory after their big announcement this week that they are lining up $500 billion in funding commitments to help drive the adoption of compute as an asset class. Does our next guest think this is a good idea? Let's bring in Bob Greifeld, the former NASDAQ CEO, who is the co-founder of Cornerstone Financial Tech Management and a CNBC contributor. Bob, it's great to see you again. What are your thoughts?
Well, I have a few. So one, when you think about it, the stock should go up because in a certain way, they've lessened their risk, right? So they started with a situation where they're providing product to the customer's paying for it. Then they're in the business of vendor financing. They have widened the circle where there's more people involved with this financing. And what I like about it is the third parties involved probably will do a market rate setting in terms of what this this asset should price at. Should it be 11% interest rate, 12, things like that. There are things about it I don't like, but certainly I think from the company's point of view, it's a good thing.
What are the things you don't like about it?
So one, there's more people in the circle and there's points of leverage in every part of the circle. So we don't really know how much leverage is in the system as we go through that. But I also think when we see the risk, I haven't heard people talking about this. We think about LLMs, and they're a phenomenal advance, right, for society. But when they came out with the LLMs, it's obvious they were trying to be effective first and not efficient. So I would think that the compute power required to do a given task in an LLM is going to go down 100-fold. And what always stays with me, when I was in grad school taking, a computer programming class, the professor had us write a program, and we first wrote it, and it really took a supercomputer to run it. And he said, your job, if you want to get an A, you have to make this program run on a TRS-80, a Trash 80, the Radio Shack computer back in the day. And we weren't that talented, but most of us got the ability to take it from a supercomputer use of resources down to a microcomputer. So I think LLMs over the next decade might have a 100-fold decrease in the amount of compute power they require to get a task. That's hard to put in a model when you're lending on equipment over that period of time.
And speaking of the equipment, and some have raised concerns about how valuable can it continue to be. Here's what the CEO of CoreWeave said about that very question on our air earlier.
One of the debates that has followed this industry has been on older generations of GPUs. And what we have, I hope, put to bed here is that those older generations of GPUs are going to have a longer useful life than anyone anticipated. They are going to contract for a longer term, and they are going to contract at a higher price. And we already are seeing that flow through our platform.
And that's something, Bob, that Srini Pajuri of RBC told us yesterday, that these A100s NVIDIA introduced in 2020 are still being used today. So does that help to allay some of those concerns you talked about?
It does. I'm in violent agreement with that. I believe the useful life of these computers will be longer than people were talking about, just a couple months ago. But the two other factors I want to highlight, one is obviously the cost of doing that, running that software will go down dramatically over the next decade. I'm making a prediction, 100-fold decrease. The second thing is LLMs today are strictly about the data center, but each of us have one of these phones in our hand. There's 7.6 billion of them out there. That has a lot of compute power. So over the next decade, you're going to see edge computing be a real play in the AI race. So certainly in the next number of years, we'll see phones come out that are AI native that can do a lot of the LLMs or SLMs, or whatever you want to call it at that point in time, on the device itself. So when I think about lending to data center based, right? Today, it's only game in town. So you have two fundamental drivers over the next decade. The software gets more efficient, reducing dramatically the use of hardware per given operation. And second, the devices in your hand will become an effective compute. There's a lot of computing power in these devices today, and that's going to be nothing but increase in the time to come.
Finally, then, we're probably going to now see, and there have already been these deals in the market. It's not as if it's that new, but the asset-backed finance space, this is kind of what we're talking about. There's everything from, airline lease agreements to, I think, credit card points, and there's lots of different types of things in this category. It has a long track record and so forth. Maybe this is just the sign of the times that compute kind of has a place in the asset-backed finance space. I mean, especially if it's only 2 or 3 year deal backed by rentals. So, I guess the real risk would be if the party on the other side of that defaults. Otherwise, they're probably going to meet their obligations. Maybe it depends, again, if you're going to be an investor, and investors will be pitched on this, retail, pension, institutional, to make sure that the person on the other side is someone that you think is not in danger of failing to make those payments.
Well, let's say the company executes properly. I'm saying, let's say we all have all good actors in the space. The leverage is not an issue. I certainly think the computers can live a long period of time. It's just hard to predict what happens over the next decade. And are those GPUs that are sitting in data centers today, are they as important 10 years from now? I'm giving you 2 reasons why they could maybe not be. One is the compute required for a basic LLM goes down by 100-fold. I would feel pretty strongly that the brilliant programmers can do more than we did in our course back 30 years ago. The second is they're going to have competitors. The competitors are going to be in your hand where you can run a lot of these functions. So if you're lending today on the data center piece, I agree, the computers will last. The question is, the world will change so much over the next decade. So if you're lending for 2 to 3 years, you can kind of see the end point of that. But if you're lending for 7 years, who can predict what this technology is going to be like in 7 years?
All right, finally, are you a lotto player or not?
What's that? I am not.
There's only one right answer to that question. And if you thought launching compute as an asset class was crazy, did you know the CME is launching hockey futures as well?
I am keenly aware of that. And you have to understand, CME is a derivatives exchange, and they can put a derivative on anything, right? They don't actually deal with corn. They deal with something representing corn. So they can certainly deal with an expansive view of the CFTC, which they have today, something related to that. And I think the bigger question, not for today, is when does this kind of investing converge with gambling? And to me, the tip of the spear is not so much the hockey piece, but if you have a same-day option, right? A same-day option, Kelly, right? That day, and it expires either worthless or worth money. How is that investing, and how is that not, different than sports gambling?
I think that is an excellent point. In fact, the very place that we should pick this up, because that is a question hanging over the markets. Bob, it's great to see you as always. Thanks.
Thank you, Kelly.
Bob Greifeld. Coming up, Google. Speaking of strong, powerful phones, they're unveiling their latest lineup of Pixel phones today, and they're showcasing the AI capabilities Bob was just talking about. Of course, it comes ahead of Apple's new phone launch next month. We'll have all those details next. Google is launching a new Pixel phone lineup today. Let's see if I'm going to make the switch. Mackenzie Sagalos has more in New York City. Mackenzie?
Hey, Kelly. So Google's new Pixel lineup includes its latest foldable, sticking with a taller design as Samsung moves toward a shorter, wider shape, similar to what Apple is expected to introduce this year. But overall, Google isn't making dramatic hardware changes. There are upgrades, including a more efficient chip and new camera features, but software is really the headline, making the Pixel 11 a litmus test for whether Gemini intelligence can drive upgrades. Now, the biggest change is Gemini becoming this sort of agentic layer on top of the operating system, working between apps in the background to call a Lyft while it orders dinner for you. Google's devices chief Rick Osterloh telling me exclusively that Google sees its edge over Apple in the Gemini ecosystem, really controlling the model, Android, and the services underneath it. And Google gets to make the case first ahead of Apple's September hardware event.
It's not necessarily the top yet. However, we think that's really going to change as these devices become much more simple to use because of the agentic capabilities. We think that it's going to grow in importance and perhaps someday become the primary way that people use their phones, their laptops, and other devices.
And the scale here is much bigger than Pixel. Android runs 2/3 of smartphones globally, and Gemini already has more than 1 billion monthly users. Kel?
Some of those features are, they sound enticing. The photo selection one, some of the others. So it's a reminder of some of the innovation out there in places other than Apple. There you go. And there's a look at the fold. So wait, Mac, show me real quick. Does it folds open and there's the screen? How does it work?
Yeah. So when you have it closed, you can see the screen here. And then when you open it up, it kind of gives you that widescreen experience. But it's just, I mean, Gemini Intelligence, it does give us a preview of what we're expecting to see with Siri AI. Of course, that will be powered by Gemini. But Rick Osterloh, their devices chief, really talking up some of the more bespoke elements that you'll get through a Gemini Intelligence experience. And of course, Pixel sales not as big as the overall Android ecosystem. So a really large installed base there.
I look at it, I'm like, I don't know if I'd ever, but I also didn't think much of the iPad. So don't listen to me. Mackenzie, thank you very much. Mackenzie Sagalos. Coming up, if your portfolio is running out of steam, you may want to consider adding some energy. That's a hint, and we're not talking fossil fuels or renewables. It's a segment of the market that's seen consistent growth and momentum that our next guest says will continue. You're looking at one of his top picks in the space, up 19% this year. The reveal is next. Move over, tea, coffee, and even iced coffee. The hot new beverage trend is refreshers. If you're not familiar, these are often cold, fruity beverages with a kick of caffeine in them, and it's helped the energy drink category get some new life and a new cohort of female fans. Our next guest has some ideas of how investors can play this trend. Let's bring in Citigroup analyst Filippo Falorni. Filippo, it's great to see you. How did we get here?
Hi, Kelly. Thanks for having me on. Yes, look, we've been long-term bulls on the energy drink category. It's had consistent growth in the US, but more recently, what you're seeing is really a generational shift in caffeine consumption. We did a recent survey of 2,400 US consumers, and what you're seeing is that consumers between the ages of 16 and 24 years old, they're using energy drinks as their primary source of caffeine in 30% of respondents. If you look at coffee, it's only 27%. And that's compared to consumers 50 years old and older, where coffee is 60% of their caffeine consumption. So pretty material generational shift that to us bodes pretty well for the category.
Yeah, I mean, to me, it's a sign of the end times. I respect the choice, but who doesn't want the It's fine. My siblings, everyone's jumped the shark here. So you have some great data that shows new consumers that started energy drinks in the past year, 58% female. And these are high margin drinks, right? Here's what Starbucks was saying. Brian Nichols said, we're seeing the refresher business play a really nice role morning to afternoon. The other officials there are talking about a great quarter, great occasion for the afternoon beverage. You're approaching this more from the packaged goods side. Monster was our mystery chart. Why is Monster a good investment for you? Who else could benefit from this trend?
Absolutely. Monster, look, it's been one of our top picks for many years. Consistent growth both in the US and internationally. Their business is about 60% US, 40% international. In the US, they've done a phenomenal job at taking share from Red Bull, which used to be the market share leader. Now Monster and Red Bull are neck to neck at 35% market share. And internationally, they're distributed by the Coke distribution system. So they have a wide reach in international markets, and they continue to gain share in many markets around the world. So their innovation capabilities are probably some of the best in my coverage. Again, the market share opportunities both in the US and international remains pretty wide.
This is also a stock that's doubled over the past 2 years, outpacing the S&P. The category is putting up 8% annual growth. Keurig Dr. Pepper, are they trying to get in on this?
Yeah, Keurig Dr. Pepper has a growing energy portfolio. So far, it's still pretty small as a percent of the total company, but they're getting to about 9% share. They've built a lot of different brands. Some of them are owned, like Ghost, which they acquired a year and a half ago. And some of them are partner brands like C4, Bloom, and Black Rifle Energy. So right now, they're about 9% market share in the US energy drink category. They continue to grow, but importantly, they're about to separate their business between a coffee company and a beverage company. And the energy drink piece will become a very important driver of the beverage company going forward.
You like Celsius as well. I mean, again, I do say that this is a category I assumed was going to be a trend, kind of a fad, and they found new ways to make it work. And maybe Costco could be a beneficiary. My producer, AJ, walked by and grabbed a Kirkland refresher out of the fridge. He probably has a different term for it, before beginning this show. So they know when they see a strong trend, they're jumping on it too.
Yeah, absolutely. I mean, look, we've seen a lot of different challenger brands. Celsius is probably, over the last 5 years, has been probably the most successful of the challenger brands. They now acquired Alani Nu as well. So they have the Celsius brand and Alani Nu, which skews younger female consumers. They're now going through some transition in distribution from Anheuser-Busch to PepsiCo. So they've had some misexecution from the distribution standpoint, but from a branding standpoint, it really is positioned very well. And you mentioned Kirkland. Private label has never really been able to get significant share within the energy drink category, but obviously Costco has significant reach and significant appeal. So we've seen in our survey increased interest in
I can see why the coffee and tea companies are in this, if this is where people are getting their caffeine now. Filippo, thanks. Filippo Falorni, Power Lunch is up next. Thanks for watching.
Stocks now back to being less than 1% from new record highs. Welcome to Power Lunch, everybody. With Kelly, I am Brian, and a special guest host, our friend Sarat Sethi, managing partner Douglas C. Lane, joining us for the entire hour with real-world ideas just for you. Also happening, inflation easing and a wave of strong tech earnings, reigniting demand for chips and memory, and what energy-producing stocks could produce you some investing energy of their own. The head of Evercore's Power and Utility Research is here.
And we have some key voices to help navigate all of this. Liz Ann Saunders, the chief investment strategist at Schwab, and Torsten Slok, the chief economist at Apollo. They will both be joining us coming up. But first, Sarat, before we dive into all of that, so much, I mean, we haven't talked to you about the NVIDIA deal this week. AI financing, Iran, the latest there of, whatever's going to happen, energy, inflation. So taking all of that in, what do you think is most important for investors to focus on?
Well, I think the AI trade keeps on continuing, and you're seeing kind of now NVIDIA going into really using the credit markets, borrowing, and more as to kind of supporting their key customers. And we saw earnings, strong earnings last night too. So that trade is still going on. What's interesting is when that trade happens, certain sectors kind of fall off. So we need kind of all the sectors or most of the ones to start moving together, but we just haven't seen that at one point. One moves and the other one moves the other way.
Yeah, and so look at the market today and the names that are jumping, which some of them had been under pressure, no doubt, but right. CoreWeave, Supermicro, Nebius is up 27% after earnings. Lumentum is jumping. The memory names, which that had traded been in down a lot from the highs, that's back up 7 or 8%. So what do you do? What does that tell you?
Well, part of that is going to be short covering too, right? Because you did have some of the momentum kind of going against these companies too. But in the meantime, kind of this is, if you own these, you're feeling very happy, but I wouldn't chase them. I kind of look at some of the laggards today and say, hey, healthcare's out, financials are out. Maybe if you wanted to buy some of those in there, or just as they kind of trade down to get some more exposure in there.
Because valuations, they are not rich. We talked about it a bit on Squawk Box this morning. If you look at some of these tech earnings, you could make the case for S&P 500 price to earnings at 20 times, which is historically not high, not low, but anybody with a rational mind could say that's a fairly fair valuation.
Hey, listen, NVIDIA, Google, some of our top holdings. The question is, are these peak earnings? Are we getting closer to peak earnings? And what's the growth rate? What is the second derivative going forward for these earnings for the next 3 to 5 years? That's what the market really cares for.
Well, how do we do this growth rate next year? We got these numbers this year, and we got a comp against these numbers next year. Why am I doing so much of this?
And that's the issue, right? If they don't grow as fast as they have for the last year or the last 24 months, the market then automatically starts discounting it. And we've seen when multiples compress. I mean, hey, we've seen it in healthcare, we've seen it in financials, we've seen it in parts of technology. Look at software companies that have gone down 40 to 65% just on multiple compression, and earnings have not changed. It's just what happens is investor sentiment changes. And if sentiment moves the other way, like it did for memory stocks for a few weeks there, you had, stocks that were up 700% were down 50 to 75%. So we have to be very careful as investors. Make sure that you're allocated properly, but don't chase. And that's when people get into trouble, right? It's when do I kind of say, hey, should I be buying these stocks when they're at their peak or close to it? Or do I kind of nibble in at these levels and then kind of buy more later on? But be diversified, because there are sectors, not just tech, that are trading at very reasonable valuations as well, that have consistent growth rates, recurring revenue. And I think that can do well with interest rates where they are, and other factors with oil where they are, things that could actually dent the economy or slow down kind of the growth rate.
All right, well, let's add a voice to this conversation. Our friend Torsten Slok, he is Apollo's chief economist. Torsten, I would imagine you were pretty happy with that inflation read today.
Absolutely. This is very, very good news for the Fed and for Kevin Walsh and for the 9 members who voted for not raising interest rates at the last meeting, because now we just got a relatively soft inflation print. Core inflation is still 2.5, so it's still above the Fed's 2% target. Headline, of course, is above 3, so that's definitely also above the Fed's target. But at the same time, if you combine that with the employment Friday. Yes, there were some issues with local government hiring and education. There were some issues about the World Cup. But taken together, these things are certainly arguing for that it was a good idea that the Fed did not raise interest rates last week.
Torsten, Nancy Lazar was on last hour, and she suggested that there might be too much liquidity in the system, pointing to, again, some of these AI trades, sports valuation levels, literally money supply, loan growth, demand for loans that we've been seeing. And is all of that a leading indicator for sticky inflation? What do you think?
Well, there is an emerging new line of thought where more people are exactly, as you're saying, Kelly, starting to talk about that maybe we should be looking at measures of credit growth, measures of growth in bank lending, measures of growth in lending in private credit, and measures of growth of lending more broadly, both to consumers and to companies. Those indicators are indeed growing fairly rapidly, but at the same time, what really matters the most for the Fed is indeed the dual mandate, namely inflation and the labor market. And on that front, I still think that the data that we've been getting more recently, especially the two more soft inflation prints, they are giving us a lot of confidence that the Fed may not have to hike rates this year. And therefore, I think the market is wrong at the moment to price in hikes because the economy is actually doing quite well, while at the same time, inflation is gradually drifting down towards the Fed's 2% target.
One source of that inflation, people say, is fiscal spending. And we are getting the latest scorecard right now. Sit tight, guys, for just a second as we go over to Washington. The federal deficit is out with its latest, not reporting itself. The Treasury is out with its latest monthly report on government spending. Megan Casella does have the info. Megan, what can you tell us?
Kelly, that scorecard is here, and it is not looking good. The federal budget deficit continued to grow in July. It's up an adjusted 5% so far this fiscal year compared to last. So now it's at about $1.8 trillion. That is larger than the deficit for all of last year, with 2 months still left to go. Now, for the month of July alone, the deficit came in an adjusted $50 billion larger than last July. So some pretty rapid growth here as spending outpaces revenue. Both of them are at all-time records for the fiscal year to date. Now, among the biggest categories for spending, defense and the military up 6% this fiscal year amid the war with Iran. Spending on interest on the debt is up 15%. Treasury has already spent about $1.2 trillion on interest alone this fiscal year. Now, on the revenue side, corporate taxes are coming in pretty weak, 18% lower so far this fiscal year compared to last. And then there's the tariff angle. Tariff refunds were larger than tariff revenues in July, even with the administration putting new duties in place. So that means on net, tariffs were about an $8 billion drag on the budget for the month of July. Kelly?
Nearly $1.2 trillion in interest on the debt. The fiscal year's not even over. I think we got, is it September? We've got a month or two to go. Megan, thank you very much. Megan Casella, worrisome, terrible. I mean, let's just keep pounding the table about how bad it is, Sarat. And I'm not sure that anything, there's no, the market, it's not really, we were talking to Ed Yardeni about this yesterday. He said he expects a 5% 10-year is pretty normal. There's nothing here that's telling you the market, or I guess the public, has a big problem with this.
Well, I think you see that, but it'll be interesting if and when the bond vigilantes actually wake up. And if that happens, that could scare the market. But the other side of it is you're not really going to have rates come lower. So now you have to kind of put this into your formula and say, hey, rates at 4.5%, 5%. Very different from the last decade when we had rates at 0 to 2%. So how does that affect cap rates in real estate? How does that affect your valuations going forward? And also for, some of the tech stocks also that have future cash flow. So I think as the market kind of socializes this, it'll be interesting to see how valuations fall out.
You can do a lot with that 1.2 trillion, but a lot of it does, to be fair, a lot of it does go to retirees and pension funds. The money is not just thrown out.
No.
Right? I mean, that interest, a lot of it just gets repaid back.
Oh, you mean the interest on the debt?
Yes, the interest.
Goes to who's
that 1 trillion,
yeah.
1.2 trillion, it's not just like, I almost said peed away, but a different word.
It's going to get a little higher as more bonds come due, right? So the rates that we paid on bonds 5, 6, 7 years ago are coming due as well. So that's going to start accumulating by itself as well.
Torsten, you have a quick comment on that?
The issue is that there's just a lot of upward pressure on long yields at the moment. Of course, we just talked about inflation. That's, of course, on its own upward pressure on long-term interest rates. But this fiscal situation is just not going away. And the term premium and all the questions being asked, as we're just debating here, they are indeed very serious issues. And the issue about tariff refunds is absolutely critical, because it used to be this case that there was taxes collected because of higher tariffs. But now, reversely, we're actually seeing, of course, a payout of these tariffs because of the AIPA decision. And that's actually boosting GDP, especially going into the second half of this year. So that's why we now both have that the fiscal situation is getting worse, but we're also giving even more upward pressure on GDP because of the reversal of tariffs now instead getting paid out to corporates rather than getting collected.
All right, Nate, it's true. The tariff reversal is a big deal, and that's hurting the bottom line as the deficit gets worse now, Brian, than it was a year ago.
Yeah, and Torsten, S&P 500 companies are expected to spend more than $1 trillion this year on AI. You say the longer it takes companies to generate ROI, the bigger the downside risk to an economy and this market. And this concentrated AI trade, the 10-year yield sitting near 4.7%. I think this is technically our bond report.
I think so.
It was kind of.
We've done a little bit of it already.
Tucked it right in there. But there it is. We ran the animation. Torsten, your reaction to maybe how AI spending, all of that impacts bonds and the debt market.
Well, the key channel is absolutely issuance by the hyperscalers. The hyperscalers are issuing very long duration debt. And when they issue long duration debt, that happens to also be investment grade, just like treasuries. So now there's suddenly much more competition for dollars that used to go into treasuries that are now instead channeled also into hyperscalers and also into financials, which are also investment grade. So that's why, given there's much more competitive landscape now for investment grade debt, where it used to just mainly be going into US treasuries, that means that not only is there upward pressure on spreads for hyperscalers, but we're also seeing dollars getting sucked out of what normally would have gone into treasuries, instead being placed $600-700 billion into hyperscalers. And that competition is very real. And that is also another factor to add to the list of bullet points of why there's upward pressure on long-term interest rates, namely inflation, the fiscal situation, and hyperscaler issuance. And these three things are the key reasons why 30-year bonds at the moment are way above 5%.
Yeah, almost 5:30 earlier this week. Torsten, thanks. Appreciate you joining us. Torsten Slok of Apollo. Surat, stay with us this hour.
All right, we are just getting started on this hour, and as we tick back toward record stock highs, our investors may be a little too high on big tech. Liz Ann Saunders is here with more on the risk. Plus, Evercore's Nick Amicucci on the power stocks that you may want to buy right now. It's 2:12. We're back right after this. Time now for Power Insider, and while we await publication of our latest issue, here's a sneak peek. Two of your next guests' top energy picks include Bloom Energy with a $350 price target and NRG. Let's find out why and maybe get some more picks as well. Nicholas Amakuchi joining us now. He is Evercore ISI's head of power utilities and clean energy equity research. Surat Sethi, of course, with us the entire hour. Nick, welcome. Good to finally get you on. I'm a little fired up. It's been a long day.
Yes.
We were just talking about that
I
in the
think
commercial.
you need to tell everybody. No, what happened?
A lot of coffee today.
Wow.
None of it decaf. Bloom Energy, NRG. I know you just brought down your price target on NRG.
Yeah.
But you still have about 60% upside. What is about these two names that you really like?
Yeah, well, obviously, I mean, speed to power remains paramount, right? And I think Bloom Energy in particular, right? We kind of view it, Brian, as this is almost the cherry on top of the icing on top of the cake for Bloom Energy. Why? Because speed to power, they're benefiting from that because you need generation and you need it yesterday, right? But when we think about the incremental leg of demand, why are we building all of these large gigascale data centers, right? It's to support inference and reasoning and agentic. And when you think about that leg of demand, that's where Bloom really becomes attractive to us because you don't have noise pollution, you have a limited air permit need, and you don't have the emissions profile of some of these other kind of technologies. So we really get excited about that incremental leg of demand, specifically to Bloom and a company that we cover that reported this morning.
Fair enough. Bloom, big storage company. NRG would be, in many ways, directly the opposite of Bloom Energy, would it not be? NRG, they're in all kinds of stuff, but they're also a giant coal producer, or at least they used to be. I mean, this is just a power production company.
Yeah, no, absolutely. And they, again, power is scarce. We like NRG in particular because of that uprate opportunity, as well as we don't think the market even is pricing in at anything associated with their virtual power plant opportunity. So within the LS Power acquisition that they closed earlier this year, they acquired a company called C-Power, and there is 6 gigawatts of virtual power plant opportunity within that company that addresses that speed to power and that ability to bring additional capacity online
Slightly
quickly.
a non-expert. When you say virtual energy and these, and I under what is going on?
Think of it, Kelly, as squeezing more juice out of the orange, right? We have existing infrastructure in place. Let's leverage that to the tilt before we start to underwrite and build out.
How do you do that?
New,
how do you squeeze more?
Well, there are uprate capabilities. You can transition peaker plants into more baseload type of profiles that then allow you to, again, kind of enhance the existing infrastructure.
And is that what NRG does?
NRG, through their virtual power plant, through the virtual power plant opportunity, has that capability. They are also building new generation. So there's a lot to like.
Is this one of the names you like as well?
No, we don't own it, and it's a very interesting company. It's done well. It's kind of pulled back a little bit too. And one of the things that we kind of struggle with is always the pricing, right? Because as consumers now feel more pricing is coming, and then they kind of blame the data centers on it. So how do companies like NRG get around that? Is it more that they're going to produce to your point, we're going to get more efficient and we'll get more production out of it, but not raise prices? Is it a volume? Because if it comes to pricing and then all of a sudden, you get the states involved, you get the government involved. So how does that happen?
Yeah, well, I think, look, you're going to have price. You're able to ring fence it too, somewhat, right? You're able to allocate it. You know who the off-taker is, who's driving, who's actually going to need that incremental power that you're generating. So you're able to kind of ring fence it and tether it towards them. So you are seeing kind of PPAs associated with particular hyperscalers, right? They are able to underwrite those certain pricing profiles, which is actually very attractive for all of the IPPs, right? Because now you're able to have a predictable cash flow stream that's coming in, as opposed to relying on the merchant
So
generation.
the customer is big tech, not the public. And
Correct.
Yeah.
Correct.
A lot of this is happening in Texas. And I know a lot of people in our audience probably think Texas is kind of like the Wild West. Just do whatever you want. Build some over here, no problem. No. There is a long regulatory backlog in Texas as well. Does that impact your valuation on either of these companies who are both doing projects, a lot of them, or operate in Texas?
Yeah, I mean, look, obviously it's a concern, and you can't fight political headlines, right? But it's well known. We kind of addressed Governor Abbott's commentary early last week, that really kind of had drove NRG shares down right on the back of their earnings. But we do think, look, I mean, you have a batch zero process in place. I mean, when you're
What is that?
It's a regulatory regime in ERCOT specifically that is basically highlighting and allocating batches of generation projects that will be brought online. And so when you're talking about kind of an audit, so to speak, of projects, we have one in place. So it really is kind of, we're not going to fight the headlines. We're not going to fight the political rhetoric. But I do think that ultimately we get into November and December, and these things are largely in the rear view.
They're showing Bloom Energy, which had a tough recent spell, but it's up 13% today. This is fuel cells, right?
Correct.
Which I've always been like, are they or aren't they the future story? Which a little bit more so they are. There's a big role for them to play here. Why do you like it?
Well, again, you think, Kelly, there's an incremental leg of demand that people aren't even pontificating yet. They have the capacity, their operating capacity that we kind of frame it as. Now, they're not currently manufacturing 5 gigawatts per year, but they have that capability, and they can bring on manufacturing capacity faster than they would actually need to deploy those assets and those units. So we think the demand for power is real. The demand for certainty and execution and deployable power, dispatchable power is very real. And we think it fits right into those buckets.
All right. I know, Surratt, you're more in the Exxon show. I mean, is that a space, Nick, you still feel fine about? It's just a difference of kind of, more momentum names versus kind of the steady eddies, that kind of thing?
Yeah, I mean, I would defer to my colleague Steve Richardson on those names particularly, but I think, look, it's kind of a rising tide lifts all boats when it comes to power demand and the need for.
Evercore does like Chevron, Stephen. Needs to write me back.
Yeah.
But this is kind of like.
I can't help you with that one.
No, you could talk to him. Tap on the shoulder.
I could.
What were you going to say?
No, I was going to say like the Chevrons, Exxons are kind of the value cash flow ownership, and this is kind of like the growth option value, because if this works.
Do they have a political issue, though? Do you think this is all just rhetoric that comes from the president? I mean, look what he's tried to do with defense companies. Obviously, he's talked about the price. They want them to lower the gasoline price. Is that all just noise?
For the most part, yeah. I mean, it's going to be kind of making sure that prices don't go up higher than they should, but over time, the oil companies' price will meet the market. You're the oil expert on this. They're going to raise the prices when they have to.
All right.
And my father owned a gas station when I was a child. Not for very long, but my grandfather also owned a gas station. I got a lot of respect for gas station owners. It's mostly families. Oftentimes, big oil doesn't own many gas stations.
Yeah.
It's families that own them, often first-generation Americans. They don't set the price of gasoline. Gasoline may be high because they have to make up for losses on other tanks. I just want to get that out there.
Yeah, that they're
not justifying prices. I'm just saying don't pick on the gas station owner. It's not. I'm sure there are bad people out there, but it's not their fault. I'm just throwing that out. That's just my.
We will take your message to the president.
Seacrest out.
Surratt and Nick. Thank you, Nick Amicucci. Still ahead, AI is back in the driver's seat today, but after June's chipwreck, if we can call it that, is this rally built to last? Liz Ann Saunders weighs in on that next. Let's get back to the markets and some potential risks emerging. Your next guest points out that even though the S&P is near all-time highs, just 4% of its stocks are trading at or above their 52-week highs. Lizanne Saunders is the chief investment strategist at the Schwab Center for Financial Research. Surat Sethi is still with us as well. Lizanne, it's great to see you.
You too.
And we've had this big correction in momentum areas like the memory stocks over the past couple of months. And financials, industrials, I mean, there are other areas that are pushing us towards these highs, right?
Oh, absolutely. And that's just the rotational nature of the market and the churn under the surface. And I think that's the clearer picture that you get about what the market has done versus looking at the index level. And all else equal, I think it's a healthy development. There is much more rotation than is typically seen. And you can measure that through breadth statistics. You can measure that through dispersion on a week-to-week basis at the sector level. And I think that backdrop is likely to persist. We've been saying for a while now that rotation is the new momentum trade. So I think that sticks with us. The latest move, though, a bit back into that AI story space.
We have to talk some healthcare, and not just because Surat is here, but I know he's excited about this. So this is an area often seen as defensive. Others would say underperforming, but it's had some really good outliers lately, and it's kind of getting its mojo back. What would you say about that?
Well, that's one of the 4 sectors on which we have favorable ratings. So we would agree with that. I think that because the earnings profile has been relatively depressed, you start to look at beneficial base effects on a going forward basis. You can't say that about many other sectors where the base effects will start to work in the opposite direction, given just how strong earnings have been across a number of more cyclical sectors. So you've got the valuation impetus and the trajectory of earnings growth impetus behind healthcare, at least in the aggregate.
You want to jump in
here? Yeah, listen, to your point, when you look at kind of the driving factors of the AI trade, the momentum trade, it's funds that are quantitative driven. What will it take, as fundamental investors to get other non-fundamental investors or other people interested in, the sectors like healthcare, financials, the ones you like? We like materials, we like the commodity trade, but it doesn't seem like money flows into these. It's kind of, they use them as source of funds, especially when, days like today or momentum goes. So in your experience, what do you see that can kind of change that as we go forward for long-term kind of investors who are fundamental investors?
I think the channel could be through an increased interest in active investing styles as opposed to passive investing styles. Passive automatically drives you into those mega cap areas. And if passive continues to be all the rage, then you're not going to see that impetus. But for active investors, whether it's individual investors or investors considering more active funds versus passive funds, that's where it gets a little bit intriguing, because it's not necessarily going to be a function of weakness in tech or communication services that drives money into other areas, but just an increasing knowledge of the opportunity cost of not having more diversification, given the stronger performance via this process of rotation that you're seeing in other areas of the market.
Here's a story that made me chuckle. Lizanne, I'm not sure quite what you'd make of it. Norway's wealth fund, its sovereign wealth fund, the biggie, is warning that the top 10 companies in its portfolio now represent 20% of the fund's value. Most of those are in the tech industry. The head of the fund said, quote, "It's chips, 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 chips. We've never seen such concentration before." Apparently, the problem is that any change to their strategy would have to come from Norway's parliament, which is a process that could normally take years. Now, other people, I guess, can just what is it called? You sell and you rebalance. What do you make of this?
Let me also just say that I'm 100% Norwegian. I just got back from Norway on Saturday night.
That's right. We didn't even do that with that in mind.
So, go Norway. Takk for Norge.
Tell Erling Haaland we said hi.
Oh, yeah, no, I talk to him every day. I will. This is an issue because foreign investors, whether it's sovereign wealth funds, big institutions, retail investors, through typically passive approaches, just buying ETFs in the U.S., do see that concentration problem. It depends on the structure and frequency of the rebalancing, whether it's just rebalancing yet staying in that more passive approach or rebalancing that might bring in more active strategies. And remember, when foreigners are investing in, say, U.S. tech in whatever form, or just the U.S. stock market in general, it's a double bet because you've got the currency piece of it too.
Right.
So any weakness that you start to see show up in the stocks, if it's accompanied by a weaker dollar as well, that's a bit of a double headwind for some of that foreign money. And then what I mentioned earlier, the opportunity cost of not being in areas that are getting their day in the sun could cause a little bit of that shift because of just the opportunity cost, not necessarily because you start to see meaningful weakness in the tech and tech adjacent space.
It's Sarat, this is going to sound a little glib, but because I haven't had to manage this kind of money with this much at stake, but there is a positive to them not being able to rebalance, which is they continue to reap the benefits of the performance of these. I'm sure if they could have prudent portfolio diversification would have gotten them out of there at much early price points. Instead, look how well they're doing. So I guess those who've been in the market and seen the other sides of these cycles would say, well, you're trying to avoid the downside that could come. But right now, they've benefited a lot from this.
No, they have. But, the point of chips is today, the S&P, 20% of the S&P is in semiconductors. It's not just we're talking about overall technology. It's semiconductors win there. And if you're, as Lizanne was saying, you're in these index funds or you're in these passive funds, you don't really do a look-through unless you're doing what Norway does. And you're just saying, well, we're diversified across the market. We have all these stocks. But you're really then buying them. And if you're not really diversifying, you're just adding more to those. And then the other sectors that are going to be the smallest part of the market just don't get the
You don't
capital.
think the index will rebalance itself to some extent?
Not if money keeps on flowing in. They just keep on buying the same stocks.
But over time, after they look at what's happened with the memory trade. That was down 40%. It's to some extent from the highs to the lows, and the S&P was making new highs in the meantime.
Well, the equal weighted will rebalance itself, but not what the market weighted, because that'll just get them higher and higher and higher. And then over time, that kind of, unless people kind of come out of it.
Lizanne, you should go back to Norway and
Yes,
tell them you are here to help with these
Why
problems.
don't I go on a research trip on behalf of CNBC, and I'll come back with a lot of juicy information.
And salted herring.
Oh, no. But I did have whale for the first time. Tastes like
My
steak,
tie
not chicken.
is all whales. It's all about whales today.
Lizanne, thank you very much. Lizanne Saunders of the
Good to see you
Schwab
guys.
Center for Financial Research.
All right, meantime, let's go to Brandon Gomez with a CNBC News update.
Hey there, Brian. U.S. Army troops reportedly faced off against Ukrainian drone operators in a military exercise earlier this year and came out on the losing end. The Wall Street Journal reports that during the exercise, Ukrainian drone units easily spotted and defeated U.S. troops and armored vehicles. The operation was part of a semi-annual exercise focused on training for large-scale ground combat operations. Lawyers for Tyler Robinson, who is charged with the murder of conservative activist Charlie Kirk, say he shouldn't be eligible for the death penalty because the shooter hit the intended target and didn't endanger others at the event. That would be a potentially aggravating factor under Utah law that would make it a capital crime. It's just one of several arguments laid forth by the defense in new documents filed with the court. Robinson has yet to enter a plea. And the Associated Press projects former NFL sideline reporter Michelle Tafoya won the Republican Senate primary in Minnesota last night. She'll face progressive Lieutenant Governor Peggy Flanagan in the general election. They're competing to replace retiring Democrat Tina Smith. Brian, sendings back to you.
Brandon, thank you very much. All right, big data, smarter stock picks, a real-time read on your day's biggest movers next.
The chip complex is catching a bid today, software taking a breather, and we have some key names reporting after the bell, like the one on your screen there, Cisco, with some action under the surface. It's up about 3% today. Here with more insight is Bob Sloan. He's the founder of S3 Partners, which provides market data on positioning within stocks and sectors. I can't start with Cisco, though. Do you know where I have to start?
Tell me.
Do you remember what you said the last time that you were on with us at the end of June?
Yes, I do.
You warned about the memory trade.
Yeah.
Do you know what day the memory trade peaked? June 22. So, Bob, as I lean in, what do you? And today we have DRAM rebounding to the tune of 8%. Is that? Can people jump back in there? Are there new areas of leadership? What's going on?
So, SpaceX kind of rules all, and that's the gravity by which everything else is pulled towards. So, yeah, you're seeing a lot of short covering in that, and you're seeing short covering across the board, like in stocks like CoreWeave, et cetera. We're seeing a lot of that.
Let's go back to what you just said. SpaceX rules all. I mean, I thought this was a stock that was set it and forget it. Retail buys it, they put it away. It's a generational thing. You say it's much more important than that.
Yeah, it is. It's a $1.75 trillion dollar IPO. It's the biggest IPO on the planet ever, and everybody owns it, and it affects everything. So you're either a believer or not, and that you either kind of say it rules the world or it doesn't. Mm-hmm. And the amount of short interest bets on SpaceX has gone to $32 billion down to $24 billion in 60 days.
But
we've never seen anything like this. Have you ever seen anything like
He's
that?
cleared out the shorts to that extent, you mean?
Yeah.
Okay, so again, I would say this is an idiosyncratic Elon Musk story. Why is it so important, and what does it tell you about the broader markets?
Well, technology, software, memory, I think certainly SpaceX is probably the frothiest trade ever. It bleeds into other sectors and has an effect, and you're seeing that. When that stock moves, it moves other things along in its wake.
It's wonky, and I don't want to go too deep into it, but like if you look at something like Delta One, which is like a strategy for synthetic baskets of stocks on Wall Street, our retail audience doesn't do it, but hedge funds do it. Tesla used to be the most important stock in the world because it was in all these Delta One option strategies. People hedged against it, right? There's a lot more to a SpaceX and a Tesla, these Musk stocks, right, than just the stock itself.
Sure.
They influence, I think what you're saying, all these weird other things that we never think about.
Well,
I mean, you guys think about them,
but
our viewer at home is probably, what's that?
Is SpaceX a memory stock? Is it a launch stock? What is it? Is it a satellite stock?
AI.
There's so many different things, and that's why it has an effect on so many different sectors.
So Bob, and you just mentioned the short interest has gone down. Stock has kind of rebounded quite a bit.
Yep.
Have the shorts then moved on to other parts of the AI trade, saying, hey, listen, we don't want to mess with SpaceX, okay? Because it's just other things happen. So, you mentioned CoreWeave, you mentioned some of the memory stocks. Is that kind of starting to back, as soon as these things get the momentum, do the shorts start pressing on that area, or are they kind of looking at other areas in the market now?
Well, positioning matters more than just what the short sellers are doing, right? So I think one of the things that we're looking at is what's the ratio of active longs to shorts in things that are adjacent to SpaceX. So, for example, like, Viasat, Planet Systems, those stocks are skewing long. And so those things are, I would say, pro SpaceX on the Elon Musk influence side. And then you have things like Intuitive and AST Space Mobile, which are skewing to the negative side. And because they're seen as being competitive to Elon Musk and SpaceX.
Let me bring this back to Cisco, which is one of these names that is suddenly very exciting again. And it's up a couple percent today. It reports after the bell. But the recent momentum areas of the market have been security, networking, identification, cyber, because these are the areas where AI agent traffic is exploding. The defenses need to be protected, and these stocks are all implicated. What do you see happening with Cisco?
So we have we're not an investment advisor like Surratt is. We're a data company. Having said that, we feed a lot of the institutional investors long interest and short interest data on a daily basis. And one of the ways that they use short interest is a signal to how a stock is going to react in earnings. And Cisco is a classic case in point. You have basically flat short interest when the stock is rising. So you can tell that the momentum and the energy behind the short bets is just not there. And so you can see that after the tape, as it sets up, we have a bullish call on Cisco at the end of the day.
You do.
Yeah,
And then would you say that this is the new leadership area of the market, broadly speaking?
I think it's too early to say that, but the way what we're looking for is our stats and our data and where we see a very clear signal in a setup in an earnings call and where we're going to see a move after earnings given the relationship between our data and the price.
Yeah. And last comment, anything else you want to mention to our audience before you go about, what you see coiled to move one way or the other?
Just look at healthcare. Healthcare, we talked about this a little bit last.
Did you set him up?
No, I did not set him up. We have not talked about this.
No, we have not. Look at healthcare. Healthcare is a crowded trade. The returns have been mediocre. There was just a lot of people looking for a return.
And in other words, they're close to getting frustrated?
Yeah, I think so.
Interesting.
That's a warning.
It's a good contraindicator either.
Like you said, you just provide the data.
Just the
investment
data.
advisors
Just
figure out
the
what to do
data.
with it. Bob, thanks very much today.
Thank you for having me.
Bob Sloan of S3 Partners. And be sure to tune in when Cisco CEO Chuck Robbins joins Squawk on the Street tomorrow morning at 9 a.m. Eastern.
All right, coming up, from Mickey to Magic, former Disney CEO Bob Iger set to become one of the new owners of the Los Angeles Lakers. Talk more about this potential mega deal coming up. It is the possible deal that is shocking the sports world. Former Disney CEO Bob Iger leading a group that is planning to buy the famed LA Lakers for a reported $12.5 billion. Now, if the deal happens, it would mean that current owner Mark Walter and his group could make over $2 billion owning the team for about 1 year. Joining us now is CNBC Media and sports reporter Alex Sherman. I guess my question, Bob Iger is a very successful human being by any measure. 12 billion is a lot of money. Iger didn't found a company. He's a CEO. Where's the money?
Right.
Where's the money coming from?
We don't know. It's funny that you said leading the bid, because we don't know exactly who's leading the bid at this point. In fact, the only two names associated with this are Joshua Kushner and Bob Iger. If I were to guess, I would say Joshua Kushner is probably leading the bid, because to your point, Bob Iger, while very successful, is not a mega billionaire.
Probably not even a billionaire. That's not a thing. I mean, I'd love to be a billionaire, but still, I mean, successful guy, but he didn't found a company. He was a CEO. He got paid a lot of money, but taxes take about half of that. Where's the money coming from?
We don't know yet. And it's not necessarily a red flag that we don't know. Look, any deal, it would take months and months for it to be approved. Money can still come in. This is very similar to what happened with the Boston Celtics sale, where there was an announced price, more than $6 billion. We didn't exactly know where the money was coming from. And then in the end, the money shows up, and I think the money's going to show up here also, because Kushner and Iger have been on the hunt for capital to buy the expansion Vegas
Las
team.
Vegas expansion
team. Which wouldn't have been at a valuation of $12.5 billion, but rumored price, I was seeing $8 billion, maybe even $9 billion for that. So you're going to need a lot of money to buy that team. So one of the questions that we have as reporters is to figure out, well, who have you lined up already, and are those people also coming in with you on this deal? Remember, there is a cap of 30% for private equity for the NBA. So some of that money may be private equity. We know some of it is obviously coming from Joshua Kushner's venture/private equity firm. So that's going to be some chunk of cash there. But they're still going to need a lot more from outside investors. We just don't know those firms or names at this point.
And wasn't there Saudi involvement with Mark Walter's purchase in the first place from last year?
And so there very well may be sovereign money in this deal as well. That is yet another place that you could tap for capital. Yes.
Why do you think he's selling? And why was there no auction process?
Right.
We talked to one of the sports banker last hour. He said he's almost never seen a sale of this magnitude not have an auction process, and didn't rule out that an auction could have brought in more money.
And the biggest question, the one you didn't say there, is why is he selling after less than 1 year? That is unheard of. Now, he is making $2 billion or so. So at one extreme, you could say, well, maybe that's why he's selling. He got this offer, and he said, why not? That's a huge amount of money.
$2 billion
in a short
in
amount
a
of
year.
time.
ESPN is reporting that Iger and whatever approached Walter, that they basically were like, hey, sell us the team. And I wonder if you could make $2 billion less than a year. Why not?
It is possible. That's why he's doing it. But you do need to, I think, especially as reporters, it's our job to point out the fact that there are several insurance companies and Guggenheim Securities, which Mark Walter owns, that are under investigation right now by U.S. prosecutors and the SEC for potential financial impropriety there. There was also a recent article in the Wall Street Journal that was questioning Mark Walter's health. So there are some unanswered questions here, and we won't know the answers to that until either we do more reporting or we hear from Mark Walter about exactly why he's selling the team.
Or if we see that the proceeds are going to pay down, fines or whatever.
Then at least you could have a guess about why he might be selling, and only selling the Lakers rather than his whole sports portfolio, which is the case right now. He owns the Dodgers. He owns the Sparks, the WNBA team. He has an interest in the Cadillac F1 team.
Yeah, he owns the Cadillac
Chelsea
F1
FC.
team. He owns Andretti Autosport.
Wow.
And IMSA as well. He's like, TWG Group is like the king of
Well, I
cars.
guess if you've ever wanted the Dodgers, for instance, now might be a time.
Maybe you should pick up the phone and call, just like apparently
they did.
Josh Kushner and Bob Iger did. Exactly.
Alex, thanks.
Thank
Alex
you.
Sherman. We appreciate it. More Power Lunch right after the break. A lot of chatter lately on the growth stocks in this market. Surat's got a couple of names that you've been adding to because you think they are just too cheap.
On a cash flow and a fundamental basis, these are companies that I think you want to own, like Disney, for example. We're talking about Iger, 14 times earnings.
Disney is one of the stocks?
Disney's one of the stocks.
They're at 14 times.
14 times earnings. They just came out with very strong earnings. They've got a new leader. You don't have the overhang anymore. Their theme parks are doing really well. Streaming is doing really well. Buying back shares, increasing their dividend. But at this point, if you think about the overhang on the media sector, including their parent company at Comcast, there's just
no longer our parent company, by the way. But I saw Charter today. That one's selling off. The other name that you like has nothing to do with Disney, but the area you've been talking about this hour, which is healthcare.
Which is healthcare. And if you look at a company like Stryker, there's orthopedics.
Ted Stryker?
So, you know, it's got knees, shoulders. I mean, fundamentally growth as our demographic gets bigger. Stryker had an issue with their cybersecurity that they're resolving. It's a fantastic management team and a good growth rate. Again, out of favor, trading at 20% of a multiple it had literally 6 months ago.
People need knees.
Exactly.
But all they want to do is buy Micron.
Yeah, maybe the chips go in the knees then.
Do you have any thoughts about the kind of memory trade being back in the... It's popping today. You saw those results last night.
It is popping today, and part of that will be short covering, and part of that will be the earnings that came out. And again, it'll be fundamental investing. And look, we own semiconductors. I have no issues with owning growth, but you got to diversify.
NVIDIA up 3%. Surat, it's been a pleasure. Thank you, Surat Sethi. Thanks for watching Power Lunch. Closing bell starts right now.
Thanks so much, guys. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with a big sigh of inflation relief today as today's CPI matches expectations. Rate hike fears move a little lower right along with yields today. Stocks, as you might expect, they are green. To the scorecard we go with 60 to go in regulation. The CPI, just one catalyst today. CoreWeave's blowout earnings report was another, and that has tech leading the way today. Look at that stock up near 19%. Take a look at Supermicro. It's higher as well after its own earnings report, and that's even better, near 20%. Outside of tech, we're watching Kava today. It had a beat. Its guide was pretty good. The stock's up 15%. It does take us to our talk of the tape. The road ahead for stocks with targets and optimism both climbing. Let's welcome in our panel. FundStrat's Tom Lee, Robinhood Stephanie Guild, and Payne Capital's Courtney Garcia. Tom and Courtney are CNBC contributors. Welcome, everybody. It's good to have you, Tom. This was just what the doctor ordered, right?
It is. We got a nice CPI report, and in the backdrop of good earnings, stocks going up on good news. I think the rally is quite healthy, and it's tracking to our view that we could get to 7,900, 8,000 by the end of the month.
Well, that's what your call was, the other day. Ed Yardeni says we're now tracking so well that we can get to 8,400 by the end of the year because of the earnings story that we keep talking about. Does that make sense to you?
Yeah, I think that is sort of the underpinning of this, because 2027 earnings, probably 410 right now. It was around 395 at the start of earnings season, and it's probably going to be, by the end of this month, close to 425. And so if you put a 20 multiple on that, you're already close to 9,000.
So we keep saying that you've been bullish. You've been right. But you keep calling for this maybe 10% pullback in stocks at some point. Now, we haven't gotten it yet. And you lay out today in a note that says, quote, positive drivers for stocks in the near term remain good AI fundamental demand, right? Strengthening U.S. economy, positive revisions to earnings, and the fact that inflation remains tamer than most expect. Those don't sound like catalysts for a 10% pullback. So what is?
Well, I think pullbacks occur when we're least expecting it, and usually when investors are bullish. So I think the end of August, getting to 8,000 is going to set us up for a period where stocks could disappoint, even though underlying fundamentals are good. And part of it is the margin debt's gotten so big. Part of it is we still haven't resolved how the market views Kevin Warsh and his new framework, whether the bond market's going to have a tantrum. And the third is we have midterms coming up, and I think that's a source of uncertainty. And finally, I do think SpaceX, which had an initial unlock, there's still a lot of stock to be unlocked. So I think all of that represents potential traps ahead.
Okay. Steph, what do you think about that?
I
I mean, I agree that, typically like when you have a period where a hedge fund, for example, blows up, it's a sign that there can be just easy credit conditions and leverage builds up. I think that kind of cleared, but I think we're going to have another one. I just think in this environment where AI is driving things, you end up having like almost speed crashes. I've heard Jordi Visser from 22B say, and I agree with that because I think you have parabolic moves and then kind of consolidations. I also think interest rates are certainly a risk that could keep flaring up. But I also agree that there's strong fundamentals. So I think that's going to be a fight within the market.
The resiliency of the market has been amazing in the face of what you've described, a hedge fund blowing up, yields backing up. But aren't we a little cleaner now in a number of ways, right? You get a little bit of heat off of the inflation picture, and the positioning is cleaner, and we've delevered a little bit. Tom's right. There's still a fair amount of, leverage in the system, margin debt and whatever, but feels like we've cleaned some stuff up.
But I think with a rally continues and then you start rebuilding that, and that's why I say like you could end up having another kind of pullback because the margin, the debt rebuilds.
Court, are people too bullish?
I don't think so. And I think ultimately the markets are being driven by earnings right now, and the earnings are justifying what the markets are doing. People were getting concerned about CapEx spending, but I think the more that you see these earnings come out, it really is justifying that. And I think when you look at the markets as a whole, if you look at the last 3 months, the things that are leading are healthcare, financials, industrials. Those are all actually outperforming the S&P 500, which means you're seeing this really broad-based rally. There's no longer just 7 names that are holding up the markets. And the fact that even in days where AI is driving the story, you're seeing everything participate. I really like that as a good story. And if earnings keep holding up and the consumer keeps holding up, I think the markets will continue to drive higher.
I'm glad you went there, because if you look at the, let's call it the balance over the last 30 days. So 1 month performance, financials, almost 4%. Technology, 3.25%. Industrials, 2.5%. Healthcare, 4 2/3. Materials, better than 3%. This is just what people were hoping for, isn't it?
Yeah, it's broad-based. I think this is a sign, and of course, as you know, global markets are doing well, and there's still several $1 trillion of cash on the sidelines. And I think that there's still a pretty level of healthy skepticism, because I think a lot of clients of ours, institutional, think either the AI trade is extended or that we're in late cycle on earnings.
It's like an earnings bubble that's about to burst at some point.
Correct. And then, of course, they think the Fed has to react to that by tightening. So I think that there's people who are sort of keeping an eye on the end of the bull market, and I think that's what's keeping it healthy.
I think I corroborate with that, because if you look at like valuations have actually come down by 2 turns, but earnings growth have more than doubled since the end of March. And so I do think there's a healthy, that to me is the numbers behind the skepticism. And I welcome skepticism, because I actually think it means that the bull market can go on for a bit longer. And so that's kind of like 1998 after LTCM, like the market went up for another 18 months and 35%.
I mean, sentiment indicators are kind of off the charts. Right. I mean, you have now what I've been saying, 8,000 feels like it's the floor in many people's minds, because they keep raising their targets. Ed Yardeni obviously is the latest example of that. Now he's the highest at 8,400.
Yeah, and actually, I want to echo what Tom's saying here, where you're talking to institutional clients, and we're actually in my firm talking to retail clients, and I think we're hearing the same thing. I think people are a little worried that, things have done so well, when is the next shoe to drop kind of a thing? And that actually, I think, is a good sign. You're not seeing this euphoria, at least we're not seeing that like on the boots on the ground, which I think is good. That's more when I get nervous that there's a top in the market, and we're not seeing that right now.
What's the retail psychology feel like?
I mean, the same. You can see that they pulled back on net buying sort of at the end of July into, kind of the time that I think you saw some wealth go away in some of the names that they were owning. But they've come back in and they're buying SpaceX, they're buying SanDisk, they're buying AMD, Micron, the names that pulled back.
But that's an interesting signal in and of itself, that, they're waiting for a pullback. Yeah. They got it in the momentum trade, and now they're once again looking to put money to work because they're still believers in the bull market.
They bought the dip. They didn't get that scared off with the pullback we had.
Does that surprise you, Tom, or is that the way it's going to be?
Well, I think that, in retrospect, we know that from 2009 to like 2020, it was a period of a bubble and skepticism about stocks. So we're 6 years into growing optimism. So I think this could last for quite a long time.
Especially if their earnings, I think what's now being told, obviously, and understood, I think, a little bit better, is the broadening of the earnings story.
Yes.
The market isn't just broadening from a sector perspective. Earnings are actually broadening to the point where the average sector is up 14% earnings growth. So yes, while the technology numbers are huge, a lot of other things are participating too. That's as much the story as this, reopening of the tech trade.
That's right. And I think maybe just to help those who are worried about interest rates, since 1900, when interest rates move from 4 to 6%, it's associated with rising PE multiple. So I think as we get towards 4, 6, even 5, I think PEs can expand, but then at 6% is when it starts to hurt multiples.
I mean, if you look at, let's just say the 30 years been backing up, really ever since Kevin Warsh was giving Fed Chair Kevin Warsh was giving his news conference. We saw the 30-year hit 520. It's been sitting now above that at 524. Some people say that right there and the rest of the curve, that's the biggest risk to stocks.
I mean, to an extent, because right now, interest rates don't tell us why they're moving, so we just know the level. Part of this is a bit of a, Kevin Warsh tantrum because he wants to move away from guidance. Part of it is inflation derangement syndrome, which I think is quelling because these CPI reports are tame. And then part of it is
the supply.
That's right, and there's huge deficits. But part of this could be that as markets start to price those things, actually yields could start to come down, especially if inflation cools. So I think in some ways I'm not alarmed at 524, even though it's a big level.
Can we get a September hike out of our heads now? Did today just sort of take that off the table?
It's probably off the table, but I don't think a hike in the next 6 months is off the table, because I think if growth continues, you want to have something that shows they're willing to keep it under wraps at some level.
How do you feel about what the Fed may do? Jackson Hole's coming up in 2.5 weeks. Mm-hmm. That's going to be a seminal moment for the new Fed chair, and we'll further game out what we think is going to happen in September.
It is, and we're also going to get more data between now and September, and I think that's what's really going to be telling here. But I think really when you look at this, if the Fed is going to raise interest rates, obviously that would be something that the markets aren't going to like to see. But I don't think necessarily that we're going to see that right now. You're seeing about 40% odds right now that the Fed's actually going to raise in next month. But ultimately, it's where that data is coming from. And I don't think that at this point in time, it's a huge concern for the markets. I think a bigger concern, to your point, is the longer end of the curve, which arguably probably is growth expectations coming in there. And the fact that when you're seeing all of this reshoring, you're seeing this AI infrastructure reinvestment, a lot of that is going to lead to longer term growth. And I think that's really the story the longer end of the curve is telling us right now.
You don't think the Fed's going to hike this year, do you?
No. In fact, I think if they hike, it would actually probably hurt Fed credibility, in my opinion, because
it would hurt it.
Yeah.
Some people say it would help it.
Opposite, yeah.
Well, the reason people are saying that is because they want him to establish that he is not a White House doing their bidding, but I think it actually hurts credibility because, one, it'll confuse people. Is the Fed just taking back a cut, or is the Fed engaging in a hiking cycle? I think it's actually more confusing if they start hiking.
Interesting. Well, we'll see. We'll see what he says in Jackson Hole. I think one of the big stories of the day clearly today is that the AI bulls are getting a lot of love because of a slate of strong earnings, giving that trade a bit of validation, if you will. Christina Partsenevelos is tracking that action for us and joins us now. What do you see?
Yeah, the names validating that. Foxconn, Momentum, CoreWeave, Nebius, Supermicro all delivered after a brutal July sell-off. The message seems to be pretty consistent among all these names. The world is still short on compute, and specifically GPU pricing just keeps climbing. So CoreWeave, you can see, is popping, almost 20% after its best quarter as a public company, raising guidance across the board. Backlog came in below the Whisper numbers, but it signed another $25 billion in deals right after the quarter closed. The catch, though, for CoreWeave and even Nebius is just debt. Ballooning interest bill is really keeping CoreWeave in a net loss even as the business scales. Nebius, on the other hand, speaking of pricing, put it bluntly, saying as fast as it brings capacity online, it can sell it with several buyers for every GPU. So pricing power is driving this trade. Also echoes CoreWeave and NVIDIA CEOs recently who speak to the longevity of GPUs. The fact that you can rent them out 6 to 10 years later. later. Then Supermicro, with its best gross margins in over 3 years and a record $60 billion in new orders. Supermicro, by the way, is an AI assembler. They guided next year's revenue to about 75% through margins, though margins did step down from here as lower margin GPU servers did fill the mix. You can see shares also almost 20%. And then after a tough July demand, we can see from these names still outrunning supply, and that is exactly what the AI bulls needed today. Scott.
Christina, thank you. Christina Partsinevelos, another group getting a bump, I think, off of some of what Christina's talking about, the AI power names. On the back of some of those results, Pippa Stevens following that for us. Hi.
That's right, Scott. So the picks and shovels of the AI trade, that's names like Vertiv, Quanta Services, Mastech, GE, Vernova, and Eaton, all in the green, building on big gains this year as the data center capex continues to balloon. And we are seeing growing backlash, including now in Texas, which previously had a more friendly regulatory environment. But there's no question we will see more data centers, which will benefit these infrastructure players. Now, we've also seen underperformance from independent power producers like Constellation and Vistra, seemingly pointing to the picks and shovels trade perceived as a safer secondary AI theme, especially as hyperscalers increasingly look to secure their own power. Quanta Services reporting a record backlog in its latest quarter as data center momentum continues to build, though some analysts pointing to now seemingly stretched valuations. A new report from JP Morgan also showing record orders for gas turbines to power AI, up more than 70% on the year. GE Vernova, a big player there alongside names like Siemens and Mitsubishi. Scott?
All right, Pippa, thank you very much for that. That's Pippa Stevens. So let's talk about tech. Bespoke out today. Tech reigns supreme in one of the best earnings season ever. Out of every 100 tech stocks that have reported, 85 of them have beaten EPS estimates. That's why this trades back in a big way, right?
Yeah, I mean, that's a huge percentage of beats too, right? We normally would expect 65 to 70% in any quarter.
Even for tech?
Even for tech, yeah.
How long can it keep that up?
I think the reality is that because supply is going to take a while to come, I think, and there is going to be a supply response. Scott, it could be easily through the rest of this year and early next year.
You agree with that?
Yeah, I do. I mean, I still think there's going to be times when expectations will get a little past what you can tell, and we'll go through periods of quiet periods, and that kind of gets people spooked. But we have allocations like this in our own Robinhood Strategies portfolios. We bought a bunch of stuff at the end of July to take advantage of the pullback, but we sold some stuff in June because you have to watch those things like kind of oscillating between.
But what you were saying earlier sort of validates what others are seeing from an institutional standpoint too. This idea of putting more capital to work within tech. You said your clients at Robinhood were buying some of the chip names, obviously. The SpaceXs of the world as they pulled back. According to Bank of America and their client flow trends, tech was the second biggest inflow week ever. So people are looking to buy the dip. I don't care if they're institutions that have, degrossed a little bit. Retail had lightened up to a point where they were ready to go back in.
I mean, you can tell, like, again, when it becomes a crowded trade, that's when I think things can get a little bit cumbersome, and that's what happened, I think, in the month of July, and we had that washing out. I think we'll hit pockets like that in the future, but I still think it's a good long-term trade. You just have to be able to bear that higher volatility.
How are we feeling about the tech trade right now?
We still want to own the tech trade. I mean, as you're saying with all of these earnings coming out, I think this is going to continue to be a story.
Oh, overweight? I know you want to own it.
We're not overweight. No, I mean, if
overweight.
anything, over the last several years, it's done so well that we're making sure that we're maintaining exposure. But even this year, it has not been your best performer. And I think this is a good reminder of why you want to own a little bit of everything in here. Because look at this secondary trade. We're talking about the picks and shovels here. But regardless of if these hyperscalers can justify the CapEx spend, the AI infrastructure has to get built. The demand is there. So when you're looking at the energy plays, the infrastructure plays, just like this broadening out of all of the less obvious AI companies who are going to benefit from that, I think that's going to continue to happen. So you want to make sure you're owning everything here because I think that broadening continues.
All right, we'll leave it there. Guys, thanks so much for being here. I appreciate it
Thank you.
very much. We're just getting started here. Coming up next, the basketball bombshell. The Lakers changing hands yet again. Bob Iger, Josh Kushner striking a record-breaking deal for one of professional sports' most iconic franchises. We have details on that developing story straight ahead. All right, we're back on the bell. Stunning news today from the sports world. The Los Angeles Lakers sold by Mark Walter to former Disney CEO Bob Iger and venture capitalist Josh Kushner for a reported $12.5 billion. Remarkable in that Mr. Walter bought a majority stake in the franchise less than 1 year ago for $10 billion. CNBC Sports' Alex Sherman's been following this story all day long and joins us with more. Look, a lot of people are still trying to get their arms around the entirety of this story, and unfortunately, we may not be able to for a little while.
Well, we're starting to get maybe our first hints of what's going on here. And again, we don't know this for sure because Mark Walter has not said anything, but both Bloomberg and the Financial Times are now reporting that there are insurance companies within sort of the holding company of TWG Global that Mark Walter owns that are rushing for capital to, in essence, pay off certain assets that they owned so that these particular assets don't have a credit rating downgrade. And so there's sort of a rush for capital among some of these assets. That may be the triggering factor here in why Mark Walter suddenly needed to sell the LA Lakers after owning it for less than a year. Again, we don't know this for sure yet, but at least it's the first hint of something that may be going on behind the scenes with other assets that Walter owns that may explain the sale. Now, of course, if in fact that is what's going on, the next logical question is, well, does he need to sell anything else? Does he need to sell the Dodgers? Does he need to sell his stake in Chelsea? I mean, those are the questions I think that people are going to start to ask Mark Walter or people around Mark Walter if in fact that's what's going on. But again, we don't know this for sure. It could be as simple as he was approached with a bid and he decided that he wanted to make a quick buck, and there was a $2.5 billion profit that he made in less than a year. That's also still possible.
It's also my understanding that, and to your point, we don't know if there will be anything related to the Dodgers, but it would be, I'm told, more difficult to do that because of the degree of partners that are involved with that franchise relative to his majority stake in the Lakers. That's one thing. We talked earlier today, and I'd like you to give more insight on this, idea of the ease at which an NBA franchise can trade quickly relative to, say, an NFL franchise where the majority owner has to be 30% liquid. The regulations around private equity are more stringent. You're not allowed to have any sovereign wealth involved. You can't have a private company own a team. You go down the list, and it's just much more punitive, I think, in the process of trying to buy an NFL franchise, even at lofty levels, than it is, as we're learning today, an NBA team as prestigious as even the Lakers are.
Yeah, look, if Walter needs the money quickly, I suppose he lucked out by buying an NBA franchise rather than an NFL team, because you're absolutely right. It's easier to get a consortium of capital together to afford even a lofty valuation because the private equity limit is 30% for an NBA team as opposed to 10% for an NFL team. So that allows you to get more institutional capital in order to up the bid. And again, in this case, at a valuation for the majority stake of the Lakers at $12.5 billion. That is a record price. It seems like each one of these deals we get in both the NBA and the NFL are record prices, but here's yet another one. The Walter owns more than a 70% stake in the Lakers. So at a $12.5 billion valuation, you can do the math. It's obviously somewhere in the, let's say $10 billion range or whatever it may be.
How are you getting your head around the idea of that valuations just continue to go to the moon? And this is obviously the latest example, but the other most recent one would be the Seahawks sale to Vinod Khosla for near $10 billion. And the next NFL franchise that trades after that, whenever it does, will presumably go for a lot more than that.
Well, there's sort of two reasons that are trickling around in people's minds these days. One is, and this was somewhat of the motivation for the Seahawks trade, it's the anti-AI play, right? It's like this is AI proof. We know that live events are more popular than ever, particularly coming off COVID. They just get more and more popular. Sports ratings are up across the board and sometimes up significantly. So that's one reason. Then the other reason is there continue to be, it's related to the ratings, but there continue to be more and more money that's pumped into media rights. And the NFL is going to come up on their next media rights deal in a couple of years. And for sure, they will be making a lot more money from their media partners than they're already making. The last deal they signed was in 2021. That was a $100 billion deal. They're going to be looking for an increase of, say, could be 50% more, maybe even more than that, depending on how they can convince the various different media partners out there to pay up for their package of games. So that's obviously a bullish sign for all of these different NFL teams, and yet another reason why the valuations continue to soar.
Yet another example as well as to how sports is now the hottest asset class around. And you just said the other day about the Bezos interest in Liverpool of the Premier League in the UK.
Yep, right. We have not seen the wealthiest people in the world invest in majority stakes in sports teams. And yet again, even here, Bob Iger is not one of these uber wealthy people, even though he's in on this transaction. Even Joshua Kushner is not one of the wealthiest people in the world. But maybe we are moving toward a time where we will see a Michael Dell or a Jeff Bezos actually buy a majority stake in one of these teams. Again, we haven't seen that. I speculated reasons why the other day. Perhaps they don't want the public scrutiny of it. But look, it may be that if all of a sudden these sports teams are on a rocket ship up because of this sort of anti-AI hedge, that we do in fact see one of these big tech investors finally invest in a majority stake where they are the majority controlling owner of a major sports team.
Yeah, because people are always looking over their shoulders. They were when the Seahawks came up. They're like, well, Bezos seems a natural. Obviously wasn't. And we'll see down the road. Good stuff. Thank you, Alex Sherman. All right, up next, Renaissance Macro's Jeff DeGraff. On the one sector he sees breaking out right now, he'll tell you what it is when we come back. Welcome back. Top technicians are pointing to a breakout in one sector of the market investors should have their eyes on. Jeff DeGraff, he's chairman and head of technical research at Renaissance Macro. He joins us now. It's good to have you back. Welcome.
Thanks, Scott. Good to see you.
This is healthcare, right?
Yeah, healthcare looks really good to us. It tends to be a beneficiary of some turbulence in technology, so I think it fits the bill. But look, it's been a long time. It's been an underperformer. It's had negative alpha for a long, long time, and finally we're starting to see relative performance pick up. So I think there's good news there. It was led by biotech and pharma, and now we're starting to see it in life science and some of the service names.
I mean, it's the best group over the last 3 months, but over the last month it had a bit of a sleepy time, but you're suggesting that the charts say this is a reawakening, if you will, because others are mentioning that too, that it's primed.
Yeah, look, I mean, again, it was such an underperformer for such a long period of time. You finally are getting breakouts, but important to us is that the relative performance is improving, right? So it's not just the stocks are moving up, they're actually outperforming the rest of the market, and that's usually a sign of burgeoning leadership. So I like what we're seeing there.
What about market at large? You know, I keep saying targets keep going up. We had another one today from Ed Yardeni. He's been doing this a long time. Says we are, because of what's happening with earnings, we're in a bullish takeoff, essentially.
Yeah, you've got a trending market. Look, I mean, you're not going to hear us fight about a market that's trading at a new high. I mean, that's just bad policy, you know, historically. I would say the breadth is confirming, which is good news. So the trends are there. What's interesting is the deficiency, and this is a bit of a nit, so I don't want to make it, you know, too caustic. But the 20-day highs have been really pretty anemic. They've been running in the kind of mid-teens, and you'd expect a market that's making a new high to be in the 30, 40+% 20-day highs. So it really belies the rotational aspect of this. That's not bad. It just it says there's a broadening out, but we would like to see, just for kind of the duration and durability, we'd like to see a little bit more momentum in this. But yeah, the trends are positive and breadth is confirming, and that's usually good enough.
By momentum, are you talking in both time and price? Because I'm looking at, say, 1 month of all these different sectors. Financials are up near 4%, tech's up better than 3%, industrials are right there, healthcare's up near 5%, materials are up more than 3%.
So for us, it's how many or what percentage of names are making 20-day highs, right? Which isn't a big bar or a high bar to clear. And you want to see a collection of those names do that on a daily or weekly basis. And again, it's this week it's materials. Last week it might have been healthcare. And again, that's fine. But we'd like to see kind of this surge in 20-day highs, because that means money generally is coming back to the market broadly, more wholesale. So this is still a little bit more selective, the way people are playing it. Again, I don't want to make it sound bearish, but to give us kind of like, hey, we're good for the next 6 months, don't worry about a 10% correction, we need to see those kind of numbers start to stick on 20-day highs. But between here and there, we're in a good spot from a trend perspective.
Forgive me, I didn't mean to step on your toes there. Gold, you say it's overbought. Tell me quickly why.
Very, very short term. We had a bubble signal in this back in October. It peaked out in January. It's been underwater for a long time. It's had a recent surge and it's gotten overbought. The trends haven't changed yet. I actually think it's building a base, so I think it's more good news than not. Tactically, I wouldn't be buying it right here, but as it consolidates, as it comes in, and as it weakens, I think you want to start building positions for a resumption of the uptrend that just got ahead of itself about this time last year.
Good stuff as always. We'll talk to you soon, Jeff. Thanks.
Sounds good, Scott. Thank you.
That's Jeff DeGraff. Coming up, top wealth advisor Sherry Paul's back. She'll tell us what she's telling her clients to do with stocks hovering near all-time highs. We're back after this. We're back. Stocks getting some relief from that inflation report today, but several other economic measures are looming this week. Sherry Paul is a top private wealth manager for Morgan Stanley, joins us back at Post 9. It's nice to see you.
You too.
Sat down and you just said we're going to help people today.
Yeah, we are.
Help them make money.
Yep.
You've been doing a good job at that. What do we do today with this market?
Well, if you're not invested in it, you should be putting together your portfolio strategy and definitely own equities and ladder in some fixed income and own a little bit of the commodity market and understand that we're in a super cycle and not get too caught up in a FOMO moment if you haven't already been included in this outcome.
I was reading this Wall Street Journal story today about all this cash that's sitting around on the sideline. You think you think there's too much cash on the sideline that it needs to be put to work, whether it's in stocks or bonds or both or whatever?
Yeah. So, you know what gets me out of bed in the morning is helping people make money, okay, and then helping them self-actualize in their lives with their money. And the thing that keeps me up at night is watching people stall out because they get into an analysis paralysis. And there's so much information right now coming at people that has no bearing on really what the trend is telling us, and that people are stalling out. So, yeah, I think there's too much cash. You look at, the inflation numbers and you look at the opportunity set in terms of the CapEx spending. We have a blowout earnings. We got the big, beautiful bill. We have some political things to get through in the fall, but beyond that, people should be invested.
Where do you like most right now in the market?
Well, I mean, I think a core staple now is in tech. We've talked a lot about this in terms of the subsectors, cybersecurity and cloud. Obviously, the chip sector, which is now, interestingly enough, being debated as potentially a new asset class, which I think is a seismic shift in terms of the financial market. Innovating in terms of how to fund this build out, and then obviously the financial services themselves.
So let's go to chips real quick first.
Yeah.
When you say it's a seismic shift, I know what you're referring to, but then can we make the leap and say it's seismic enough that was a cyclical area of the market traditionally is now more secular because of the very historic build out you're talking about?
I don't think so. I mean, I think that we just look at this as a form of like, where is the CapEx spending now going to occur? And if it's now, there's a possibility it comes off balance sheet. That was the big worry a month ago or two ago when people were talking about the debt ratios on corporate balance sheets, borrowing to build out AI. And now if they're able to offshore that into a new financial structure, that changes everything in my mind, especially when it comes to earnings.
Earnings are broadening out.
Yeah.
I mean, that has to be a principal part of your bullishness, right? I mean, that's why Ed Yardeni goes to 42.50 today. I'm sorry, not 42.50. 84.20.
I was going to say that feels a little like, I don't know, 5 years.
84.50, I think.
Yeah, absolutely.
My head's spinning with too many numbers. I say too many of these numbers too often.
Well, you know what's funny is that's what's happening to investors. Their heads are spinning over the numbers, and what we want to do is give them actionable ideas that they can actually put their money to work instead of sitting in the conversation or the debate.
The fact that we're so balanced over the last month, more so than we've been. I just read off to Jeff DeGraff, who's a technician who looks at the market. The balance in sector performance is pretty astounding, really, what people have been clamoring for.
Yeah.
Does that continue?
I think so, because I think now we're in the next phase of this, which is the rapid installation phase, and the ability to actually put evidence to the story. And the evidence is in the earnings, okay? Because remember, capitalism is always a story. Somebody comes up with a great idea, they sell us the story and say, invest in my idea. And the evidence of the story actually being brought to fruition as having some value in our economy is through the earnings cycle. And so the gap in between that idea and the evidence is where people were sitting over the last 3 years far too long. And now we have that evidence. And I think moving forward across the board, it's one of the most well-balanced setups going into 2027.
I mangled the Ed Yardeni comment. So I want to correct it.
Yeah.
8,400 from 82.50. 8,400 from 82.50, just to make sure the record is set on where he thinks we're going from here. Do you think because you like cyber and software's done better, that the death of that area of this market was greatly exaggerated? Is it a place that you would like? If you think semis have had this seminal shift, what about software?
I think that software was over-exaggerated, right? But the concern was warranted. And I think what investors need to be doing right now is actually placing investments instead of bets. In the early days of this, there was a lot of like meme stocks and the betting of either a consolidation or an outright death. And I think now we have the evidence through earnings that that is just not the case.
Financials you like?
We like financials.
We're going for, I think, 11 weeks in a row.
Yeah.
We haven't seen a streak like that since like 1989.
Just beginning.
It is?
Just beginning
Why?
in many ways. Because we're coming into like a full deregulation cycle. Lending is starting to pick up. We've got, productive IPO slates, not to mention the credit boom. And so all of those things really come into, I think, supporting financials going forward.
Good to have you back.
You too.
Enjoy the rest of the summer.
Thank you.
Thanks, Sherry Paul. 8,400 from 8,250. Coming up, a possible takeover bid sending shares of one restaurant chain soaring. Details next. Welcome back. We have some news out of Washington. Megan Casella has that for us. Megan, what do we know?
Scott, it was just announced that White House Press Secretary Caroline Leavitt will be stepping down from her role at the end of the month to spend more time with her family. President Trump just announcing this on Truth Social, writing, "Our wonderful White House press secretary and one of my most trusted aides, Caroline Leavitt, will be departing her role so she can spend more time with her beautiful young children and family. He calls it a decision I totally understand and respect." He says, "Caroline will now be one of my top outside advisors and an influential voice within the Republican Party as we work to defy history and conclusively win the midterm elections." In her own statement, Caroline again attributed this to her family, saying, "The truth is, since returning to the White House after the birth of my daughter, I have felt in my heart I cannot be the best mom while devoting the constant time and attention to the job of press secretary." So, Scott, by my count, this is the 5th high-profile departure in the Trump administration since the start of his term. It was Lori Chavez de Remer, Kristi Noem, Pam Bondi, Tulsi Gabbard, and now Leavitt, again remaining as an outside advisor, but some turmoil now, or some turnover, I should say is the better word, in the Trump administration. Scott.
All right, Megan, thank you very much. Megan Casella coming up. Cisco and Cerebras about to report earnings in overtime. We'll tell you what to watch for. Plus, Cerebras shareholder Malcolm Etheridge, he'll join us ahead of that print next.
Now we finally getting the drop. Googity Bob. Right here now at the end of the day. Finally getting a drop. It's not even a significant drop. It's just a drop, return really back into the zone. Very confident with the trade that I didn't take today, even though this was a pretty nice opportunity even here in the last minute. Hold up, like 772, 8, 50 cent. Might really be worth it today. If I'd have been here, I'd have took it, but I wasn't. Anyway, I want to thank you guys for tuning in. Look forward to being here with you tomorrow, inshallah. Yes, sir. Bright and early, guys. We'll come up with a game plan of attack. Let's see if we can make a few coins. If the opportunity presents itself. I do regret not being here.
I got some news on Wendy's. Let's get to Brandon Gomez with that. What do we know here?
Hey there, Scott. Yeah, we talked about it earlier. Wendy's shares are up 13% on a report that Nelson Peltz's Trian is preparing a takeover bid for the burger chain. People familiar with the matter told the Financial Times Trian is working on a proposal with backing from an assortment of investors, including Blue 5 Cap.
Meta is down bad. But showing you my charts, my trading view charts, where I want to take my trade at today. I clearly saw this chop in this area, And I wanted to either grab a call on the breakout above it in that 774 area, or I wanted to wait till we drop down to the 769.5 area for a put. This action we really get now is really our very first decisive, bearish move, but it is a rejection off of that 773.2 resistance area. So that has been holding for the past couple days. Shout out to those of you who were able to catch that. Some beautiful profits the last 15 minutes, maybe 30 minutes, depending upon where you got in at. Alrighty, I look forward to seeing you guys tomorrow, inshallah. Have a good evening.